Welcome back. This is Open Exchange, and we are coming to you live from the CNBC-TV18 Motilal Oswal studio. Well, let's turn our attention to the telecom space and let's discuss, how trends are likely to pan out. But before that, let's play out a soundbite we got from Communications Minister Jyotiraditya Scindia, who bats for more competition in the telecom sector. Let's hear that out, and then we'll get an expert opinion.
Today we have fiber, we have broadband, we have Wi-Fi, we have mobile, and soon enough, we will also have satellite. Our job is to provide as many avenues as possible, and within each vertical as well, provide intense competition. It's not good enough having a duopoly or one carrier or two carriers. You must have competition in every sector. India today is probably the only country in the world with 4 telcos.
Okay, that's the minister. Can we read between the lines? Should we read between the lines? Are there implications for more than 2 players, the third weaker player? Balaji Subramanian is with us, Vice President at IIFL Capital Services. So I'm not going to do the reading between the lines. I'll ask Balaji to help us with that. Balaji, what do you make of it?
Good morning. Thanks for having me on the show. I think this kind of reiterates the government's intent to have a 3 private player plus 1 PSU in the market. So there has been a lot of twists and turns as far as Vodafone Idea's fortunes are concerned during this year. So they did the dues conversion into equity to the tune of 37,000 crores sometime in late March. And then, there was this chatter that the government has done enough, and it also kind of coincided with the Supreme Court rejecting the review petition by the telcos. So again, there was a concern that we could be headed back to those days when there were these fears of a duopoly. But now I think there were a few media reports that a couple of days back talked about more options in front of the government, which could be like extending the payment timeline on the AGR dues, converting the compound interest into simple interest, and so on and so forth. So I think, again, the spotlight is back on, the government kind of showing its support behind having a third player. Now, the Supreme Court verdict also provides some leeway to the government to kind of, work out a number of options that have been discussed. So I think that is the key monitorable going forward, because as things stand today, Vodafone Idea has to make about 16,500 crores of AGR payments by 31st March 2026. And for that, that is pretty high. And it will internal accruals will be insufficient to make those payments. And unless there is clarity in terms of more government support coming in, debt raising will be a tough ask. So I think the first step would be, ideally should be some kind of a relief measure in terms of either quantum of the liability or in terms of extension of the payment timelines.
All right. Hi, Balaji. Good morning. Good to hear your thoughts as always. The first payment you said is how much by 2026?
That is around 16,500 crores.
16,500 crores. All right. And what are you penciling in, though? The minister, we heard what he had to say. Do you think that Vodafone, are you factoring in a 3-player market or more than that in your estimates?
See, my estimates or, my view is that Vodafone Idea will remain a third player. Of course, what market share they hold on to will also be contingent on how quickly they raise funds and, how quickly they plug their subscriber loss. Even today, they are losing subscribers, even though the loss rate has come down from where it used to be about 6 to 9 months back. So my base case is that we will have a 3-player market, and Vodafone Idea, will survive as the third player. But I don't see it thriving meaningfully because, again, there are challenges in terms of their spectrum debt burden. AGR will only address a part of their problems, while the spectrum debt is the larger one. And there, at least I don't see an easy way out other than giving them a fairly benevolent payment timeline.
So, but if they survive, then it'll be good, from a customer perspective. But from a shareholder perspective, at around 6 rupees 80 paise, what is your rating you have on the stock and view on it?
See, I have a reduced rating on the stock. That is simply because of the fact that even if we were to assume, some of these relief measures coming in, I don't know in what form and shape they will come. But considering the heavy payouts that they face even on the spectrum side. On one side, their ability to invest in network will be compromised. And let us not forget that both Jio and Bharti Airtel are significantly ahead in terms of their 4G coverage, 5G coverage, capacity, etc. And they are also continuing to invest in their networks, even though their peak capex phase is behind. And if Vodafone Idea has to have significant headroom to invest, then that would mean that at some point more of these dues get converted into equity, which will be a dilution from an existing shareholder's perspective. So that's why my view is that even though Vodafone Idea should survive as the third player, it still may not be the best, long-term investment from an equity holder's perspective. That said, there could be stock price pops, especially if there is some finalization or there is some clarity on the relief measures. So that those pops can't be ruled out. But fundamentally, I think the company still has got its task cut out.
Got it. All right. So there'll be a three-player market, but you have a reduced rating on Vodafone Idea. The last few trading sessions, there's been some traction actually on Bharti Airtel. And there was this expectation that maybe we'll see a tariff increase. What are you penciling in terms of a tariff increase, and by when? If you could help us out with the quantum.
See, my assumption in terms of the next tariff increase is sometime towards the end of this calendar year, or sometimes in the early calendar year 2026. I think the expectations have started already getting built in, because it's almost a year, almost exactly a year since the last tariff hike happened. And with all the tariff increase now in the base, and soon that will also get anniversarized in the numbers. So I think, the expectations of the next round of tariff hikes are starting to get priced in. That said, it is very difficult to call out the exact time. But as I said, I am penciling in something towards the end of this calendar year.
Okay. All right. Towards the end of this calendar year. That's what your estimates are factoring in, right?
That's right, yes.
And how do you see the ARPUs move, say, in the next 2 years from current levels?
So if you look at Bharti Airtel, they are at around 245 as of last quarter, 4Q FY25. I would expect them to almost hit 300 rupees by the end of FY27. Which includes, the next round of tariff increase and some, organic upgrading from 2G to 4G data consumption increase, etc., that keeps happening on a regular basis.
No, very useful conversation. I mean, Bharti, we don't talk about this very often, but what a strong outperformer, right? It has been. It was 750 rupees beginning of 2023, and it is basically more than doubled, and that's a large name we are talking about. So sometimes you don't have to look very hard to find the winners. It's right in front of you, but that gets ignored. But obviously this has not been ignored. It's been ignored, I guess, as far as mainstream conversations, etc. go. You're looking at the next big thing, the small cap, the mid cap, but this is a huge, big, giant company which has delivered such phenomenal returns. Balaji, in terms of targets, etc., slightly longer term, beyond the 12-month that you guys put out, do you think this will the stock is a good buy?
I would still think so. I think one interesting aspect that has clearly been visible in the last round of tariff hikes is that Bharti has been able to see the highest revenue growth from the tariff hike that happened last year, which means that the company has managed to keep churn and downtrading to the minimum possible extent. And I think that is because as the overall general price level keeps moving up, the ability of Bharti's superior quality subscriber base to kind of absorb those tariff increases also starts shining through. I think that is a substantial point because we have had similar tariff hikes by all three players, but it has been Bharti who has been the biggest beneficiary. So I think, even the next round of tariff hikes, I wouldn't be surprised if that trend repeats itself, maybe in a more pronounced manner than what we saw in the previous tariff hike. And that is why, Bharti's stock is trading at where it is today. And I would tend to kind of, expect the stock continuing to do well because the execution engine has been smooth. There is a clear line of visibility towards the 300 rupee ARPU mark. The return ratios are improving. The FCF generation is healthy. And with only 3 serious, spectrum buyers in the market, the kind of, competitive intensity, even when it comes to future auctions, renewals, etc., will be fairly manageable.
All right. So Bharti Airtel indeed gets a thumbs up from Balaji as well. Thank you very much for joining us, Balaji. Good conversation and appreciate you taking out the time for it. Nifty is up 106 points in the pre-open, 0.5% higher. I just want to point out one individual stock, and that's India Mart, up 4%. Nuvama has turned positive on the stock, and the market is taking note of that brokerage call. We'll talk more about it in just a bit. But let's go across to our technical experts for the 9-10 calls as well. So, Darshan?
Well, it's HDFC Life. Buy HDFC Life with a stop under 763.
Okay. And Mitesh, what would your stock be?
Delivery for price targets of 393, 395.
Okay. All right, gentlemen. Thank you very much for that. Well, before we hit market open, let's quickly revisit some names on the consumer side as well. Mangalam's looking out for Titan and Indian Hotels. Tell us more, Mangalam.
Well, we spoke about a couple of initiating coverages yesterday. Today, one has come in on Indian Hotels, where JP Morgan has initiated a late check-in, but, they have a high price or a long stay. They have an overweight rating, 890 rupee target price. The recent weakness on the stock, they believe, is a way to accumulate. That's because, one, they are expecting better than expected revenue per available room growth in FY26. The consensus estimates on EPS were downgraded because of the military conflict. They believe that this can be revised, and they expect strong first quarter performance on a low base and initial signs of a high offtake as well. In fact, the FY30 targets that the company had set itself, they believe that they would be achieved ahead of schedule. The other one that I'm looking at is Titan, where Macquarie has written they've had an outperform rating and a target of 4150 rupees. Why do they say that? Because, one, they believe the first quarter there has been healthy demand for jewelry growth, and they believe that the EBIT margins for the companies have bottomed out in FY25, and they expect 20% plus sales growth in both jewelry revenue and EBIT in the first quarter, and that would mean that is a positive, and that's why they are outperform on the stock.
All right, we'll keep an eye out on this one as it opens up. The pre-open about 0.75% higher on Titan. The first rates will start to come up and we'll get going with what we have. So 0.5% of the Sensex, about 0.45% of the Nifty. The Nifty Bank is up about 0.75%, looking better. And mid-cap and small-cap indices are up 0.6% as well. So 160 on the Nifty is what you have. And the Nifty Bank is starting at about 56,500. Okay, so it's kind of flattened out on the Nifty Bank. The Sensex is up 0.5%. Small cap index is up about 0.5, 0.6% as well. 100 points on the Nifty. The Sensex is up around 400 points as well. You know that at the margin, was there some expectation? It was a binary event, who knows, right? But at the margin, was there some disappointment with regards to Korea not getting bumped up and then opening up space for weight increase as far as India is concerned for global funds? Perhaps, yes. I mean, but not really the big driver at all. You got bulk of it, at least with the Nifty 50 heat map opening up in the green. Ultratech, Titan, NTPC, RIL, Power Grid are top of the list. And at the bottom, you got about 4 names which are starting in the red. It's a good start, about 1/3% higher, 25,135. Surbhi.
Okay, 90 points up for the Nifty, though the Bank Nifty is flashing a little bit of red, you'd have to say. Not showing too much of enthusiasm immediately. Let's talk about the Nifty gainers then. On the gaining side, Titan, we just heard the view from Macquarie come in. That's working well for the stock, almost 2% up there. Trent is also up. There's some buying in IT names. Let's see if it lasts today, unlike yesterday. Wipro is slightly higher, 1% higher. HCL Tech is about 1% higher. Reliance is a meaningful contributor. Gain of almost 0.7% on Reliance as well. Lever is up about 0.5%. So that's what's bringing up the upside for the Nifty. The downside, financials are a problem. ICICI Bank, Kotak, SBI Life, Axis, HDFC Life. It's banks and NBFCs not feeling too great this Wednesday morning. Bank Nifty is flashing a little bit of red. Before I hand it over to Nigel, I just want to complete that point on IndiaMart. The reason that stock is up 5% is because a Nuvama note has come out. Nuvama has upgraded it to a buy. It's increased the earnings estimates by 9-10% because it feels that revenue growth will now start moving higher with what the management has been doing. So that's an interesting stock beyond the Nifty, up almost 6% now. Nigel.
Well, that's right. That's a big upgrade actually coming in from Nuvama because they have upgraded the stock to buy from reduce. Remember earlier they downgraded to hold, then they went to reduce, and now in fact the target price from 2,100 to 3,800. So big revision out there, and also the multiple they're giving is 35 times. Earlier they were giving it 22 times. So that's about IndiaMart. What else? MediAssist. That one's moving with some good momentum this morning. So that in fact is up closer around 3%. Big shade of green out there on MediAssist, up 4.5% now. Mukant, another one that we don't talk to very often, stainless steel player. The hope was that in fact, they will see a bit of a turnaround, which hasn't been forthcoming actually in the last few years. But in the last 2 trading sessions, massive volume-based buying is what we've seen out there, delivery-based buying. And that stock, in fact, has moved up in style. So good going on that one. A few other names, not too much of volumes out here. So the Nifty is up close to 120 points. That's pretty good going. But as we mentioned earlier, it appears the Nifty Bank a bit of an underperformer today, and that's up of only around 30 points. But the number of stocks advancing to the number of stocks declining, 4:1. You like that look on the screen?
Nigel, there's a stock, Enviro Engineers Infra, right?
Yeah.
Which is it's EIEL, Enviro Infra Engineers Limited. Okay, I think it's down. It's down about about 1% or so.
Was the big mover yesterday.
Was the big mover yesterday, absolutely. All right, I think what we'll do is we'll look at more stocks as we go along, but our market conversation is what comes up next. So let me bring in Sandeep Bhatia, who's with us. Sandeep, always a pleasure having you with us here. Good morning. Prashant here. Sandeep, of course, is Managing Director, Head of India Equity at Macquarie. Sandeep, a lot of volatility, but the market has been very, very steady. And I guess we kind of, away from geopolitics, start to focus back on more local stuff and more trade-related stuff and all the supply which is coming into the market. How are we placed? I mean, the mood is positive, but there is reluctance to chase things higher in a big way. Would you agree?
Yes, definitely, I would agree. So pleasure to be on the channel again. Good morning to your viewers and to all of you in the studio. What do we say? I don't think geopolitics goes away permanently. In fact, I would think that we are in the age of geopolitics for the next till at least the end of this decade, for the next 5 years. And in the interim, I think India has actually started on the margin seeing improvement in consumption. I was just reading the May data on credit card spends. That's up some 15%. We all know that the monsoon progress has been good. The monsoon has covered almost all of India except parts of Rajasthan and Haryana, Delhi. So hopefully we are in for a good spell of monsoon and therefore agricultural growth, and therefore rural consumption. So all told, India will be in a good zone in the second half onwards. I think I was just talking to senior fund managers yesterday. The RBI cutting rates, the tax cuts which happened in Feb in the union budget, all of it point to significant impetus given to the economy. So I would think we could be pleasantly surprised in the second half. Valuations remain very demanding. There's a lot of supply of paper. On the flip side, that's where I think the market, as you just said, seems to be in a bit of a balance. A lot of good things happening, but also a lot of supply.
Hi, Sandeep. Is that supply becoming a concern? I mean, just the extent of it, and it's coming from everywhere, IPOs, blocks, etc. And local mutual funds, they're not getting in the kind of equity flows they were getting, say, back in December or January. Is supply a concern?
Supply would be concerned if we see some reversals happening in further reversals happening in flows into the domestic mutual funds. Supply would be a concern if there's some bad news on earnings. I don't expect that, but yes, if that happens, then definitely supply is a concern. I don't think I would be too concerned about even a market correction of up to 10%. It's something which is required. It's something which is would actually present an opportunity. We had great supply and a lot of issuances coming in last year. It was one of the best years for investment bankers. I think this was seen to be a weak year, but actually it started on a much stronger note than anyone anticipated in terms of issuances. So yes, it is potentially a cause for concern. But a market correction, if it starts a market correction, it can easily, it's actually a good thing for investors.
So would you think that you would not rule out another 5-10% correction from current levels?
Yeah, I don't think at these levels anyone can rule out 10% kind of correction. I'm not saying it's happening. All I'm saying is that it can happen. There's nothing that should not spark any nervousness for investors.
Okay. Sandeep, the other issue is the drivers from here on. So if you're an optimist, you'll say that the RBI is loosening, we have the income tax cut, and who knows, maybe we have some GST revisions as well, which make things more reachable for the average consumer. Do you expect a bigger pickup and a wider sort of a pickup in overall earnings? And is that already in the price now at 25,000, or could that provide some cushion and maybe even some upside?
We are now exactly the way you framed your question. We are all looking at the margin. At the margin, is there a real upside, or at the margin, is there a real downside? I would think if you say anything of material nature, it should be about 10%. I would definitely, as I said in the beginning, there's going to be a slow grind up. On the whole, I think we are not in a zone where we will see a major downfall of over 10%. So let's say between 15 to 20%. I'm not in that camp, but it will be a slow grind up. There are positive factors which are helping the market. The only negative I can see is the amount of supply and the quality of supply. Obviously, the quality of supply is always a concern, and it always something which we know post facto. Once the supplies hit the market, once the first quarter numbers are out, that's when we realize that these were duds. So yeah, this is where we are. At the margin, positive, but need to be careful and would take any correction in market as an investment opportunity.
Okay. All right. Sandeep, I recall you joined us post Trump's first round of tariffs, and you said India will outperform. And kudos to that call, because India actually did pretty well and we bounced back very, very well. And one sector I think that you said is pretty well placed is pharma, if I remember correctly. Is that a sector that you're still bullish on?
We continue to like Sun Pharma. We think that's something which offers both earnings growth and in a very high valuation market, still decent valuations. So Sun Pharma is definitely what we like. I think we are now in definitely a stock pickers market. Rather, I would say that we are in a stock pickers market for some time in the future too. As I said, I don't expect a major correction. So this is not going to be a screaming buy market. Therefore, you have to be extremely careful. Either look for earnings growth of 12%, steady earnings growth 12%, which you see can continue for, let's say, 2+ years, at least 3 to 5 years. Then you will be in the money in that stock. Or you look at earnings surprises. I think one sector that we initiated and we liked has been the hotel sector. We have seen some negative headwinds come through because of the air accidents and because of the wars and because of travel. So again, this is a structurally bullish sector. We like companies such as Chalet or ITC Hotels. And so if there is a correction in some of these sectors or stocks, then that's something which investors should look at. As I said, look for steady earnings growth and price corrections in high quality companies. Those are good names to look at.
No, absolutely. Sandeep, what you were saying earlier, right? 10% kind of fall, no one should panic. I don't think anyone, that's the problem. There is no panic. As good as there's no panic, but it's also a problem, right? Because everything gets bought into so fast, and before you know it, they're right back. They snap back so fast nowadays, right? So there's no sustained, or it doesn't stay low for very long. First of all, the dips are not very sharp, and then they don't last for very long. Actually, they last for very, very short times, and it's getting shorter and shorter. Is there a problem? You always got to have a list ready, right? And cash in hand to be able to take advantage of any of those opportunities.
I think that's a very sharp observation. That's for something which I also been talking to fund managers, that these pullbacks and this characteristic of the market that you are just described, that it's a short and sharp pullback, is actually something which has happened in the last two plus years. It's never been like that before. When we got a correction, we got a healthy correction, as it was said, and it was quite a prolonged correction at times. But we are not in that zone now. And, I'll give you a perspective on this. We had the Macquarie strategist come in and meet investors just 2 weeks ago. He's Mr. Victor Schwetz. He comes regularly on your channel. So I'll tell you what when he was discussing India, what he said was India will emerge as a separate category within the emerging markets. So most fund managers, when you talk to them, they're based in Hong Kong, Singapore, Europe, or US, they look at a bunch of markets in the emerging market universe. So there's, of course, the big US market, then there's the European fund managers, and then there are emerging market fund managers. So the emerging market pack is where India resides. While India is part of the emerging market, actually what happens in the emerging market pack is that two countries, such as which are Taiwan and Korea, are developed. So they actually will eventually migrate out of the EM pack, emerging market pack. Now there's another big giant, China, which for all practical purposes, and even Macquarie's view is that it's in a structural kind of slowdown, and there's structural challenges of investing in China, which means that the only other large market that remains in the EM universe, in the emerging market universe, is India. And actually now he said that India will emerge as a separate category and a separate market within the EM universe. So like you have, US specialist investors, you have, let's say, European investors, which is still a couple of countries which are in Europe, but India will actually emerge as a separate investing entity within EM, because most of the other EMs don't make much sense. Now, that's not going to happen in 2 years' time. This is a 5 to 10 year phenomena. But we are witnessing the migration of India and the separation of India from the entire emerging market pack over the next 5+ years. So this is probably one of the golden periods of investing in India.
Which basically means that you've got to pay a high price. You've got to be ready to pay a high price of admission, right? It's a good point, and we're most likely going to be speaking with... I read that note that Victor wrote, and we'll be speaking with them next week. So we'll bring up some of these things. But good explanation, good context, Sandeep. Thank you very much for joining us here on the channel. There's so much demand, right? So you got to have supply on the other side as well. So oftentimes we complain about all the supply, but supply is good. Otherwise, demand is going to overwhelm. And we're talking about some new supply which is coming to the market, a new IPO. So it'll be HDB Financial Services.
And it's been one that's been awaited for a long time. It's going to be the largest issue, perhaps, at least as far as this year is concerned. We haven't seen something as big. We're talking about 12,500 crores. And the subscription is open today. The price band is between 700 to 740 rupees a piece. The proceeds of this issue will be utilized for future capital requirements. About 2,500 crores comes into the company, and then there is a OFS part of it as well. So let's understand HDB Financial Services better. We have with us G. Ramesh, Managing Director and CEO, as well as Jaikumar Shah, Chief Financial Officer at HDB Financial Services. Gentlemen, good morning and thank you so much for joining us. Welcome to the studios. This promises to be the start of perhaps many interactions in your due course of your listed independent financial market journey. So very interesting business, sirs, and I just want to put some context out there. A lot of your lending is happening in tier 3, tier 4 parts of the country. And for the benefit of our viewers, I just want to put this out there. We'll put some graphics as well, that the 3 key business verticals for HDB would be enterprise lending, which is almost 40% of their business. There's asset finance, which is another big piece. And then there is consumer finance. So just broad thoughts over there. You've managed to grow the AUM, if we go by past years, CAGR at roughly 20%. As you come to the market, what's the sense on the scale and size of the business, the growth, and the key drivers ahead for HDB? So,
thank you for inviting us today, and good morning to all the viewers. So we started the company in 2007, started lending in 2008. Today we have a balance sheet size of about 1,07,000 crores. It's an organically built balance sheet. We didn't do any acquisitions over the years. We have 19.2 million customers as we speak, presence in 1170 cities through 1771 branches. So that's the scale of our distribution. That's the scale of our business. And we've been growing through the last 17 years of our journey. What we believe is that India is a huge opportunity for our business. And just to clarify to our viewers that we are a subsidiary of HDFC Bank, but we do not get any business from HDFC Bank. We are independently an entity. We don't get leads from HDFC Bank or any of the group companies. And that's been since inception. We run our own origination, our own risk management, our own collections, our own technology stack. So our business and technology stack is independent of the bank. And we believe that, with a product suite that serves the needs of aspirational India, we are well poised for making the opportunities in the future.
Mr. Ramesh, I'm glad you're clarifying that point, that from a lending perspective, you're very different from the bank.
That's right.
But just clarify on this part, you do get, you do some services for HDFC Bank, right? The sale of services, as that part of it is called.
That's right.
I think FY24, it came down a little bit, the contribution from that segment, FY23 also. So just tell us what the thought is, because it's been giving you more than 1,000 crores of revenue every year.
Right.
So going forward, will that continue to be a big revenue stream? Are you looking to scale it down? What's the thought? The BPO part of the business for the bank.
Right. So we provide some BPO services to HDFC Bank and only to HDFC Bank. It's in the nature of collection services and some back office work that we do for the bank. That scale of that business really depends on the volume requirement of the bank. In the last few years, the bank has invested in digital capabilities, so some of the requirements have come down. While it's a significant part of our revenue, it's a very small part of our net revenues, which is a profit after tax. Given that our loan book itself is now 1,07,000 crores and generates significant revenues, it's a small portion of our net revenues in that sense. So not very material from a business perspective.
But it'll come down. That source of revenue eventually will be coming down.
Yes, relative to the lending business will come down, yes.
Let me just complete that point. Good morning, both of you. Thanks for coming down. So there are these RBI draft rules, right?
That's right.
With regards to overlapping business. How, as they are firmed up, what do you think is going to happen? I mean, what are the possibilities? How will you have to deal with it?
So essentially, the draft rules came out about 8 months back, right? Yeah. And the draft rules are really a document that's put out for discussion, which enables the industry to give its feedback. And the feedback has gone back to the regulator, and they're looking at the feedback. And as per the annual report, they're looking at the feedback. As I said, for us, the business is independent of the bank, right? And so very difficult to look at what might be the final circular at this point of time. I'll be back in your studio when the final.
Is it possible you may have to get rid of the business or merge it?
So those are scenarios we'll look at based on what the final circular says. As I said, we are run as an independent business. We don't see any, and the reason why we set up this business as independent business is because we chase a set of customers which are fairly distinct from what the bank does, right? Or from what retail commercial banks in India do. For example, we have 19 million customers and 1,07,000 crore balance sheet, which means that our average ticket size is just about 1,65,000. We only do retail lending. Our top 20 customers account for less than 0.34%.
No, you're it's very, very granular.
Right? So that's the level of granularity of a business, and which is what I think is best service to an NBFC model.
Yeah,
that's
absolutely. And we'll talk about growth, and we'll talk about the real stuff in just a bit. I just wanted to get this point about HDFC Bank out of the way. It may also lead to HDFC, the bank, having to sell their stake down to 20%. So if that were to happen and it's no longer the parent, I mean, then does it affect?
So it doesn't affect the business model of the company in any way?
Ratings, ability to access funds?
I mean, again, it depends on scenarios of what happens, where does the ownership get transferred to, and things like that. So I said, you invited me to your studios again. We'll talk about it in the final circle.
I think you want to chip in as well.
As Ramesh quoted, RBI in its annual report has said that they will issue based on the feedback received. And I think that's an important point to know, that the regulator has taken in the feedback and it will work with us. Today, RBI is probably one of the finest regulators in the world, right? They've classified us as an upper layer NBFC, and as part of that, wanted us to list. So we'll work with our regulator to make sure, what's best for the company, what's best for the country. We'll go ahead from there.
Okay, all right. You all can't give us fixed numbers, but I just wanted to know about the way things are going to move ahead. The cost to income ratio is relatively high if you look at some of your peers. So how do you see that panning out in the time to come? And in the past year, maybe a couple of one-offs, but the credit cost spiked up a little bit. How is asset quality looking, and what's the way ahead?
So let me take that one first. So if you look at how Ramesh explained a bit about how retail we are. Now, when you're touching every single part of the country, right, and your average ticket size is approximately 1,65,000 and you're disbursing 4,000-5,000 crores a month, you can imagine how many touch points you have. If you were to give out a 5,000 crore loan, it's very different to giving out a 50,000 rupee loan. You still have to do your KYC, you still have to make sure your customer is good, you still have to make sure, you've understood the credit of the customer. That kind of retail granularity, right, demands the kind of cost that it does. The most important focus for us is the return that we generate at the end of the day. I think the way you look at different models, and you all analyze probably more than I can imagine, each model works differently, and this is a product that we've developed in a manner that services the real Bharat and at the same time delivers the right return for our shareholders.
So on that point of asset quality and what your shareholders can expect going ahead, I think about 30% of the book is unsecured right now, 70% is secured assets. Are you planning to maintain a similar ratio? Just give us some more sense on the unsecured part, because typically that's better for business, higher yields. So what's the thought process between secured, unsecured, the way you see yields moving as the book grows?
So we have a 73% secured and 27% unsecured as on March 31st, 2025. That's been in the range of 75, 25, 70, 30 over the last few years. Unsecured lending is a business that we've been doing since 2008. That's the first business we started. As I said, our focus has been that how do we touch our customers' lives as many times as possible through our products. So our product development strategy has been around making sure that whenever a customer has a credit need, do we have a suitable product that meets the customer's requirements? So it's a business that we've been doing now for 15 plus years, very comfortable with a 75, 25, 70, 30 range.
Okay.
Yeah.
In terms of growth, I mean, there is, it's a long, highway of growth, and most lending institutions, and you're well diversified, you've got the name, you've got the branding. You've been doing this for a long time. Could you give us some sense of how growth will look? Large numbers, since we can't be specific, let's go long. I mean, we can't talk short.
So let's look at a few fundamental things. Right?
As you said, you're about 1 lakh plus odd crore size.
Yeah. All organically built, yes.
Yeah. So say in the next 3 years, where will that number be? I'm talking about,
Right. Okay. So I can't give you a forward-looking guidance, but what I can tell you is aspirations.
You can't give me forward-looking, so maybe really forward-looking. That's my roundabout. But
so one is that you look at our distribution, 1170 cities. You can imagine what the 1170th city actually looks like, right, in India. 70% of branches in city number 101 and beyond.
Yeah.
Right, a phygital distribution model, and one of the things Jay was referring to when we said our cost to income appears slightly high, but that's also because we're looking at the customer and saying, what is the best option for this customer to engage with us? So we don't say you can only do digitally or you can do physically. We're saying choose the method that you want. You can do a purely physical or purely digital. We are comfortable with either. Our response times on processing applications are no different, whether a customer comes into the physical model or digital model. The fact that the back end is fully digital, 97% of applications have a digital footprint, right, in the form of processing. And one of the propositions we offer to our manufacturer partners, and we work with more than 100 of them between our consumer finance and our commercial vehicle and construction equipment business, is that irrespective of where you are in the country, our response time will be the same. So whether it's a metro like Mumbai or whether it's a small town somewhere in Assam, our response time is the same. Our customer growth has been about 29% in the last 3 years. Our AUM growth has been about 20% last year. And we continue to think about what new products we can add to the suite we already have. And that's the way we think of growth.
Just a quick last point. Again, I know you can't give very specific answers, but we need to understand an assessment on the borrowing mix, the yield, the margin profile that aspirationally you think you can sustain and maintain. I think first half it's been around 7.6%, Jaikumar. In the past, on a full year basis, you've maintained margins upwards, northwards of 8% as well. We're in a rate cut environment. So what's the sensitivity to margins in a downward rate regime? Just give us some color. I mean, is 8% sustainable? I mean, long-term basis?
I'll give you two components to it. One is our yields and second is the borrowing cost.
Yeah.
And we have a very matched principle in terms of how we borrow. So we don't borrow short and lend long. We don't borrow too long and lend short. Either ways. So we have a 3.5-year book approximately, and we borrow 3.5 years. Now, on that, one important component is, if you look at rates that were there in 2021-22, it had gone down to as low as 5.7 and 6. And the rates that came out in 2024-25 were approximately 8%. So one of the things which happened is a spike of around 200 bips, which just shot up very fast. Now, for a retail business like ours, when you're going to a customer, neither does it go up very fast, nor does it go down very fast. So that's a bit of spike which has come through. As the balance comes back, I think things will fall in place.
Which means higher margins eventually as we go down the cycle.
So the way I would look at it is, what was I borrowing at maybe in January to now? The rates have purely cooled off by almost 50 bips. That's just a statement in the market. And with our parentage, with how we operate as a company today, we are probably the finest borrowers in the market. And that's just public data. 37% of our loans come from bank borrowings, and more than 45% almost comes from NCDs. We're the largest issuers of debt today in the 2 to 3 year space in the country. Okay. So we don't talk about it as much, but we're very happy that, we can work behind the scenes. Our treasury is completely independent of the bank. We operate on our own and make sure we fund our own assets.
Are your most of your loans, are they fully linked, external benchmark linked? I mean, how frequent is the reset? I'm just trying to understand how quickly you have to revise them lower.
So in terms of our loan book, only our LAP book, which is around 23% of our overall book, is floating. Okay. The remaining entire 75-76% is completely fixed rate.
All right. We'll talk numbers and guidance next time you're on, and after that as well. Thank you both for joining us.
Thank you. And
thank you so much. Pleasure.
Good luck.
And during that conversation, we already fixed the next couple of interviews. So looking forward to having you back in the studio. Thanks a lot.
So much. Thank you for inviting us today. Thank you.
Well, let's get to the next management then. That of REC. Mr. Harsh Baweja, the Director of Finance at REC, joins us to talk about the impact of RBI's new project financing norms, rate cuts, as well as the outlook for the remainder of this fiscal. Hi, Mr. Baweja. Thanks a lot for joining in. Well, it was definitely a relief that came in from the RBI when we looked at project financing norms. Help us out now. Help us decode some of these final guidelines. How do you read this? And more importantly, how will it impact your business as well as your capital ratios?
As far as REC is concerned, since this is not coming retrospectively, this will be prospectively. So ultimately, our the book up to 30th September 2025 would be governed with the existing rules, and this will be applicable to the financial closures to be done after 30th September 2025. So it will have a very insignificant effect on the balance sheet of the company. Reason being that as of now, my provision on the standard assets is already 0.94%, whereas the RBI has mandated the minimum 1% provision for the under construction project. So we don't think that this is going to impact our balance sheet. Number two, NBFC's accounts are basically governed by the India system. And whatever additional provision, if there is on account of RBI provisioning are there, that is routed through the impairment reserve account. That doesn't affect our PAT, basically. Number two, the guidelines says that total provision of 1% on the under construction assets is to be made. So in case if I do the financial closure of any of the asset in the Q3, then the provision will have to be made progressively based on the disbursement to be made in the quarters to come. So it is going to make any effect, very insignificant effect in the books of accounts, and that will be done only progressively. And simultaneously, I can say once that asset achieves the completion, then the extra provisioning made will be reversed to 0.4%. So ultimately, this will be a continuous business after the March without affecting my previous business, which has already been done.
Okay, got that, sir. Now, your company reports low credit costs, right? But as a key market player, do the final guidelines also indicate that RBI does not see increasing risk in project financing? And can we expect that for your business as well?
As far as my credit costs are concerned, that is already at a very low rate, and we make a provision of 0.4% of my stage 1 assets and 0.5% of the stage 2 assets. For under construction project, as I have already explained you, for the new projects, we will have to make an extra provision. But having said that, if you see my numbers of the 31st March 2025, I am already at the level of 0.95% of my provisioning in the standard assets, stage 1 assets. So perhaps we don't see much of the impact on the ECL numbers and the credit costs in the near future, sir.
Okay. Mr. Baveja, another tailwind perhaps is, of course, the rate cuts. We're in a downward rate regime. So how will this impact your spreads? Any internal assessment that you have done for the business? Maybe if you can give us some sense of margins.
As far as the RBI's rate cuts are concerned, we have yet to see the impact coming to the market. Since if you see the bond yield, which has been happening for the last 2 or 3 weeks, even post the rate cuts, there is not much of the rate cuts in the bond yields that is coming in the market. Rather, before the rate cuts, REC could raise one of the cheapest source of funding through the institutional bonds. But in the recent times, say within last week or so, the bond yields have gone high. So we have yet to see the impact of that and the impact of the CRR, which is to be done in progressive manner. But yes, some insignificant effect in my cost of borrowing will always be there, since whatever fresh borrowing is coming, that will be coming at the reduced rate. And we think that our guidance regarding the NIM, we have given a guidance of around 3.5% to 3.75% and a spread of around 2.75% to 3%. We hopefully see that we would be able to maintain this range within this range, and we'll monitor it quarter by quarter. We see that impact further coming up in the market.
All right, so let's get back to the guidance then that you've given. I think around 12% loan growth. Last year, the number was impacted because of higher repayments. How much of repayments do you expect this year, and what kind of loan growth should we be factoring in?
Since we are into an NBFC business, we will have to understand that prepayments are the part and parcel of the total business profile. You cannot ignore the prepayments. Number two, in case if any of the agency is making prepayment to us, it means those agencies are the sound parties, sound clients. And if my clients and the loan books pertains to the agencies, those who are the sound books, sound agencies, that in that case, I can say that my balance sheet is also very strong. So prepayments will keep on coming. We are not afraid of that. We treat it as a part of the regular business activities. But yes, we expect that our AUM will grow at the rate of around plus minus 12%. And quarter on quarter, we'll see the progress, what is happening, what is the percentage of prepayments are coming up. Since one of our products, that is revolving bill credit facility, that in itself has the characteristics that agencies, whenever they have the surplus, they can make the prepayment even without the prepayment charges. So that prepayment will keep on coming and that will affect our loan book also. But keeping that aside, rest are the very insignificant amount. Some of the amount had been made by the prepayment by one of the borrower who had raised the fund through their IPO proceed. Similarly, one of the big borrower had made the payment to make their headroom available for their new sanctions, then they had reached the exposure level. So these type of cases will continue to happen. And we expect, despite all these things, that we should be able to maintain plus minus 12% growth.
Okay, all right, got that. Mr. Viveja, finally, we are in Q1. What should investors expect from REC as this year rolls on? Any sense of how so far business has shaped up in this quarter, growth trends, yields, anything you can leave us with?
Quarter end is not very far off. Let us wait for the quarter end to be completed. We are working very hard on all the aspects. We are focusing on improving our quality of the books of accounts and quality of the assets. We expect that by the year FY26, we will be a zero NPA company, and some of the assets are at the advanced stage of resolutions. Disbursements are absolutely on the same track. In case if the prepayment doesn't happen, that it should be on the same target as we expected earlier. And as of now, for this quarter, we don't expect any effect on the NIM and the spread. That may be continuously on the guidance. And we say that since we are in the financing business, we should keep on reviewing every quarter. What is the impact? The things are changing very fast. So market is moving very fast. 15 days before, the yield rate was different. Yesterday, the yield rate was, bond yield rate was different. I am raising fund from the market. Even the international market is different. We have raised from the ECB markets. The rates which were available at the end of the March are very much different, the rate prevailing as of now. So we have to review it and we have to focus on each and every day and each and every quarter, and we'll keep on reviewing. But yes, as far as the borrowings are concerned, on the date of requirement, we don't want to keep any funds idle. But yes, on the date of requirement of the fund, which source is cheaper to us, we go for that kind of funding so as to arrive at the good cost of borrowing.
Well, thanks a lot, sir, for joining in and giving us a sense about the impact of RBI's changes as well as some sense about business. But we look forward to chatting up with you at the end of the first quarter numbers and get a further sense about the year ahead. For the time being, we'll slip into a short break. On the other side, we'll get an exclusive chat going with Mr. Mohanty of the Indian Rare Earths Limited, as the government is expected to finalize a rare earth magnet manufacturing scheme soon. Stay tuned for that conversation.
Okay, welcome back. 140 points, 25,180 is where the Nifty is trading at. Now, the government is expected to finalize a rare earth magnet manufacturing scheme within the next 10 to 15 days. This comes after China curbed the export of these magnets, which are critical for electric vehicle manufacturing. Sources say that the new initiative will have an outlay of 1,000 crore rupees and support capacity of 1,500 tons of rare earth magnets. The secretary at the Heavy Industries Ministry, Kamran Rizvi, has said India is in talks to import rare earth minerals from Japan and Vietnam.
Are we looking at any other countries where we can source the magnet from, except China? So you are aware that rare earth is available in Japan, in Vietnam, and efforts are going on to bring from there.
So now we have someone who really knows the lay of the land as far as rare earths are concerned. Mr. S.B. Mohanty is CMD in charge and Director of Finance at IREL. Mr. Mohanty, good morning. Thank you very much for joining us today. Important that we are having this conversation to get a real sense of where we stand. So as you heard, the government, of course, is wanting to set up that processing capacity here, plans to import some of this as well, as we are facing curbs from China. Give us a sense of state of play here in India with regards to these rare earths. And the rare earths I'm talking about are specifically, 4 or 5 which go into these magnets. So I hope I'm pronouncing these correctly. Neodymium, there is dysprosium, there is terbium, etc., etc. I mean, these 4 or 5 of these rare earths which go into these magnets, which are important for the auto industry, EVs, etc. Do we have sort of enough reserves of this here in India? Do we have the processing capacity? Could you give us a sense?
Yeah. Good morning, and thank you very much for calling me to this program. Actually, the India is having heavy mineral of 1,300 million ton of capacity, and out of that, monazite will be around 0.1%. That is 13.15 million, and rare earth will be 6.9 million ton we are having. So, but as per the content of the material, so we are having heavily this lighter rare earth elements, and this heavier part is not available in our resource, which is found only in minuscule or in the ppm level. So that is the key issue. Otherwise, if this magnet making is we'll look into the magnet making, they are ND, PR, and this DYTB. This NdPr is neodymium and praseodymium. These 2 elements are used, and at our capacity we are having Nd oxide, and up to oxide level we have been making it, and we have got sufficient quantity as of now. Because earlier 2020 we have tried to see what is the market absorption of this material, and that time we have made one expression of interest, but during that very few parties came up, and ultimately all of them backed out because of this inverted pricing mechanism. So how it has happened is there are 2 aspects. One is our this feed material for NdPr is costlier than the NdPr, and at the same NdPr oxide, and at the same time this this NdPr oxide price is higher than the metal as well as this alloys. So on that basis, the economy of scale is not properly made, so that people can come and invest in this area. If you look into our particularly how India is poised for the heavy rare earth elements, we have to get it either imported or we have to look for the resources like from the hard rock minerals, which is available in India, but that will take a little bit of time.
Yeah. Mr. Mohanty, so just to clarify, you're saying that, and you need heavier and the lighter elements to essentially make these magnets, right?
Right.
And the heavier we don't have, so we have to import them. That's what you're telling us.
Yes.
Okay, got it. I just had a basic question. Processing of rare earth and getting them out, I mean, it's seen to be, as far as I have understood, extremely environmentally damaging as well. And there is very little one can do to mitigate that damage. And that is why many countries around the world have not developed these industries, and they sort of have relied on China all these years. Is that a correct assessment? And what is our plan? I mean, there is, of course, getting it out of the ground. The other is processing it. So just your thoughts on both.
Actually, yes, that is correct. Partially correct. Actually, there are 2 different technologies are available for making it. One is calciothermic reduction process, and which is not environmental friendly. At the same time, this molten salt electrolysis process, if that is more environmental friendly. So if you look into those things, the countries started China, they sent the material to China and China processed it because of this environmental rules and regulation. Initially, China was having around 200 different companies operating in their country. And at that time, it was processed and the environmental laws, regulations are not followed, particularly there. Cheaper manpower, all this source was happening there. And by that way, the prices, whatever is coming for this product, the cost of production of these materials are at a cheaper price they are making it. And yes, of course, the environmental footprint is definitely there. In our country, particularly, we are looking for this molten salt electrolysis process, which is some of the magnet manufacturing who have shown the interest, they are having this facility developed already.
Mr. Mohanty, so I'm trying to simplify it further for our viewers. You know, when this crisis unfolded upon the whole world, including us, and most of the auto companies are saying that they have these magnets, maybe a supply for about 2-3 months. After that, it could be problematic. So now we're talking about this Atmanirbhar scheme, right? To even try and get self-reliant in these rare earth magnets. So just simplify this for us. You're saying the heavier type of earths, they're not found in India. So that's a separate issue. So to what extent can we look at manufacturing these magnets in-house? There is first this question of whether we have the required type of rare earths. Then is the question of whether we can set up the refining capacity, and I'm sure that's not going to come up overnight. So realistically, what are we talking about in terms of Atmanirbharta when it comes to these magnets?
Okay, so what happens in our process? We are getting this feed material for this rare earth is monazite. And this process is entirely cumbersome and complex. And this rare earth element, what we are getting is not of economy of scale. So on this process, and this rare earth elements are radioactive also, because monazite is a radioactive element. That further make it complex. So the process is also difficult. And as a result, what is happening? We focus on our lighter rare earth, particularly NdPr. There is no issue. We have developed the capacity. Right now, 11,000 ton of REO we can produce. So with that, we can have around, we have got capacity of around 800 metric ton of NdPr. So from there, around 2,400 ton of magnets can be made. But because the feed material is not available, because you know the challenges we are facing, particularly the sourcing of this monazite processing.
So, sir, just to understand, because I mean, please pardon us, these are very, very technical processes and terms. So we're trying to simplify this for our viewers.
Yes.
You just said that 400 tons of magnets can be made. So are you saying that with the available, reserves that we have, we can manufacture 400 tons of these rare earth magnets in India as of now?
No, I've said NdPr oxide is the feed material for making of the magnet. So NdPr oxide we are making. From the oxide you have to make the metal, and thereafter the alloys, and this magnet will come up. So now currently we are having NdPr oxide, we are producing around 400 ton. So but we have got a capacity of around 800 ton. So we can cater, if full capacity we operate and we get the entire monazite for processing, then we can go up to 800 ton, and 800 ton can cater to requirement of around 2,400 ton of magnets.
Got it. So we're working at 50% of the current available capacity of this, pretty important material, which is the NdPr oxide.
Just one more point, sir. The ratio is 1:3 then. 800 tons can produce 2,400 tons, correct?
Three times.
Three times.
That's the rough conversion ratio. Yeah.
Okay, got it. So, yeah, that helps us understand some of the basic brass tacks. Now, sir, the scheme apparently is going to have an outlay of 1,000 crores. So the government wants to make India as self-reliant as we can be. What should be the ask? And private industry wants to chip in. I mean, we've heard from a lot of, metal companies. Nigel's been telling us about, for instance, the Vedanta Group has been talking about it. What are the first steps? Where should the money be put? Refining capacity will take how long? How can we become more self-reliant? What would your recipe be? Whether it's mining of the rare earth, processing, and ultimately making those magnets?
right now what we have to do is we have whatever the NdPr oxide we are having right now. Let's have this facility for the magnet making, so that we have to go stepwise. First step will be whatever NdPr oxide we are having, we should be in a position to convert it into the magnet. So before going for magnet, we have to convert it to metal to alloys. These technologies are heavily guarded, and right now the technologies are not available in an economic scale. BARC and DMRL, they have got the technology, and we have to upscale it. So that is one aspect. So when we are looking for what is to be done right now is one aspect is we have to ramp up our the production capacity right now. That to make it the nameplate capacity we should achieve first. So thereafter we have to look for the demand. So demand 2030 it will be coming around 8,000 ton of magnets roughly as of date it is spoken, but it is very difficult to predict the exact requirement of the magnet in the country, because magnet is as such magnet is not getting imported to the country. It is embedded to the product, and product is coming to country, and the product HSN code whatever is there, that is different. So we are not in a position to predict exactly how much quantity of magnet is required. So as such, what we have to look for is instead of monazite, we have to look for this ionic clay where the process is small. So quickly we can come to this rare earth chloride stage, and from there we can quickly go for NdPr oxide, and thereafter this making of metal and alloys. So by that way we have to proceed. Initially we have to look for this this import of other source of this rare earth elements. That is one, and utilize our fullest capacity. And where our another one is this circular economy, where this end of life magnets, where we are utilizing right now only 1%, and we have got a potential of around 20% we can utilize it. Where you can see in China it is 100% they are recycling. So in some cases of lithium batteries, which was earlier 5%, they have gone up to 95% recovery. So in this front, if we will be in a position to recover better, so that that will also solve a lot of issues in our case.
Okay, all right, Mr. Mohanty, giving us a good science class this morning, and we request you to come back on the channel, because we can have a longer discussion on this front. But very quickly, because the markets are live as well, and the markets would like to understand what is the private participation. So have you heard about any private participation from the likes of Vedanta, as Surbhi has mentioned? And is there any role that's chalked out for a company like GMDC? Because there is hope. The management out there has been saying that they're looking at this part of the business. So have you heard anything on both these two companies?
So initially GMDC, yes, they are going ahead with this. They are looking for hard rock mining, and definitely they are coming up with the complexes coming up there. And we are also looking for this hard rock mining in Rajasthan, Sivanaring as well as Kanthai, where this hard rock mineral is available, and that contains heavier rare earth also. So quicker we go for that, that will be better for us. And similarly, you are talking about other like Vedanta. Yes, we have not heard they are coming up for this magnet making. But other private players are there who are showing their interest. 5-6 of them are there, and we hope the things will change soon.
You could name a few, sir, of the private players.
Like Intelus is one, and other one is Midwest. And
these are all Indian companies, private companies.
Indian companies, yes.
Okay, got that. So, very, very interesting conversation and a lot of science, as Nigel said. I'll have to go and revise my periodic table. Do you guys remember the periodic table?
Oh, God, 108 elements. Don't ask me to name all of them.
Hydrogen, helium, I think I said.
It's all tongue twisters.
But Mr. Mohanty, you did say feedstock, right? That we don't have the feedstock. What is that feedstock?
I'll let you know. 6.9 million ton of this rare earth elements are there. But the challenge is how to access it. So although the minerals are there, then you should have the surface right also. So because actually all these are available in the placer deposits where this habitation is full of habitation. So getting the access to the land is very difficult. And there is a misnomer going on, and some illegal miners they spread this news that it spread cancer and all. But actually, what happens in reality is when the monazite, which is the radioactive element, it is taken out from the feed material, so it became background radiation reduces. So on that front, it is rather more beneficial.
Yeah.
So those things, misnomers are not there. And on top of that, if I will compare, this Chinese source is 6%. They contain 6% of rare earths. And in India, we are having 0.056%. So they are superior in 100%.
Yeah, absolutely.
That way,
And so,
to get only 800 tons, that is the nameplate capacity, 800 ton of NdPr, we have to handle around 10 million ton of raw sand. So you can this volume.
Wow. Very, very fascinating stuff, sir. Thank you very much for running us through all of that. And maybe you can come back as we continue the progress on this front in terms of setting up this industry, actually, the entire value chain. And there are so many elements, as you said, have to go step by step. But really appreciate you sort of clarifying a lot of things, much better understanding, and I hope useful for the viewers as well. Thank you.
Thank you.
Okay, all right. We got 130 points on the Nifty, 25,180 at this point. We take a quick commercial break here. We'll focus on commodities as well. Manisha back with us in just a bit from now. There are some flashes, interesting stuff coming in from Mr. Mukesh Ambani, Chairman Reliance Industries, in an interview to McKinsey. And we'll take note of that as well in just a bit from now on the other side. Stay tuned.
Welcome back. The markets in fine form, 134 points up on the Nifty. Mid-caps are also in cruise control mode. Let's now turn our attention back to the commodity markets and see what's the latest. Manisha has not been able to take her eye off crude at all last, I think, couple of days. I wonder if it's still crude or something else, Manisha, now this time.
Oh, well, you know, with crude just about holding 1.5%, decided to move on to some other commodities as well. While crude, of course, stays in headlines there. But you have to look at the kind of gains that we've seen come in for the copper prices. Well, that is trading at a 2-week highs and has shown a quarter resilience, actually, with all that has been happening in the global markets, whether it has been about tariffs or about geopolitics as well. The currency is moving all over the place. China data not coming well, but we have seen copper prices show that resilience. Well, the reason that you have seen gains also come in the overnight market is the Iran-Israel ceasefire. It also has been about dollar index slipping back below that 99 level has been supportive as well. And then when you look at the markets right now, it clearly is a huge arbitrage that you are looking at in the space. Copper prices are trading in a backwardation one. When you look at the cash versus the 3 months, that is how it trades on LME. The cash is at a $345 a ton of a premium to what the 3-month futures are. And this is the kind of situation that you have until June 2026. So the near-term demand for copper definitely seems quite supportive there. Also, when you look at the ready available copper inventories on LME, they're down by 80% in 2025 so far. Actually, when you look at the inventories from March onwards, the last 4 months have seen inventories decline by 65%. This is the lowest kind of inventories that you have seen on LME in almost since 2023 August perhaps. Interestingly, with the kind of LME inventories that we have right now is less than 1 day's global consumption. So that is what clearly seems to be adding premium to prices there. Interestingly, when you also look at the refined copper shipments, well, to US have been at a 200,000 tons, which is the highest in a decade, is what we've seen in this year until now. While the traders are reacting to the rapidly falling inventories, potential US tariffs, it also has been about pricing crisis at smelters. And that really should come to your notice because excess capacity, insufficient raw material has taken the prices on the higher side. So much so that the spot treatment charges right now stand at $45 a ton. When you look at the copper prices, it has been steady, as I said, resilient even. For the week, we are up by a percentage point, up 2% for the month of June. And in this year, outperforming the other metals with 23% of gains.
Okay, all right. Manisha, thank you very much for that. So that's essentially the commodities picture. Let's talk about some individual names now. Torrent Power, the stock should come up on your screen. Vivek is standing by with what's going on here. I think sharp bump up and then a bit of a drift is what we are seeing. Vivek, take us through it.
Well, that's right. So Torrent Power is in focus. This is an important as well as a material development as far as power distribution companies as well as, power distribution itself in India is concerned. MERC, which is Maharashtra Electricity Regulatory Commission, on a public notice on June 23rd, has expressed satisfaction that Torrent Power can go ahead and offer parallel DISCOM services in 3 key areas, which is Pune, Nagpur, as well as MMR. So now the company can actually act as a parallel DISCOM service provider or as a parallel power provider to simplify it. Now, what MERC has said is that they express satisfaction for the company. This will act as a parallel electricity distributor. And interestingly, Torrent Power's offer as far as, this particular service or offering of service for power is actually at a slight discount to what the current prevailing rates are. Now, remember, company had actually gone ahead and petitioned to act as a distributing company in December 2022, and it was under evaluation for the past 2.5 years. Why is it important as far as Torrent Power is concerned? The company had projected a capex of close to 15,000 crore on which it could get an ROE of close to 15.5%. What is the capex towards? Capex is for 5 years towards transformers, distribution lines, substations, as well as related assets. Now, importantly, MERC will hear the final petition filed by Torrent Power on July 22nd, and which is when we will get to know the final outcome, whether they can go ahead and act as an alternative or as a parallel distribution provider. JM Financial today, in a note to its clients, has mentioned that this particular development is value accretive and can open a new stream of opportunity in future. It's an important development, number one, for Torrent Power and also for the power DISCOM space, given the fact that this could act as a precursor to going ahead and seeing more players as far as power service provision is concerned in the DISCOM space.
Okay, all right, Vivek, got it. Thank you very much for that. We will have to take a quick break on that note. Come back on the other side. We'll have Vishruth Rana of S&P Global to discuss growth and inflation outlook amidst geopolitical volatility. Welcome back. So we're talking macros now. S&P Global has increased India's FY26 GDP forecast to 6.5%. Their earlier estimate for the country was 6.3%. They're also expecting significant growth uptick in China, despite all the tariff conundrums. Vishruth Rana, economist Asia Pacific at S&P Global Ratings, is with us now. Vishruth, thank you so much for joining us on the show this morning. So we've got that note, quite interesting, because it's not just India, but you see more growth ahead in China as well. Just explain the thesis, because we still haven't seen the final word and the ink dry on the actual tariff. What is it that you're baking in your estimates when you increase GDP estimates for both India and China?
Yeah, thank you so much for having me on the program. It's always a pleasure. And indeed, in these volatile times, I think a forecast is always going to come with a wider band of uncertainty as the economic environment remains highly uncertain. But as you pointed out, one key swing factor turns out to be the tariffs and what we assume going forward for the trade environment. We currently believe that the Liberation Day tariffs that happened in the early part of May are unlikely to happen again, in the sense that we expect that the current 10% baseline tariffs that the US has in place are going to remain through the forecast horizon. In our assumptions, we assume that the US effective tariff rate will be at 15%, which is roughly the current level through our horizon. So that is one of the big drivers behind our upward revision in the region compared to our May forecast, when trade was highly more volatile and looking much darker at that time.
So what does this mean for, let's talk China, because when we're talking tariffs, obviously they stand to get impacted more. So you're saying effective final tariff for US at 15%. What about the tariffs on China? Because from 145%, then there was significant climb down. And exactly what are you expecting? A bigger uptick in China? What will drive it?
Yeah. No, that's a great question. So the 15% effective was on the global, from the US to the global.
From the US side, yeah.
Right. But for China, the level is closer to 40% in our estimate. So we estimate that the US effective tariffs on China are roughly 40%, which is very steep. There is some diversion going on, in the sense that Chinese exports are going to elsewhere, to Southeast Asia, to Europe, before going onward to the United States. So part of that is happening. But of course, the bilateral trade between the two has climbed down quite sharply. But what does all of that mean for the Chinese economy overall? One, it means that there is a more adverse external environment, and that is baked into our forecast, which is one reason why we don't think that growth will hit the 5% target that China has in place at the moment. On the other hand, the more important part for China this year is how the domestic story plays out. So there, the property sector currently still looking a little bit adverse there in China at the moment. Consumer sentiment relatively cautious, despite some stimulus measures. Overall, the domestic economy is holding up a bit better than the external environment, which is leading us to revise our forecast higher, but still well short of the 5% target that the government has in place.
Okay, so now let's talk about India. The small increase in the forecast here, 6.5%. So what made you do that? Does it have to do with the easier monetary stance of the RBI? Your thoughts?
So definitely, I think one element to the forecast is this front loading of rate cuts that the central bank has engaged in. And we think that it will lift consumer sentiment, should lift credit growth in the economy as well, which has been slowing for several months. On the other hand, the RBI did move to a neutral stance, which means that there's limited further room for cuts over the horizon. We think about 25 basis points of further cuts coming up this fiscal. Overall, the growth environment for the domestic side of the economy has held up slightly better, which is the main factor driving up our forecast for the year. In terms of the trade and tariff environment, I think India, one sheltering part for the economy is that it is more services oriented, both in terms of trade as well as domestic activity. And the service sectors have so far largely been exempt from the tariffs and trade tensions, which is going to be a positive factor this year.
Okay. Vishruth, otherwise, I mean, how do you size up the overall macros here in India? Growth, you're saying 6.5%. The hope is that inflation will remain under control. I mean, the last print was below 3%. And now with the oil prices again stabilizing, how do you see the next couple of months play out here?
Yeah, there's a couple of key factors, I think, on the inflation outlook. The first thing is food prices, of course, which is the key for India. And with the Met Department forecasting above normal monsoons, that should bode well for agricultural produce, and that means food prices should be relatively contained through the rest of the year. Indeed, we think that inflation is likely to come in just at the 4% mark for this fiscal year. Helped by the lower food prices, the outlook for energy prices is key. In India, of course, the producers bear some of the costs of that energy price volatility. Some of that is smooth before going to consumers. However, we think that energy prices for now are likely to remain range-bound, despite the recent increase in geopolitical uncertainty. And this means that energy price inflation should be relatively capped. I think one key swing factor to point out is the core prices and the prices of gold, which are currently playing into the inflation outlook. But for now, this remains relatively contained. We're not overly concerned.
Okay. All right, Vishruth, we will leave it on that note then for today. Thank you very much for joining in. Appreciate you taking out the time. With that, we're going to wind down on this edition of Bazaar. We're leaving the markets in steady form, 160 points up on the Nifty. The Nifty is actually doing better than the mid-cap index right now. Bank Nifty for the time being, also notching up gains of a little over 0.25%. So steady start to the day. We'll take your leave on this note, but do stay tuned. All the action continues. Up next is Chartbusters.
The Indian market opens higher as the street digests the ceasefire between Israel and Iran. The Nifty rises to 25,200 as all sectors trade with gains. The broader market slightly underperforms the key indices, but market breadth firmly in favor of advances.
Shares of IndiaMart surge in trade as Nuvama turns bullish on the stock. They upgrade the stock from a reduced rating to buy on the back of potential demand upcycle. They have also raised their target price to 3,800 rupees per share from around 2,100 rupees per share earlier.
MCX rises 4% as UBS maintains its buy call, raises its target price from 7,000 rupees earlier to 10,000 now, expecting new product launches to drive growth.
And steady gains for Indian hotels as JP Morgan initiates coverage on the stock with the overweight rating. They have a target price of 890 rupees per share. They expect the company to meet its FY30 targets ahead of schedule.
IEX2 rises on the back of a bullish brokerage note. Bernstein has upgraded the counter to a market weight rating with a target price of 160 rupees per share.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, with me is Mangalam. And the markets have started off well in the green, so that's pretty good news. The Nifty is up 100 points. The Nifty Bank was underperforming a little bit, but the breadth of the market still in favor of the number of stocks advancing. So the screen looking pretty good, Mangalam.
Screen looking pretty good, and dare I say it, it's early in the day, but it looks a lot more solid than it was yesterday because we have a diverse sector of moves, all of them doing fairly well. Yesterday was that bit of uncertainty that whether the ceasefire will sustain or not. Towards the end, we saw that sell-off, but now 24 hours have passed. The street has realized that this is going to sustain. And with the addition of call writing that we've seen, if the market sustains around the 25,250 mark, then could there be a case for short covering of those calls or not is something that we will be watching out for. But we're not the experts here. We do have Chandan Taparia joining in for his quick technical view on the market along with individual stocks. Good morning, Chandan.
Good morning, Mangalam and Nigel. Thanks for having me.
Yes, go ahead. Do tell us your view on the indices.
Yeah, so we have seen a consolidative move for most part of this series. In fact, on expiry to expiry basis, the Nifty index is up by around 1.5%. And volume weighted average for the series is at 24,900, and we are 300 points higher than the volume weighted average, which indicate bullish bias. We have seen sustained put writing at 25,000 strike earlier. Call writing used to happen the same. So the base of the market is shifting higher, and we are heading now towards the July series. And historically, as per the seasonality, 10 out of 10 July in last 10 years were positive, which clearly indicate the fresh leg of rally. So I'm expecting seasonality to work here, led by a bullish breakout on the daily and the weekly chart. So till Nifty holds about 25,000 marks on immediate basis, I'm expecting it to head towards 25,400 level. But on positional basis, till it holds about 24,600, expecting market to head towards 25,750 to 26,000 and probable head towards the new lifetime high in the month of July. Talking about Bank Nifty index, here also the positive momentum could be seen. However, it has been consolidating in a range, but a small follow-up could lead to the next leg of rally. With support of 56,000, Bank Nifty can head towards 57,500 mark. So expecting both the indices to start the next leg of rally, Nifty can head towards the lifetime high, while Bank Nifty can head to the new lifetime high territory.
All right, you are calling for a lifetime high on both the Nifty as well as the Nifty Bank. That'll be very interesting. Individual stocks, what do you think will lead the indices there?
Yeah, so stock-wise, first trading idea is buy on Titan. In fact, the gold prices are supporting the counter to move on higher side. We have seen a positive price pattern. In fact, corrective move of last 4 to 5 weeks is coming to an end for fresh leg of rally. We have seen sustained put writing at lower strikes, and rollover is also better. So recommending to buy with support of 35.25, and Titan can head towards 37.25 marks. Second trading idea, that is buy on Bharti Airtel, one of the strongest counter with low beta and margin of safety here. In fact, the most of the telecom counter were in action in last few days. So Bharti Airtel will be in focus. One can buy with support of 1915 for an upside target towards 2025. One more trading idea, that is buy on TVS Motor. Expecting fresh leg of rally in the counter, one can buy for an upside target towards 3,000 with support of 2810 in TVS Motor.
Thanks a lot, Chandan, for joining in and giving us all of those calls. Well, let's turn the spotlight now. The latest in the NSE IPO front. Sources say that NSE has filed for settlement with SEBI in the co-location case. Yash is picking up some of the scoop. He joins us to fill us in with more details. Yash, tell us more.
Well, Nigel, this is the biggest settlement honestly filed by any company in the history of Indian capital markets. It's coming from the National Stock Exchange now. As per our sources, what we've been given to understand is that NSE has filed for a settlement application in the co-location case with market regulator SEBI. As far as the settlement application and the amount there is concerned, it's upwards of 1380 crore rupees, to end this co-location matter at the doors of market regulator SEBI. Now, if, in a situation where SEBI accepts this settlement offer, then it will clear the only impediment which is left in the way, casting uncertainty on the timeline for NSE's IPO. Once, if the settlement application is indeed accepted by market regulator SEBI, in that case, post which SEBI will look to issue that NOC or no objection certificate to the National Stock Exchange in terms of allowing the exchange to file for its IPO DRHP. Simultaneously, the regulator will also move to withdraw its case, the legal case against the National Stock Exchange, which is pending before the Supreme Court. Now, this essentially, the acceptance of the settlement offer will set the ball rolling as far as the further process is concerned, remove the uncertainty impediment on the timeline for NSE's IPO. But of course, it's a process after which, only the approval and the launch will happen, and that might take anywhere between about 8 months to about a year. But it's a normal process which will begin after this, big hurdle gets cleared, and if it does get cleared.
They made the offer. Now it's up to SEBI whether they accept it or not. And once they do, the ball sets rolling for the NSE IPO. Meanwhile, just keep an eye on a couple of stocks. MCX up around 5.5%. Positive brokerage note that doing well for them. India Cements continues to do well. We have some traction on Vodafone Idea for second day running, and Jubilant Foodworks as well has spiked to the high point of trade. So let's get you some ideas for profit. We do have our colleagues from Money Control Pro joining in. Today we have Khushbu Rai Gupta with a stock that she's tracking. Khushbu.
In today's idea for profit, we have Hindustan Unilever. HUL is a market leader in the FMCG space with strong presence in home care, beauty and personal care categories. The company's volume growth trajectory was flat on the back of the negative mix. However, HUL is creating strategies to increase the organizational growth led by deep penetration and strong distribution network. The company will launch new products across core brands concurrent with the changing consumer needs. In this backdrop, HUL has increased investment in the beauty and well-being segment to speed portfolio transformation in the skincare category. The acquisition of The Minimalist, which is a premium brand operating in the high-growth beauty space, is part of the same execution plan. The growth via inorganic route in the deeply penetrated and high-growth portfolio segment will support sustained volume growth in the medium term. We also feel that the meaningful volume growth recovery is required for valuation re-rating backed by a revival in the urban demand.
HUL has the idea for profit. It will be very interesting to see where it goes from here. It looks like an FMCG day today. A bunch of them actually moving to the high point of trade. We have Britannia, Tata Consumer, all of them doing well. But what we'll do is take a short break. And as we do that, don't lose sight of India's business news leader, which is CNBC-TV18, just being a click away. That's on the phone. The instant app, the CNBC-TV18 app, gives you access to breaking news, in-depth articles, financial world updates, everything that we discuss here, all of them at your fingertips. You can download them from either the Apple Store or the Google Play Store, or just scan the QR code, which is up for you on the screen.
Welcome back. Markets continue to trade well in the green, but let's focus on a couple of big movers. Mahanagar Gas, that's trading with gains, following a solid note that's come in from Citi, who are quite bullish on the company's prospects. Sudarshan joins us to detail that note out for us. Sud.
So this Citi Gas company has been moving higher for the last few sessions, and today also it's trading with gains. But today Citi has come out with a note. It has opened positive catalyst watch on the stock. And as far as rating is concerned, it has a buy call and target is 1700 per share, implying an upside of almost 18% from current levels. So it has mentioned few positive catalysts. So first one is volume growth. It believes that the company is going to achieve 10% plus volume CAGR over next 2 to 3 years, and it can very much start from Q1 of FY26. Second one is margin tailwinds. In Q4 of FY25, company had reported margin of rupees 8.30 per SCM. Citi believes it can rise to rupees 9.50 to 10 going forward. Third is clean fuel mandates. It's saying that any positive developments from Maharashtra state government related to phasing out petrol and diesel vehicles and converting or transitioning to CNG will be positive for companies like MGL. And lastly, merger and acquisition. It says CGD sector consolidation is inevitable and it's going to be beneficiary for large players like MGL and also some of the companies like IGL. That's the reason you are seeing a positive uptick in the stock.
All right, take that point, Sudarshan. Thank you so much for that. That's about MGL up around 2%. Just keep an eye out and see it, though. The stock has moved higher. It's up around 3.5%. Remember, over the last couple of days, the decline in crude prices would further assuage any concerns with regards to raw material price inflation on a lot of these tire companies. We did see a big move on the rice companies yesterday on account of the truce. CEAT is something that we'll be watching out for. I remember a couple of weeks ago, we did have the management joining us and saying that, from the second quarter is where we will see margins improving for the company and the benefits of that would come by. Any sort of uncertainty that the street had with regards to increase in the raw material prices now stand assuaged with Brent at around $68 per barrel. So CEAT up around 3.5%. MCX, that's the other stock. We've been talking about it, up now 5% on the back of a bullish note coming in by UBS. Vamakshi, 7,000 rupees target price jumps to 10,000.
Well, absolutely, Mangalam. It's a big upgrade coming in from UBS on MCX, and they've outlined the reasons for the same. They're expecting very strong growth in the first quarter, especially in the average daily value, which is the ADV. In fact, in the first quarter so far, they highlight that the futures ADV saw a growth of almost 50% sequentially, driven by a sharp rise in bullion. Option premiums ADV is also quite healthy at 4,300 crores, an uptick of almost 30% sequentially, and therefore they're estimating the trading revenue to see a jump up of almost 34 to 35% quarter on quarter and a net profit uptick of almost 50% quarter on quarter. So that just shows you how massive, how robust the quarter one is expected to be. Now, they're also expecting the new product launches to support near-term to medium-term growth. Conservatively, the electricity derivatives, which they just launched very recently, is expected to contribute almost 3% of the revenue by FY28, and they do see further upside potential from this particular segment. They're also expecting good traction in the new silver options, given the preference for near to expiry contracts. Given all of these factors, they've gone ahead and revised their estimates. For FY26 to 28, they're expecting an earnings CAGR of 26% given a higher operating leverage, and they've gone ahead and revised their EPS estimates by 13 to 17%. They believe markets are not fully pricing in new products, growth potential and operating leverage benefiting from higher volume. So given that, MCX is up in trade.
Okay, all right. Thanks a lot for that, Vama. Well, India Mart, Intermesh, that's as well as seeing solid gains in today's trading session. Nuvama actually has done a U-turn. Earlier, they had downgraded the stock twice. Now, in fact, they have a buy rating on the stock. Vinny joins us to detail that note. Vinny, a complete U-turn, increasing the multiple, increasing the target price, changing the outlook as well. Tell us more.
Absolutely, a complete U-turn coming in there. The downgrade has come in somewhere in October 2023, and since then they were negative on the stock. Now, obviously, they have moved up and upgraded the stock to a buy rating, increased the target price from 2,100 rupees per share to 3,800 rupees per share. What are the factors they believe? That obviously, they believe the business is now entering a new demand cycle. Other than that, they believe management is on the right right path. They've been working towards, reducing that competition on the supplier front, and that is working out well for the company, is what Nuvama is highlighting. They believe all the headwinds for the company now are behind them. Now they could see a positive cycle coming in for the company, expecting subscriber addition to start showing up in Q2 FY26, Q3 FY26 and onwards as well. Overall, they believe that, the company will see a good growth going forward, and that is why increasing their earnings estimate for FY26 and FY27 by 9 and 10%, and also they're raising the target valuation multiple from 22 times to 35 times, driven by improving growth prospects. So positive outlook overall on the business, the demand trends improving over there for the company, and that is why they believe overall IndiaMart Intermesh could do well going forward.
Take that point, Vinny. Thank you so much for that. 6% higher on IndiaMart Intermesh on the Q-turn done by Nuvama. Take a short break, come back, and do more on the markets. A lot of stock-specific action. Stay with us.
Well, let's focus on Tata Motors then. Mr. Sailesh Chandra talks about the company's situation with rare earth magnets and also give us a sense about the outlook on the EV sales. Let's listen in.
As far as Tata Motors is concerned, I think we are good for the next few months. But beyond that, the stocks will run away definitely. We are quite hopeful with the intervention of the Ministry of Commerce. Also, SIAM and ACMA both are coordinating with the government bodies and There's a reach out to the ambassador in China also. So I think all these efforts, we are hoping that should yield results and we get some solution. And for mid to long term, we would definitely look for alternatives. But in short term, definitely this issue will be crucial and will have to be resolved. See, as from a demand perspective, with all the launch activities and all the, interest and excitement in the market is high. How the rare earth, will impact is too early to, comment, because as I said that there are ongoing discussions, and if it gets resolved, there should be no impact at all. Next, few months, as I already mentioned, that we have inventories to back us. And there is a hope that things will get resolved. So there is no change in outlook that we have considered at this stage.
All right, no change in outlook on account of the rare earth at this point in time. Good going for the EV industry, though it's very good going for the market right now. 25,200 holds on sustainably for the Nifty so far. HDFC Bank has moved to the high point of trade, so a fair weight on the index, and that's leading the Nifty Bank above that 56,600 mark as well. The other group of stocks that are doing well today belong to the FMCG pack. Britannia has moved to the top of the pops, up around 2%. We have Tata Consumer, which too has moved to the high point of trade. And ITC had a bit of a dip post-gaining. Thereafter, that dip has been bought into. That stocks moved to the high point of the trade as well. With that, we'll wrap up on this edition of Chartbusters. But you stay tuned. Trading Hour comes up next.
Hello, good morning. You're tuned into Trading Hour, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. With me is Hormaz Pataki as well. Hormaz, very good morning. We are in shades of blue, but market is not going through any midweek blues. You and me, Hormaz is looking like he's going through those blues. But look at it, Hormaz. We're seeing 25,200 on the Nifty again today. So it's an interesting day. 0.6% of gain. Broader market's doing well. Not outperforming, but doing well.
The green turned into blue yesterday. The bulls would be hoping that does not happen today. But of course, unlike the very, very sharp moves that we saw earlier in the day yesterday, and then that very sharp cool off, fairly steady so far in the first 120 minutes of the trading session so far, 160 points higher on the index. Of course, still well below yesterday's high. So it's still about that 25,200 mark. The broader market's doing fairly well for themselves, even in today's session, 0.5% higher on the mid-cap index. Similar sort of gains seen on the small caps as well. Now, plenty of individual movers in the broader markets, of course. So the small cap index, though, that's the bigger outperformer in comparison to the mid caps and even the benchmarks for that matter. 1.5% higher on the small caps. So look at the movers. MTNL is now up 17%. In today's session. It's the top gainer on the small cap index. In fact, Balaji Amines is the other one that has seen a very sharp spike in just a few minutes. 11%, almost 12% higher now on Balaji Amines. There you can see there 12.5% higher. Infibeam is up 9.5%. Kirloskar Brothers is up 9.5%. In fact, another mover, Barbecue Nation, 6.5% higher on that stock. That too has seen a very, very sharp surge in today's trading session. At the highest point of the day is Barbecue Nation, of course, well below its IPO price. But into some of the other specific stock movers in today's session, and one of them is IEX, and that is on the back of a Bernstein note, which has upgraded the stock. It's off the highs of the day, but Vivek is here to tell us more on what Bernstein has to say on IEX. Vivek, good morning.
Well, good morning. Very interesting note that came in yesterday from IEX, from Bernstein on IEX. Earlier, they had an underweight stance as far as IEX was concerned. They've upgraded it to a market weight rating. They have a target price of close to 160, still below the CMP. However, they've gone ahead and said what was their earlier stance and what is it that they believe about IEX now. Number one, they believe that volumes would be soft as renewables won't come to the market. However, that thesis has now changed. You're seeing a lot of renewable energy coming into the spot market as well. Along with that, they have mentioned the transaction charges at this point of time is unsustainable, given the fact that in India, spot market broking charges or transaction charges are quite high. They believe it continues to remain high, and on that particular parameter, they continue to hold on to their earlier theses. They believe that when it comes to market coupling, which is the single biggest risk as far as IEX is concerned, they see the odds at 50%. So again, they're not really taking a call on whether or not, that particular development, they're not taking a call on which way it would go, but they continue to see it as an important risk. They say that to upgrade it or to downgrade the stock from this point on, they believe that market coupling outcome would be the key trigger. So overall, they've changed their stance as far as renewable energy power coming onto the spot market, and this is the reason why they've upgraded the stock doing reasonably well in today's session.
Okay, Vivek, thank you so much for that. Surely keeping an eye out on IEX. But there are two other stocks that are in focus on the back of brokerage notes as well. That's Titan as well as Indian Hotels. Mangalam is joining in with us to give us more details on this one. Mangalam.
And they have an outperform rating. Their target price stands at around 4150 rupees. What they say is that their channel checks suggest that there has been healthy demand in the first quarter for jewelry business, and they believe that in FY25, the jewelry business margins were under pressure. It's bottomed out, and from here on, they are likely to see 20% growth in jewelry sales and operating profit in the first quarter, and that is likely to do well for them, which is a positive. And on the back of Titan, we have some other jewelry companies as well running up in today's trading session. The other one I'm looking at is Indian Hotels, where there is an initiating coverage coming in from JP Morgan. They've initiated at overweight, and their target price stands at 890 rupees. Remember, the stock has corrected about 12 to 15% from its 52-week high, and this, they believe, is temporary and likely to abate on account of, one, better than expected revenue per available room expectations or performance in FY26, and secondly, the consensus had cut EPS down because of military actions that took place in India post-Operation Sindoor, and now they believe this is likely to reverse as well. And the strong performance of Q1 FY26 on a low base is likely to bode well for them as well. Not just the very near term, they believe that the FY30 targets that the company had set for itself, are likely to be met ahead of schedule as well. So all these things make them positive on the stock. The stock higher today.
Doing fairly well for itself is Indian Hotels. Mangalam, thanks a lot for that. But the big story of the day, of course, is the biggest IPO of the year so far. That's the 12,500 crore rupee issue from HDB Financial Services, which has opened for subscription. Price band 700 to 740 a share. The IPO proceeds will be utilized for future capital requirements. Of course, it's a 2,500 crore rupee fresh issue and a 10,000 crore offer for sale. Earlier, we spoke to G. Ramesh, who is the managing director at HDB Financials, to understand the company's business and the future outlook. Listen in.
What we believe is that India is a huge opportunity for our business. And just to clarify to our viewers that we are a subsidiary of HDFC Bank, but we do not get any business from HDFC Bank. We are independently an entity. We don't get leads from HDFC Bank or any of the group companies. And that's been since inception. We run our own origination, our own risk management, our own collections, our own technology stack. We provide some BPO services to HDFC Bank and only to HDFC Bank. It's in the nature of collection services and some back office work that we do for the bank. That scale of that business really depends on the volume requirement of the bank. In the last few years, the bank has invested in digital capabilities, so some of the requirements have come down. While it's a significant part of our revenue, it's a very small part of our net revenues, which is our profit after tax. Given that our loan book itself is now 1,07,000 crores and generates significant revenues, it's a small portion of our net revenues in that sense. So not very material from a business perspective. Essentially, the draft rules came out about 8 months back, right? And the draft rules are really a document that's put out for discussion, which enables the industry to give its feedback. And the feedback has gone back to the regulator, and they're looking at the feedback. And as per the annual report, they're looking at the feedback. As I said, for us, the business is independent of the bank, right? And so very difficult to look at what might be the final circular at this point of time. The reason why we set up this business, independent business, is because we chase a set of customers which are fairly distinct from what the bank does, right? Or from what retail commercial banks in India do. For example, we have 19 million customers and 1,07,000 crore balance sheet, which means that our average ticket size is just about 1,65,000. We only do retail lending.
Well, it's been an hour since the IPO opened for subscription. Overall subscription so far, as I can see, is 9%, led mainly by the non-institutional and the retail investors. Non-institutional portion subscribed 13%, retail portion subscribed 10% so far. We'll keep you updated with the numbers as the day goes by. Of course, it's just the first day, so we'll keep track of HDB Financial, the biggest IPO of the year so far. Take a short break. On the other side, all things commodities with Manisha Gupta.
Welcome back to Trading Hour on CNBC-TV18. The markets are managing to hold on to the gains, but what's happening in the world of commodities and specifically crude? We have Manisha joining in with us to take us through all of that. Manisha, crude is seeing that sharp decline in the last couple of days, now easing of global tension. What are we watching out for here?
Oh, well, absolutely. If you look at the yesterday evening market sense, we did see prices decline by nearly 5%. And with that, we've seen the crude oil prices go down by 11% in the matter of this week. At this point in time in the Asian markets, as you can see, we are trading nearly 1.5% on the higher side. That is because the street is weighing on the durability of the ceasefire between Israel and Iran. There still are various statements being thrown from both sides. Apart from that, while U.S. did strike 3 of Iran's nuclear facilities, but the U.S. intelligence itself says that the damage hasn't been so severe, and perhaps the nuclear activities within these sites could start in the next few months itself. So that slight premium seems to be coming back into the markets. Apart from that, the US dollar has declined, and after such a sharp sell-off that we've seen in crude, there is some opportunity buying as well happening in case of prices. Most importantly, you have seen a decline in the US inventories to the tune of nearly 4.2 million barrels. The street was anticipating 1 million barrel of a decline. So you have a very strong number coming in. That in turn has been supportive as well. Markets are also looking at the IEA maintaining that they have 1.2 billion barrels in reserve when it comes to crude and can be deployed if needed. That is what seems to be capping the gains at this point in time. But remember, it's a weekend. There's more data coming in from US today on how you close weekend. Before that, you'll be looking at a lot of volatility in the evening session for the crude oil prices. But at this point in time, there are very less short sellers now emerging because we've seen prices decline so sharply already.
Indeed, some interesting developments for crude oil, finding some support at lower levels. Manisha, thanks a lot for that. All eyes, of course, now on the data coming out from the US and, of course, the OPEC meeting coming up next month as well. Let us now get you some insights from Mukesh Ambani. The Reliance Industries chairman spoke to McKinsey and discussed how clarity of goal and purpose, accompanied by the right people, can drive innovation, unlock extraordinary talent, and create impact. Now, he also spoke about the big bets that Reliance had taken, emphasizing that Jio was the biggest risk the company had taken so far. Reliance was investing their own money into the venture, even as analysts voiced concerns over India being ready for advanced digital technology. The worst-case scenario was that the company would not earn much return. Even at this time, the philosophy at Reliance was that it would be the best form of philanthropy for India, as they would have digitized and transformed the country. Mukesh Ambani also spoke of Reliance's plans in the domain of artificial intelligence, where the purpose is to solve complex problems and create wealth for the nation and for its people. He highlighted this has to be the reason behind Reliance not entering the high-risk GPU game and deciding to take the downstream route. Reliance is also making a big-ticket entry into green energy with one of the world's largest manufacturing ecosystems for clean energy, covering solar batteries, hydrogen, and more. And the Reliance Industries chairman terms this to be the company's contribution to saving the planet from the looming climate crisis. Speaking of the future, Mukesh Ambani said he remains confident that Reliance will continue to serve India and humanity well into the future, but also warns that the confidence of the next generation to succeed in developing landscape will be the key.
Okay, on that note, we're going to actually slip into a very short break. When we return, we'll discuss market technicals with Mitesh Thakkar and his top bets.
Welcome back. Continuing to remain around that 25,200 mark on the index, and one stock that you just saw at the bottom of your screen that's doing well for itself right from the onset is India Mart, and that is on the back of an upgrade that has come in from Nuvama. Vinny, it seems as if Nuvama is now turning a corner on India Mart, believing that India Mart is turning a corner.
Yes, absolutely. They believe India Mart is turning a corner, and that's why that upgrade, right? Because it reduced and downgraded the stock previously somewhere in 2023. Now, from a reduced rating, they have moved to a buy rating. So, upgrading the stock there, raised the target price. 3,800 rupees is the new target price. Previous was 2,100 rupees per share. Like Hormuz is also saying right now, the business they expect will take a turnaround. They expect new demand cycles starting for India Mart and Intermesh. They believe the management is now moving on a right path, and management had been taking actions over the last couple of years in terms of reducing that competition on the supplier front. Overall, in terms of headwinds for the company, that is bottoming out. And now, going forward, specifically Q2, FY26 and onwards, they expect subscriber growth to come in for the company as well. That addition over there will start improving furthermore from Q2, FY26 and onwards. So, on the back of this, they've increased their earnings estimate by 9% for FY26 and 10% for FY27. Other than that, they're raising their target valuation also. Previously, it was around 22 times. Now it's 35 times. All this mainly driven by the growth prospect of the company. So they're positive on the demand trends, positive on subscribers, the addition that will come in for the company. So overall positive on the stock. That's why the stock is buzzing in trade, holding on to gains of almost 5% in today's trading session. But shifting focus to an exclusive, now the deadline to submit bids for Jayaprakash Associates is under bankruptcy process. The bankruptcy process that has ended. Now sources are saying that at least 6 bids have been received. Let's go across to Ritu, who's picked up some details on this front. Ritu, what are you seeing here? What are we expecting now going forward here? Okay, I think we'll connect with Ritu in a bit, but this is an important story and Ritu had picked up details on this front as well. So yes, we'll connect with Ritu. But let's move on, and Mahanagar Gas for now. That's also the one that is trading with gains, and this is coming in following a bullish note from Citi. Sudarshan is here to tell us more details on this one. Sudarshan, good morning.
Good morning, Vinny. So Citi has a buy call on the stock and target price is 1700, implying an upside of almost 18% from current levels. And today Citi has opened a positive catalyst watch on the stock. So it has mentioned few catalysts for the stock. First one is volume growth. It believes that company is going to register 10% plus volume CAGR over next 2 to 3 years, and that can start very much from Q1 of FY26. Second, margin tailwind. In Q4 of FY25, company had reported margin of rupees 8.30 per SCM, which Citi believes can rise to rupees 9.50 to 10 going forward, and that can happen mainly because of the recent fall that we have seen in crude. Third is clean fuel mandates. It's saying that if there is any positive development from Maharashtra government regarding transitioning or phasing out petrol and diesel vehicles to CNG, that will be positive for MGL as well. And last one is merger and acquisitions. It believes that CGD sector consolidation is inevitable and it can be beneficiary for large players like MGL, and that's the reason you are seeing an uptick in the stock. Currently, it's up around 2%.
Positive catalyst watch from Citi there. Sudarshan, thanks a lot for that. Closing on 1450 levels is MGL. But the other one that has had another bullish note today coming in from UBS this time around is MCX. And it is the first time that the stock has received a 10,000 rupee price target. Vamakshi is here to tell us more on that. Vamakshi.
Well, Hormaz, UBS has maintained its buy rating on MCX, but have managed to raise their target price from 7,000 earlier to 10,000. And the rationale behind this is as follows. First up, they're expecting very good growth in Q1, especially in average daily value. Now, keep in mind that in Q1 so far, they report that the futures ADV saw growth of almost 50% sequentially, driven by a sharp rise in bullions. The option premiums ADV was also quite healthy at 4,300 crores, an uptick of almost 30% sequentially. And this in turn would lead to a likely growth in terms of trading revenue between 34 to 35% quarter on quarter, and an uptick in net profit of around 50% sequentially. Now, they also highlight the second factor, which is new product product launches. They believe that this will support the growth for the company in the near as well as the medium term. They believe that conservatively, the electricity derivatives, which they just launched very recently, could contribute around 3% to the revenues in FY28, but they do see some further upside potential out here. They're expecting good traction in new silver options, especially given the preference for near-to-expiry contracts. Given all of these factors, they've gone ahead and revised their estimates upwards. They're expecting a 26% earnings CAGR from FY26 to 28, and they've revised their EPS estimates by around 13 to 17% for FY27 as well as 28. Now, as far as valuation is concerned, the stock is trading at around 42 times FY27 EPS estimates, but they believe the market is not fully pricing in new product growth potential, operating leverage, and benefits from higher volume, and that is the reason why they've gone ahead and upped their target price to 10,000 per share.
Okay, Vamakshi, thank you so much for that. Stock holding on to gains of more than 6%. But like we were talking about before, let's put the spotlight on Jaiprakash Associates. And this is an exclusive where we're picking up that the deadline to submit the bids for Jaiprakash Associates under the bankruptcy process has ended. Sources tell that at least 6 bids have been received for this. Ritu is here now to give us those details. Ritu.
Well, yes, that's right. Top corporates have lined up to throw their hat in the ring for Jaiprakash Associates under the bankruptcy law. And our sources indicate at least 6 suitors have come forward to submit binding offers for the company with that deadline ending on Tuesday. Now, these include names like the Adani Group, Vedanta Group, Dalmia Bharat, the Naveen Jindal Group, as well as listed infrastructure company PNC Infratech. And interestingly, another JP Group company, JP Infratech, which of course is now controlled by Suraksha Group after having gone through the IBC process itself. Now, these bids are yet to be open, so we don't know the offers yet, but there is a meeting of the Committee of Creditors where the offers will be examined and then the negotiations will start. But some of the banks that we've been speaking to indicated that while typically it is the bidding process where the price discovery happens in IBC, but in this case, the National Asset Reconstruction Company or NARCL's offer of 12,000 crores to acquire Jaiprakash Associates stress loan from the banks earlier, that could serve as a benchmark for the prospective bidders. Now, we had earlier reported as many as 25 entities had shown an interest with an expression of interest for the company, but now, as we're reporting, only a handful have come forward. But that said, it is a key milestone in what has been a very long-running insolvency case. Remember, JP Associates was first identified by RBI in its second list of large defaulters back in 2017 and was finally admitted into the NCLT only last year. It is the flagship company of the group with interests across real estate, hospitality, cement, engineering, construction, and so on, and is facing claims of more than 57,000 crores from the lender. So now, all eyes on how the bidding war plays out, especially with these kind of high-profile names in the mix.
Another step in this resolution. Ritu, thanks a lot for that, in the resolution process at least. Well, Mitesh Thakkar now joins in for a quick chart check and some trading ideas as well. Mitesh, good morning. Thank you for joining in again. Well, 25,300, we couldn't sustain those levels, but we are fairly okay as of now. What would be your trade, not just for today, but over today and tomorrow, considering its monthly expiry tomorrow? Do you carry positions over into the next series, or do you wait for expiry to happen somewhere around 25, 150, 250? What's your call on the index and your stock ideas as well?
So, good morning. I would definitely want to carry my positions. I think, on the stock side, there's no worry. On the index, we haven't been trading much, taking some small quantities. Though the Nifty structure is positive, 2-hour closing about 25,250 might be, something which will give you confidence for taking some long positions. And then we can look at a continuation on the upside to about 25,450, 500 zones at least, and then maybe higher. So the structure is good, but for timing, trading with more of stock buys.
What about stocks, Mitesh?
I have a buy on Indian hotels. I think, after a good correction and consolidation, the stock is trying to break out. So buy here with the stop just below levels of 770 for targets of 805. And Udco is the other one, which is also seeing some positive crossovers on the intraday and the daily charts. So buy here with the stop at about 232 for targets of 245.
Okay, keeping an eye out on those two stocks as well. Mitesh, thank you so much for joining in with us as always and giving us your views on the market as well as individual stocks. But on that note, we're going to slip into a very short break, and up next we'll come back and discuss market fundamentals now with Sahil Shah from Aquarius Asset Management.
Welcome back. Taking the conversation on the markets forward now with Sahil Shah, who is the CIO at Equirus Asset Management, who is joining in. Sahil, good morning. Thank you for joining in. Before we get to your top holdings, and there are some interesting names there, we would like to talk about those in greater detail. We are on the cusp of earnings season starting up. I'd like to talk firstly about the consumption bit, right? There has been conflicting reports or contradictory reports, if you could call it that. There's one brokerage citing almost a $40 billion consumption boom over the next 2 years, but the macro data on ground seems to suggest otherwise. Where in the consumption basket are you placed, be it discretionary or staples? I see your discretionary is one of your largest holdings. Where within the consumer discretionary space are you bullish on?
So good morning and thank you for having me here. So we are very much positioned on the discretionary side on the consumption side, and more importantly, we believe that a lot of companies which have done consistently well on the consumption side, they are trading at high valuations. So what we are more positive on is on the turnarounds in the consumption space, as well as some of the names on the jewelry side, where we believe that the formalization of on the jewelry side is going to continue over a longer period of time. Maybe there is a 6 months to 1 year of subdued growth that might turn up. But from a 3 to 5 year perspective, I think jewelry and some of the consumer discretionary names where we see a lot of margin upside potential should do well. And that is where we are finding a lot of value.
Hi, Sahil, right. So you're finding value coming in on the jewelry side is what you're talking about. And I see in your holdings also you do have Thangamalai jewelry, but are there any other options that you would look at? What is the strategy here in terms of overall? Other than jewelry, are there anything like hotels or luxury side? That is something that you would watch out for, given that's also a discretionary bet.
Yes. So, I mean, we are not, we don't have anything on the hotels or on the other names that you mentioned. More importantly, a lot of our weight is also inclined towards consumer discretionary side, where we are seeing significant margin expansion in some of the names, whether it is some bedding company or some of the consumer durable names. So we believe that the top line growth, X of jewelry and X of certain segments within the consumer discretionary space will continue to be around 10 to 13% odd. But what will really drive the earnings growth will be the margin recovery in some of the names that we have identified.
Interestingly, Sahil, Thangamayil in your holdings were in a field where you have names like Titan, Kalyan Jewelers, Senco, and a lot of others. What drives your conviction on a name like Thangamayil? Is it just because of the smaller size and it has the scope to grow larger? What is your rationale on this?
So I think Thangamayil has been present in very micro markets, and now they are going into a very large market, which is the Chennai region, which itself is a very, very big market compared to the size of the company that it is. And as the company is able to successfully expand into those markets and they go into more southern markets, I believe that there is a lot of scope of growth, at least in the southern market itself, where Thangamayil Jewelry is a good brand name. So that's right. What is driving our conviction on Thangamayil Jewelers.
Sure. Sahil, I just want to understand your thought. Overall, now in the markets going forward, do you believe the broader end of the markets, right, the small cap or the mid cap will see a better performance versus large cap, even in terms of earnings that you're watching out for? Because last 6 months, I think small cap is down 1%, while mid cap is up 2% and Nifty is up 6%. This is the 6 month that I'm looking at. So you are expecting outperformance now from the broader end of the market.
Yeah, so I think, so what has happened is that post-COVID, the earnings growth of small and mid caps has been far superior as compared to the large caps. And that also drove the performance of the small and mid caps from post-COVID levels to almost in 2024. Now in FY25, what happened was that there was a convergence in the earnings growth of large caps as well as small and mid caps. And both grew by in the mid-single digits. Now, as far as small cap is concerned, people typically don't invest in small cap for a mid-single digit kind of growth. And hence, the small cap performance in FY25 suffered. Going forward, what we are expecting is that small caps will start outperforming the large caps, as it has happened post-COVID, and if you look at even longer-term history of 10, 15 years, small and mid-cap earnings typically outperform large caps by a good margin. And I think that thing will resume in the next 2 years. And as that happens, I think small cap outperformance should again come back.
There are a couple of other names in your list, Sahil. Kolte Patil is one of them. It's just undergoing a takeover process right now. IFB is the other one, two completely different. Now, a lot of analysts, experts believe that real estate is currently in the midpoint of its upcycle. Do you believe that Kolte Patil also, does that carry the same rationale as Thangamile does? Because Kolte Patil too is present in a lot of micro markets and is moving into larger ones now. And what about IFB? Because a lot of these durable manufacturers have spoken of challenges on ground currently, especially because how the summer turned out to be, which is their peak season. Tell us your rationale for these two.
So as far as real estate cycle is concerned, there are pockets, there are regions where if we speak to the management, they themselves are saying that 60-70% of the buying that is happening is not because of the own consumption, but it is more driven by investments. And whenever that has happened, we have seen that there are real estate bubbles that have been created. Now, this is more region specific, and this is not happening across India. Where the stock specifically you mentioned is present into is more into Pune markets, and now increasingly getting into the MMR region, which is the Mumbai region. So that is the reason why we are quite comfortable, and with the new private equity entering in, more aggression is what we are expecting in terms of pre-sales growth, which was lacking for this company over the last 2 to 3 years. Now coming,
Yeah, please go on.
Now coming to the other consumer durable name that you mentioned, as I mentioned that in some of the consumer durable or consumer discretionary names, we are expecting a good amount of margin recovery to happen. The companies have demonstrated some bit of margin recovery in the last 1 year, but a large part of margin recovery, if it happens over the next 2 years, then there is a good valuation re-rating potential that these stocks can have.
Okay, Sahil, thank you so much, for joining in with us on the show and giving us your time, helping us understand the outlook for the markets as well as the sectors and stocks that you're looking at. But on that note, we're actually going to slip into a very short break. But remember to tune into all new CNBC TV18 Prime, bringing you insights from policy makers, business leaders and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m. Welcome back to Trading Hour on CNBC-TV18. Now let's shift focus and put the spotlight on Tata Motors, as Tata Motors tells CNBC-TV18 that they are preparing alternates for exports amidst the volatile geopolitical situation. My colleague Parikshit caught up with Executive Director of the company, Girish Wagh, and began by asking about the much-anticipated demerger. Listen in to excerpts from that conversation.
Entire demerger process is going as per the announced timeline. We've had received the shareholder approval also. Now we are looking forward to NCLT approval. And I think during this calendar year, we should have the demerger happening and both the companies listing separately.
Okay. Now, in terms of how this is going to help the passenger vehicle business, which will be housing both Tata Motors and JLR, and the commercial vehicle business, which will be a separate entity, different brokerages and analysts have said that this will simplify the structure but will not lead to any material unlocking of value. How would you address those concerns?
So I think the value generation is finally going to be basis how do both the businesses deliver their strategy, right? And to speak about the commercial vehicles, we have in the recently concluded Investor Day laid out our strategy for the next 5 years, the aspiration to grow, and what are the various avenues that we are looking at, not just to grow the revenue, but also how do we achieve resilient financial margins as we go ahead, deliver strong return on capital employed, as also robust free cash flows. So I think once we start delivering these kind of results on a year-on-year basis, quarter-on-quarter basis, that is something that should lead to value creation.
Right. What would be your outlook for growth in this quarter and also for the full year FY26 right now?
So FY26, I'm still looking at a single-digit growth happening across the segments. And within that, I'm more bullish on the buses and vans, followed by the heavy commercial vehicles. So I think these are the two segments where we should see higher growth. But at an overall commercial vehicle industry level, we should see single-digit growth. And this is despite having a shift happening towards higher tonnage vehicles.
Could you also give us a sense of your offtake in terms of the EV business?
The EV business, let me go segment by segment. I think in buses, we have been operating now more than 3,600 buses across 10 cities. Cumulatively, they have covered more than 31 crore kilometers. So we have a lot of experience under our belt now. And while doing so, we have, I think, fine-tuned our model for managing these buses. We achieved an EBITDA break-even during the last year. I think we are going to further improve the financials during the current year. And we also have been discussing with the government agencies on two aspects. One is the payment security mechanism. And second is migrating towards an asset-light model because we can't afford to have these many buses on our balance sheet. I think all these things seem to be falling in place, and therefore we should be up for the next tenders which may be coming up.
Right.
This is about buses. In small commercial vehicles, I think unfortunately the FAME incentive which was available for the last mile mobility was removed during the last year. But despite that, I think we continue to sell a good number of vehicles. And just recently, that is yesterday, we have launched a new small commercial vehicle, Ace Pro, which is going to be the most affordable four-wheeler, both in ICE as well as EV format. And that's something that should give us additional volumes in the last mile mobility. In addition to that, in bigger trucks, we are discussing with specific set of customers in cement, steel, and port kind of end-use applications to deploy specific heavy trucks for their restricted kind of an application. So that's the progress which is happening on electrification.
Finally, sir, the geopolitical tensions that we are seeing constantly, issues related to rare earth magnets and supply chains, domestic pressures as well, how is that going to impact pricing and production in the months to come?
So, 20% of our international business or export actually goes through that channel. So that's something that we are keeping a track of and also then creating alternate routes by which we can reach our vehicles to Middle East. But I think as of now, we are keeping a track of this and be prepared with action plans.
Interesting conversation there with the management of Tata Motors. Take a short break. Just as we do that, some good news for our viewers. India's business news leader is now just a click away, and that is CNBC TV18's all-new app, where you get breaking news, in-depth articles and financial world updates right at your fingertips. You can download the app from the Apple Store or the Google Play Store, or even scan the QR code that comes up on your screens to download the app. Take a short break. Back in just a bit.
Welcome back to Trading Hour on CNBC TV18. But let's shift focus and talk about a couple of names that are in focus on the back of order wins. KC International and L&T Tech. Upasana is joining in with us to give us details on this front. Good morning, Upasana.
Good morning. First up, let me start with KC International. The company continues to get slew of orders. Now, this time, company has bagged new orders worth 1,236 crores for civil projects in India. And the company says that it is the largest order that the company has received in building and factory segment. Mind you, earlier this month, company secured new orders worth 2,211 crore in its T&D segment. And with all of this, company's YTD order intake has surpassed 5,500 crore with a growth uptick of nearly about 35% on a year-on-year basis. Now, next up is LTTS. The company is selected as an exclusive global engineering partner for enterprise data and digital services for a global energy major. This is a 5-year agreement valued at more than $50 million is what the company has indicated. So all in all, these two stocks remain in focus on the back of the order wins.
All right, Upasana, thank you so much for those details. By the way, one of the other names also that earlier won an order in the day was Surya Roshni. That too is trading with healthy gains after the order win that it had won just before market open. So it's off the highs of the day, still 4% higher is Surya Roshni. By the way, the other active buzzers is Sammaan Capital is one of them, 15% higher now on the stock, among the top gainers in the broader markets today. And the other one is Solara Active, and that has seen a very strong up move in the last few minutes, just like Sammaan Capital. Over the last 1 hour, that stock has moved to the highest point of the day. And take a look at Solara as well, just after 11 o'clock, now 13% higher on that stock as well. You take your leave on this edition of Trading Hour. We leave you with the Nifty just at 25,200, 600 points higher on the Sensex as well. From Vinny, myself and the team that put this show together, thank you so much for watching. Halftime report on the other side.
Stocks climb on a halt in hostilities in the West Asia. IT, consumer durables perk up, industrials and utilities sulk.
Tata Motors tells CNBC-TV18 there is no production cut expected over rare earth magnets in the next few months. But 20% of its CV sales go via the Strait of Hormuz, and they are working on alternative plans.
HDB Financial's 12,500 crore rupee IPO opens for subscription after receiving a strong response from anchor investors. The management tells CNBC-TV18 discussions with the RBI on overlap of business which HDFC Bank are still on, even as its operations are completely independent.
Reliance Group Chairman Mukesh Ambani, in an interview to McKinsey, says he expects Reliance to live on long after him by focusing on future businesses and reinventing itself to deliver societal impact. He says the big challenge will be the confidence of next gen to succeed in the new landscape.
The biggest risk we took was Jio, says the Reliance Group Chairman Mukesh Ambani, adding that the worst case was Jio will fail, but it was own funds being invested. So even if it did, digitizing India would have been the biggest philanthropy for Reliance. Watching us here on Halftime Report from CNBC-TV18, the Motilal Oswal studio. This is the launch of the Axiom Mission 4 to the International Space Station. Happening as we speak, you can see that on your screen. This includes India's Shubhanshu Shukla, who will be the pilot of the spacecraft. This mission, remember, involves private space firm Axiom Space and Elon Musk's SpaceX. The 4-member crew will travel aboard a new SpaceX Dragon spacecraft, docking the International Space Station. The docking is expected at around 7 a.m. on Thursday. So there's the countdown. It's 8, 7, 6,
5, 4, 3, 2, 1. Ignition and liftoff.
For 3 nations, a new chapter in space takes flight. Godspeed, AX4.
Wonderful visuals, them. Successful liftoff so far, 30 seconds post liftoff. We do have Shubhanshu Shukla, Indian pilot of the spacecraft. It will be reaching or docking with the International Space Station in the next couple of days, 7 a.m. on Thursday. These are the parents of Shubhanshu Shukla. A fair amount of pride, I think some sort of, a lot of happiness, and also the worry of their son being in space. They will be praying for the success of the mission and obviously the well-being of everyone on that itself. Moment of pride for the parents, as the son brings a lot of joy, not only to the work that he does, but also to the entire space community and, more importantly, the nation.
Well, that was very interesting, very inspiring visuals, and we hope, whatever it is that they've set sail towards, they accomplished the mission quite successfully. But moving on, the 12,500 crore IPO of HDB Financial Services, the largest of the year so far, has opened for subscription today. The price band is set between 700 to 740 rupees a share. IPO proceeds will be utilized for future capital requirements. Earlier today, we spoke to G. Ramesh, Managing Director at HDB Financial Services, to understand the company's business and future outlook. Let's listen in.
What we believe is that India is a huge opportunity for our business. And just to clarify to our viewers that we are a subsidiary of HDFC Bank, but we do not get any business from HDFC Bank. We are independently an entity. We don't get leads from HDFC Bank or any of the group companies. And that's been since inception. We run our own origination, our own risk management, our own collections, our own technology stack. We provide some BPO services to HDFC Bank and only to HDFC Bank. It's in the nature of collection services and some back office work that we do for the bank. That scale of that business really depends on the volume requirement of the bank. In the last few years, the bank has invested in digital capabilities, so some of the requirements have come down. While it's a significant part of our revenue, it's a very small part of our net revenues, which is a profit after tax. Given that our loan book itself is now 1,07,000 crores and generates significant revenues, it's a small portion of our net revenues in that sense. So not very material from a business perspective. Essentially, the draft rules came out about 8 months back, right? And the draft rules are really a document that's put out for discussion, which enables the industry to give its feedback. And the feedback has gone back to the regulator, and they're looking at the feedback. And as per the annual report, they're looking at the feedback. As I said, for us, the business is independent of the bank, right? And so very difficult to look at what might be the final circular at this point of time. The reason why we set up this business, independent business, is because we chase a set of customers which are fairly distinct from what the bank does, right? Or from what retail commercial banks in India do. For example, we have 19 million customers and 1,07,000 crore balance sheet, which means that our average ticket size is just about 1,65,000. We only do retail lending.
Well, that's then a very important IPO, very large IPO coming in from the HDFC Bank stable. But moving on, this is a special segment, Value Plus. Mangalam, you've been looking at the Timex Group, some important developments overnight, a large OFS, a large supply and offering. What do you make of it?
Well, it's a very interesting deal that has happened. One which has happened earlier as well, where the foreign promoter looks at the Indian company and tries to offload some stake out there. But, this is beyond that. We're just trying to look at what the business does and, more importantly, how it's valued as well, and who the buyers in that could be and what they get out of buying this as well. So for starters, the news is Timex Group Luxury Watches BV, which is the promoter, holds about 75% stake in the company, wishes to sell 15% via an offer for sale, and the floor price is 175 rupees. Now, you would see the stock lower by 5% today. Remember, the previous closing price was 264 rupees, so the floor price is actually nearly a 35% discount to the previous floor price or previous close price itself. What does the company do? The Timex Group, on the whole, is America's oldest watchmaker. They design, manufacture and distribute watches and jewelry for brands. Not only do they have their own brand, but they also have manufacturing operations for brands like Versace, Guess, Furla, UCB, Ferragamo. So a lot of these designer brands outsource their watch manufacturing to Timex. They have multiple sales touchpoints in India. If you look at their India business itself, from FY22, ignoring FY21 because there was the COVID impact, there has been a steady rise in the sales. And EBITDA in FY22 was obviously impacted by COVID, but thereafter it has been in high single digits for most part of the last 3 years. The only problem with the business, along with everything else, is the inventory days. Because if you look at it, FY22, the inventory days were 130, and that has inched all the way up to 180. That's nearly 6 months of inventory lying on your books, and that has an impact on their operating cash flow, etc. as well. Where does 538 crore in revenue stand when you look at all the other companies? You have Titan, obviously head and shoulders above everyone else, 4,500 crores. This is their watch business, and an EBIT of 553 crores. HMT, it's a PSU, which is a very slow-moving company and a lot of legacy costs. So they make an EBIT loss of almost 111 crores on meager sales of 163 crores. So take that out. Ethos, again, not an apples-to-apples comparison because Ethos is a watch retailer and not a watch manufacturer or a watch owner. So we have them doing about 1,250 crores in sales versus 130 crores in EBIT. If you look at, Titan as a direct comparable, analysts value Titan anywhere between 25 to 30 times EV to EBITDA, valued between 15,000 to 18,000 crores. Timex watch at the floor price is actually valued at 25 times FY27 expected EBITDA, which implies that it is pretty much at par or maybe at the lower end of where Titan's valuation is, and understandably so. What are the triggers that you'll be looking at from here? One, because it's an OEM business, increased order from brands, their inventory management. I will personally be watching out for how they manage their inventory. Secondly, they are focusing on increased share of revenue coming in from e-commerce. And last year, they acquired Just Watches, which is an offline retailer. So them, supporting offline retail and growing their sales from here on is something I'll be watching out for as well. But Timex is a has-been sort of brand. What are the risks? Disruption in import of key raw material, because a lot of their raw materials are imported. Secondly, increased penetration of smartwatches, for which they don't have much answers. Thirdly, they have a high reliance on Flipkart for OEM business. So any change out there could impact their overall business. And finally, it's an MNC owned by a foreign parent. Any royalty imposition coming in from the parent could be a bit of a risk as well. So those are a couple of things we'll be watching out for. Timex at floor price, priced in line with what the other watchmakers are, but they do have their fair share of risks and opportunities.
Well, thank you so much, Mangalam, for telling us exactly, what are the key risks, the key perspectives as far as this particular OFS is concerned. Doesn't this also indicate, a growing trend where you're actually seeing MNC promoters go ahead and sparing stake in the Indian companies, and in most cases, the Indian subsidiaries or the Indian entities are trading at much higher valuations. Right?
That's absolutely true, and we've seen that with Whirlpool. We've seen that with a lot of the other companies as well, which are looking, in fact, not only selling their stake in Indian companies, but a lot of times exiting the India business on the whole as well. So let's see where this goes. But from a Timex standpoint, I'll be very interested to see how the business itself does. But speaking about Timex, don't lose sight of Titan. Titan's actually moved to the high point of trade. A large part of that can be attributed to the positive note that has come in from Macquarie this morning. So Titan up around 3%. And on the heels of Titan, we have some gains on the back of that coming in for Kalyan Jewellers as well, because Macquarie's thesis is that the first quarter demand has been fairly good. Timex is lower, pull up Titan and pull up Kalyan Jewellers, both of them doing extremely well. Kalyan Jewellers is up around 4% as we speak at the high point of trade. So jewelry business doing well. But let's get you some interesting insights from Mukesh Ambani, the Reliance Industries chairman, who spoke to McKinsey and discussed how clarity of goal and purpose accompanied by the right people can drive innovation, unlock extraordinary talent and create impact. He also spoke about the big bets that Reliance had taken, emphasizing that Jio was the biggest risk that the company had taken so far. Reliance was investing their own money into the venture, even as analysts voiced concerns over India being even ready for advanced digital technology. The worst case scenario for them was that the company would not earn much return. Even at this time, the philosophy at Reliance was that it would be the best form of philanthropy for India, as they would have digitized and transformed the country. Mukesh Ambani also spoke of Reliance's plans in the domain of artificial intelligence, where the purpose again is to solve complex problems and create wealth for the nation and its people. He highlighted that this has to be the reason behind Reliance not entering the ultra-high risk GPU game and deciding to take the downstream route. Reliance is also making a big ticket entry into green energy with one of the world's largest manufacturing ecosystems for clean energy, which covers solar batteries, hydrogen and much more. Also, the Reliance Industry chairperson says that this will be the company's contribution to saving the planet from the looming climate crisis. Speaking of the future, Mukesh Ambani said he remains confident that Reliance will continue to serve India and humanity well into the future, but also warns that the confidence of the next generation to succeed in a developing landscape will be key.
Welcome back to HTR. Well, there's a bit of a correction from the higher levels, especially if you look at some of the capital goods names. They're seeing a bit of corrections. Names like ABB India, Cummins, all of them now trading near the day's lowest points. But we'll now shift focus to the financial space. In a recent note, JM Financial says investors are worried about muted loan growth in the sector. They also expect largely flat net interest margins in H2 of FY26. We are now joined by Ajit Kumar, lead research analyst, BFSI at JM Financial Institutional Securities. Thank you so much, Ajit, for joining us. First up, give us the main feedback that you've received from investors. Despite so much of liquidity injections that the sector has received, you're saying that investors believe that they don't expect too much of credit growth as far as FY26 is concerned. Why is that?
Yeah. So thank you for having me. So yes, we met around 25 foreign investors in Singapore and Hong Kong last week on India financials. Their feedback was mix of caution on current state of affairs with hope of recovery in second half of FY26 or FY27. Three feedback which I wanted to highlight here. One, obviously, as you highlighted, investors were worried about muted loan growth in sector. So between end of March 2025 to end of May 25, so for the first 2 months of this financial year, credit outstanding for banks is broadly flat versus, let's say, 2.1% growth same period last year. Now, the series of steps taken by the RBI in last 6 months, like repo cut, CRR cut, easing of various, guidelines on gold loan, project finance, LCR regulation versus draft regulations, and deferment of ECL guideline were very well received. This should lead to improvement in credit growth in second half of FY26. Having said that, still investor credit growth expectation for FY26 was more like 11% YOY right now, lower than, let's say, 12 to 13% YOY expectation in March 25. So there is a decline in the expectation. While we believe that there is going to be pickup in, let's say, credit growth in the second half, but there is a decline in the expectation, let's say, compared to 2 months back. So the reason for this, I think, material improvement in credit growth in FY26 is unlikely until unless, income level of the larger population improves, which leads to a real increase in demand. So that's the main reason why we believe that, credit growth for the full year should not be more than, let's say, 10.5 to 11% on a YOY basis.
All right, we take that point. I look at some of your top picks and you are positive on SBI, BOB and Axis Bank. I'm a little curious about Axis Bank because there are a lot of people who, met with analysts, etc., met with the companies, etc., and said that maybe for Axis Bank, the growth looks a little muted in the first quarter. Yeah. Despite that, your positivity, if you could explain?
Yeah, you're absolutely right. So, I mean, the loan growth for Axis Bank is relatively lower as compared to some of the other large banks. But having said that, when there is a decline at the sectoral loan growth itself, the other large banks will also see, decline in the loan growth, whether it is ICICI Bank, whether it is, let's say, Kotak Mahindra Bank. In most of the places, we will see, growth decline in this year, financial year versus last year. There is going to be a broad-based slowdown in loan growth for the NBFCs as well. In that scenario, when we compare Axis with somebody else, let's say like for example, ICICI, Kotak and SBI, there is a value differential, right? And when the delta between, let's say, loan growth of Axis versus others comes down, valuation-wise, Axis look much better as compared to some of the other large banks.
Okay. Ajit, one key point that you mentioned and something that the street is tracking very closely is the net interest margin.
Yeah.
For banks, it's expected to moderate in H1. You're saying it's expected to remain flat in H2. Why? And number two, a lot of optimism is built around the NBFC pack, especially given the kind of rate cuts that we've seen. You don't seem to be so optimistic. Why?
Yeah. No, so we have made peace with the fact that for banks, margin is going to decline in first half and that largely be flat as the positive impact of CRR cut, flow through in second half. So CRR cut is getting applicable from September onwards, which is going to give, positive impact on the margin side. However, for some of the NBFCs and mid-sized bank with higher share of floating, higher share of fixed rate book, the general expectation is margin is going to expand in this year versus, let's say, FY25. But our sense is this is not going to be happening in this rate cut cycle. The reason for this is we are getting into this rate cut cycle when there is a elevated pressure, elevated asset quality pressure in the unsecured loan. Now all the mid-sized banks and NBFCs want to get into secured segment all at the same time. So everybody wants to do affordable housing, everybody wants to do vehicle financing. So there is a shift in loan mix which is happening from unsecured loan to secured loan. and that is leading to pressure on the margin side. And there is a elevated pricing pressure in the secured loan as well. And that is why we believe that FY26 margin for most of these names should either be flat or, let's say, in a best case scenario, only marginally higher, maybe let's say 10 to 15 basis point higher versus FY25 against, let's say, 100 basis point of rate cut for rate cut that we have seen. Even the management commentary suggests, in a similar line, like for example, Bajaj Finance, right? In their investor presentation, they have said that cost of fund will go down, but my margin is going to remain flat, on a YOY basis. That basically means that yield is under pressure. We cover roughly 30 to 35 names here, and more than, let's say, 25 to 30 names have reported decline in yield in fourth quarterly result. So even before we could have seen, benefit on the cost of funding side, yield is under pressure. There is no pricing, power for the lenders, when the sector loan growth is muted.
That really, points to the problem that we're looking at here, Ajit. We're not as worried about margins because that will take care of itself if the loan growth does come by. You spoke about higher competition. You spoke about, similar profiles of people who everyone is now chasing that has a pressure on the yields, etc.
Yeah.
So whether growth comes by or not is the big macro challenge right now. But the important point here, you said you covered about 30, 35 names in the space. I don't know whether it's conspicuous by its absence or you don't, cover this name. There's IndusInd Bank. And the reason why I ask you very specifically is about 7 days ago, there was a large, foreign brokerage that changed its view on the stock. And this was the first after that entire debacle that we saw on IndusInd Bank. So are you tempted to bite the bait here with a stock which is 50% lower? So if things remain the same for everyone, how much of that is in the price, etc.? Would you have a view here?
Yeah. So on IndusInd Bank, we have a hold rating. The reason for this is, I don't want to look at, IndusInd Bank fundamentally till the time, all the mess is cleared, right? So, after every, let's say, 1 week or 2 weeks, there is one news or some other news which is coming out. So till the time, all those mess is, completely cleared, till the time I don't have confidence on the, this softer aspect, we don't want to look at, IndusInd Bank at this particular point of time, from fundamental perspective.
Just as an academic exercise, have you done, the worst case scenario analysis, bear case, what would the stock be priced at, and basis which, where is it right now?
So see, fundamentally speaking, even in best case scenario for IndusInd Bank, ROE trajectory should not be more than, let's say, 7-8% going into, let's say, FY26 and FY27 as well. I don't think IndusInd Bank will be able to cross, double-digit ROE by FY27 as well. Given where the valuations are, things looks completely, priced in. But having said that, as I said, the moment, I have greater confidence on some of the softer issues, we will obviously, have a relook at the name.
Well, thank you so much for joining us. It was a very good conversation and also moderates some of the optimistic expectations that the street has built in. But it's now time for a quick break. Pritesh Mehta from Yes Securities will join in with some trading strategies on the other side. Stay tuned.
Welcome back. Let's look at the market. For the last couple of trading sessions, the Nifty has been selling off from the highs. Today, the good part is it's holding around the 25,200 mark. Whether it goes up from here or not is the big question. The answer to that will be where the Nifty Bank goes, because right now, the Nifty Bank, which is off high, significantly off highs right now, sitting with a gain of just about 100 odd points. So we'll watch out for that, but no complaints from all the other sectoral gainers as well. We have, for the first time in the last many days, diverse sectors moving. We have Nifty IT on the one hand, we have FMCG on the other hand, we also have infra and auto, all of them fairly in the green. And the broader markets, they're doing actually a shade better, at least in the market breadth and the small cap indices. The small cap index is up around 1.5%. If you look at the market breadth as well, fairly solid, 2,000 stocks advancing for about 600 stocks, which are declining. And as the market digests the truce for the next day, we have India VIX, which is now moving towards that 13 mark. So ahead of expiry, that is, good news from the stability of the market. However, where the market goes from here on is dependent on whether it holds on above that 25,200 mark or not. Why is that? Because the initial bout of short covering by call writers has taken place already. You can see the 25,100 call writers covering their positions. You can see the 25,000 call writers covering their positions as well. But now, at lower levels, we have the 25,200 put writers, which are fairly active, and we have the 25,150 put writers also equally active, telling you that the support for the market is closer to 25,100 to around 25,075 itself. On the way up, 25,200 call writers are still active. So if the Nifty holds above 25,200, these call writers, all 1.5 crore of them, will have to cover their positions. The key is for the market to hold at these levels. And more importantly, if you're looking at a bigger level, then yesterday's high of 25,318 is important to cross for further short covering on the Nifty. In terms of stocks, I'm watching out for a couple of them. Yesterday, we had pointed out the possibility of Titagarh re-entering FNO ban. Chances are that it may exit FNO ban. And RBL Bank and MCX are the two candidates which might enter FNO ban one day ahead of expiry. Vivek.
Well, thank you so much, Mangalam. So your call is MCX and RBL Bank. These are the ones that are likely to enter the FNO ban today. Well, Pritesh Mehta from Yes Securities now joins in on the show for a quick technical check on the market. Thank you so much for joining us, Pritesh. What are you making of the Nifty as well as the Bank Nifty at current levels? It appears as though markets are struggling to sustain at higher levels.
Good afternoon. So see, yesterday also we had a steady start. At one point of a time, Nifty was up by almost by 300 points, but it closed by just 70 odd points. It shows the market is lacking strength at the top. It's lacking that directional strength and momentum also. But despite that, despite the external news flow, broader markets are outperforming. They are doing well. So even today and yesterday's session, broader markets have been doing well. So in a scenario where the index is not moving much, not doing much, but broader markets are standing on their own, it shows that rather focus on the index, we should be focusing more on the broader markets. They are outperforming. Whether you look at the Nifty 500, whether you look at Nifty mid cap or Nifty small cap, these are the space we need to focus on. I think Nifty, on the broader sense, it could continue to be range bound, but broader market space to watch out for.
All right, we take that point. And what individual stocks are you backing right now, Pritesh?
So yes, see, we have our customized customized capital market index, and it has been improving since the May end. And we can see several stocks are popping up in our buy list. One of them is CAMS. Now, CAMS is we have seen a break of a 45-degree trend line on our Pontifical chart, and now witnessing follow-through moves. So we are expecting a big run-up in this stock. We are talking about 20% rally from here on. So buy for a target of 5,200. The risk management level would be around 3.00 levels. And the second stock is FSN, First Source Solution. Now, IT index for 2025 has been a big laggard. But what we are seeing is that mid-cap IT has been doing well. Even the structure of our customers' mid-cap IT index is improving. So within this space, FSL stands out. We have seen a bullish total breakout coming in this stock, and we are witnessing follow-through moves. So buy for a target of 450. The stop loss would be around 380.
Thank you so much, Pritesh, for joining us, giving us a view on the market as well as the individual stock call. Well, it's now time for a quick break. On the other side, Manisha Gupta joins in with Devendra Sharma of Agri Economist. Stay tuned.
Welcome back, and joining us on the show now is agri-economist Mr. Devinder Sharma. Mr. Sharma, hi, thank you so much for joining in. First, your sense on the kind of Kharif numbers that we seem to be getting. 10% sowing more than last year. Of course, there's a disparity on what is getting more sown. We've clearly seen some decline in soybean, some decline in tur as well. This is where we did not get MSP for many of those farmers. But what is your overall sense?
Well, I think, first of all, it looks very exciting when we hear the 10% increase. But when we look at the numbers, it doesn't give us any encouragement. First of all, the area which has increased is that of wheat, a little bit, I would say. And then, of course, there's a decline in oil seeds and pulses, which is very crucial because in the last 1 year, we have imported about 46,000 crores worth of pulses. So the farmers are not finding any excitement in growing pulses anymore. And also the area under oilseeds has shrunk. The reason you spelled it out clearly that soybean farmers are not getting the right prices. So why should they go in for enhanced sowing this particular year? So I guess it is a mixed bag, and I think it should be very clear and obvious that the price policy has to change to encourage farmers to bring more area under pulses and oilseed, which is the requirement today.
Mr. Sharma, when you say the price policy has to change, what do you really mean with that? Because the MSP increase is something that the government has been pushing on in sense of price increase for farmers.
Yeah, but if you see the price increase happens at a time when the imports are coming in. So if the cheaper imports are coming in, you will see that the prices get depressed in the market, as a result of which farmers don't get the right price. Now look at soybean, for instance. Against the MSP, which is higher, the farmers are getting about 4,300 to 4,600 per quintal. And so therefore, there is no excitement for them to go or shift towards soybean. The area under pulses has also decreased because the shift is now towards wheat, simply because there is an assured price there. So I think the government has to formulate a policy. Two things must be assured. One, of course, the right kind of price. And second, the imports are not coming at a time when the harvest begins. And that is something which we have to be very careful, because pulses is a victim of that kind of a price folly.
Mr. Sharma, there is just so much conversation around GM right now. While while a lot of people believe that it can increase productivity by 15 to 20%, you're anyways importing a lot of that. But the kind of resistance that we've seen on GM also has been on the higher side.
I think, let me be very clear, there is no increase in productivity anywhere in GM crops. Let me be very clear on that. And I think this feeling or impression has been given by the industry, and I include the GM industry in that. The classical case is that of cotton. We had BT cotton in India. We have seen the collapse of BT cotton recently, and nobody has raised a question. And even prior to that, when the increase happened in the initial years, when the introduction happened in India, the GM crops introduction happened in India, that was not because of any advantage that the GM offered. It was because of other factors like irrigation and fertilizer increase, and this has been demonstrated in an excellent paper published in the very important magazine called Nature by a former director of the Cotton Institute in India, and along with an economist, sociologist in America. Now that is a very important paper which tells us that the increase was not because of GM seeds, as was given or we were given to understand. So I think it should be very clear, GM is not the answer for our increasing productivity, it is the price. Let us provide a higher price to farmers and you will see they raise the productivity. For instance, the case of pulses. If pulses prices were higher, there is no reason why Indian farmers wouldn't have taken that offer. The result is that we have not been able to provide the right kind of prices, so farmers don't see any incentive there. So it should be clear to all of us, it is not GM. And GM, of course, has health concerns, as we all know. We are not a GM nation. So why should we take that line that we need to import GM maize or GM soya? No, we don't need to do that. It will also impact our exports of soya meal, because globally there is a demand for non-GM soya meal, and that India is a country which they are looking up to. Why do we want to lose that option also, or the advantage also? So I think it is very clear we don't need GM, we need healthy crops, and the productivity increase can happen without GM. GM was just an illusion that has been created in this country.
I want to come back onto the cheaper import part of this. And while we've seen that happen in edible oils, we've seen that happen in pulses. I was reading a latest report, Mr. Sharma, and that tells us that even cotton imports, now India does seem like a net importer because from 15 to 17 million bales last year, or rather this year, it looks like we'll be importing 40 lakh bales rather. So from being a second largest producer, and even with an 11% import duty, it does feel like the cotton imports are cheaper into India.
You're very right. And I think cotton is a classic example where the GM experiment has gone wrong. The GM bullet that we all talked about has bitten the dust. It happened in China first. It is happening in India now. In the last 2 years, if you have seen, the area under cotton in Punjab, Haryana and Rajasthan is at the lowest ever. And that tells you that, the farmers' love affair with cotton has gone. And that has gone for two reasons. One, of course, is that the GM crops varieties failed and failed miserably. And the second part is that we are not able to give the right kind of price to cotton farmers. So both the things, I think, should be an eye-opener for all of us, that for boosting the productivity or production within the country, we need to ensure that there is an adequate and assured price, A, and B, we do not go fall for such fallacious kind of argument which say GM is the answer. GM has not been the answer anywhere, including China, which initially had shown remarkable productivity, but then everything crashed as far as the GM crops were concerned in China. So what is happened in India is a repeat of that same performance, and I think that should be clear that GM is not the future ahead.
Well, thank you so much, Mr. Sharma, as well as Manisha, for joining us and giving us an insight into this very interesting as well as important topic. Well, we'll now slip into a short break. We'll get you more on the markets and focus on Dixon Technologies on the other side. Stay tuned. Welcome back to Halftime Report. Well, the market continues to see some selling pressure from the higher levels. Some of the different stocks yesterday that did see some bit of selling pressure emerge today continue to see some moderation. Names like Masgao Dock, IOC, some of the names like BDL. These are some of the stocks that are under pressure today. But another stock that's under significant pressure is Dixon Technologies. Phillip Capital today in a report has flagged off growth concerns for the stock. Upasna joins in with more details.
Well, certainly the brokerage has flagged off some growth concerns here. Well, it has maintained the sell call on the stock with a target price of 9,085 per share. Now, the brokerage says that Dixon was sole manufacturer partner of Motorola last year, but this trend has changed in this year, that is CY25, with Motorola routing some of its volumes to Carbon in this year. Now, in Feb and March in the current year, this outsourcing was minimal, but when it comes to April and May, it accounted for nearly 25% of Motorola's monthly volumes, which were diverted. Now, Phillip Capital says the initial estimate suggests that this figure can rise as high as 35% by June. Now, coming to the Dixon's second largest client, that is Longcheer, it may also outsource some of the incremental volumes to Carbon, is what the brokerage estimates. For Dixon, volumes from Longcheer have grown, looking at the past trends, but in May this year, that is CY25, Longcheer also started beginning outsourcing a small 2% share to Carbon. And brokerage believes that this share can also quickly rise up in the upcoming months. Now, on the back of this, Phillip Capital has reduced its FY27 estimates for the company. It has reduced revenue by 4%, EBITDA by 6%, and PAT by 9% on account of higher competition in the mobile phone assembly space and citing some of the growth concerns for the company going forward. So all in all, certainly we can see the stock under pressure today on the back of this note.
Take that point, Pasna. Thanks a lot for that. The promoter recently sold some stake. Brokerage is not very positive on the stock, down by almost 2.5% from the peak. It has seen a bit of a cut as well. With all of this, let's take a short break. And as we do that, let's tell you about CNBC-TV18 Prime. What is that? It brings you insights from policymakers, business leaders, economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, gives you unparalleled insights as well. You can tune into CNBC-TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m. every weekday. Welcome back. Just keep an eye out on a couple of stocks from the broader markets. We have Sammaan Capital, which has seen a big move, almost 17% higher right now. And most of the gains have come by in just the last 15 odd minutes. So just watch out for that one. MCX continues its move upwards. Dixon Tech is the other one, which is now down 3%, and that's largely because of promoters selling. More importantly, a negative note coming in from a brokerage as well. So that's extended its cut. We had Upasana talk about the reasons for weakness just moments ago. And just pull up Sammaan Capital, the intraday chart. That comes up for you. A big move is what we're seeing. And Bazaar Style Retail, that's the other stock, backed by strong volumes, up around 8%. As we're looking at the broader markets right now. 2,000 stocks in the green versus 600 in the red. With that, we'll wrap up on this edition of Halftime Report. But you don't go anywhere because you have Business Lunch coming up next.
Stocks climb on a halt in hostilities in the West Asia. IT and consumer durables perk up while industrials and utilities sulk. Tata Motors tells CNBC-TV18 there is no production cut expected over rare earth magnets in the next few months, but 20% of its CV sales go via the Strait of Hormuz and they are working on alternative plans. HDB Financial's rupees 12,500 crore IPO opens for subscription after receiving a strong response from anchor investors. The management tells CNBC-TV18 discussions with RBI on overlap of business with HDFC Bank are still on, even as its operations are completely independent. Reliance Group Chairman Mukesh Ambani, in an interview to McKinsey, says that he expects Reliance to live on long after him by focusing on future businesses and reinventing itself to deliver societal impact. He says that the big challenge will be the confidence of the next gen to succeed in the new landscape. The biggest risk we took was Jio, says Reliance Group Chairman Mukesh Ambani, adding that the worst case was a Jio will fail, but it was own funds being invested. So even if it did, digesting India and digitalizing India would have been the biggest philanthropy for Reliance. Also on the show today, 41 years after Rakesh Sharma made history by becoming the first Indian astronaut, Group Captain Shubhanshu Shukla has marked India's return to space travel with launch of the Axiom 4 mission to the International Space Station. We get you all the details in a short while from now. Hello, good afternoon. You've tuned into Business Lunch, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in. As always, markets in the green. Markets managing to hold on to that green today as well. Yesterday, in the second half of the trading session, we'd seen some bit of a subduedness. Today, as of now, that's not the story. 25,200, like you can see, is what the Nifty is managing to hold on to. Sensex, 0.7% of gain, 500 points up, more than 500 points up is what the Sensex is trading at. Bank Nifty, or even the broader end of the market, managing to hold on to that green. So yes, Nifty mid cap, small cap, Nifty bank, all of them trading with positive gains today. We're not seeing much of a decline coming in. Nifty mid caps slight bit off the day's highest point, but let's hope that like yesterday, we do not see a further fall coming in the second half of the trading session. Obviously tomorrow is going to be that monthly expiry, so we'll be watching out for that tomorrow, but today hoping for this green to continue. Nifty as of now at the day's highest point also is what it's trading at. All the sectors except for realty are trading in the green. A lot of individual names on the broader end of the market are also managing to hold on to strong gains on the back of brokerage reports. So MCX, India Mart Intermesh are some of the names coming in from the broader end of the market that are holding on to good gains. But let's move on and talk about what's happening in the world of IPOs. We have the 12,500 crore rupees IPO of HDB Financial Services, the largest of the year so far, has opened for subscription today. The price band is set between rupees 700 per share to 740 rupees per share. The IPO proceeds will be utilized for future capital requirements. And earlier in the day, we actually managed to speak to the management of the company to understand the overall outlook and the plan post the IPO launch. Listen to what they had to say.
What we believe is that India is a huge opportunity for our business. And just to clarify to our viewers that we are a subsidiary of HDFC Bank, but we do not get any business from HDFC Bank. We are independently an entity. We don't get leads from HDFC Bank or any of the group companies. And that's been since inception. We run our own origination, our own risk management, our own collections, our own technology stack.
The government is expected to finalize a rare earth magnet manufacturing scheme within the next 10 to 15 days. This comes after China curbed the export of these magnets, which are critical for EV manufacturing. Now, sources say that the new initiative will have an outlay of 1,000 crore rupees and support capacity of 1,500 tons of rare earth magnets. Today, we spoke to the management of IREL and discussed the availability of these rare earth elements in India and more on this topic. So listen to what he had to say.
the India is having heavy mineral of 1300 million ton of capacity. And out of that, monazite will be around 0.1%, that is 13.15 million. And rare earth will be 6.9 million ton we are having. So, but as per the content of the material, so we are having heavily this lighter rare earth elements. And this heavier part is not available in our resource, which is found only in minuscule or in the ppm level. If you look into our particularly the how India is poised for the heavy rare earth elements, we have to get it either imported or we have to look for the resources like from the hard rock minerals, which is available in India, but that will take little bit of time. This rare earth element what we are getting is not of economy of scale. So now currently we are having NdPr oxide, we are producing around 400 ton. So, but we have got a capacity of around 800 ton. When we are looking for what is to be done right now is one aspect is we have to ramp up our the production capacity right now. That to make it the nameplate capacity we should achieve first.
Now, shifting focus to an exclusive, the deadline to submit bids for Jayaprakash Associates under the bankruptcy process ends. Now, sources say that at least 6 bids have been received. Let's go across to Ritu, who's here to give us those details. Ritu, good afternoon.
Good afternoon, Vinny. You know, some of India's top corporates have lined up to bid for Jayaprakash Associates. And out of the 25 entities that had initially shown an interest, our sources now indicate at least 6 have come forward with binding offers, with that deadline ending on Tuesday. Now, these bidders include heavyweights like the Adani Group, Vedanta, Dalmia Bharat, Jindal Power from the Naveen Jindal Group. You also have listed infrastructure player PNC Infotech in the fray, as is JP Infotech, which is another company from the JP Group, which is now controlled by Suraksha Realty after going through the IBC process itself. Now, JP Infotech, in a statement to us, confirmed the bid, but they did not share any other details. Now, while the financial terms of any of these offers are not really known yet, some of the bankers we've been speaking to tell us that that 12,000 crore offer that was made earlier by NARCL, or the National Asset Reconstruction Company, to acquire JP's stressed loans could be used as a benchmark by the bidders. Some even expect the offers to be lower still with the ongoing litigation around the company's price lands in Noida. But that said, this is a major milestone in what has been a protracted insolvency process. Remember, JP was first flagged by RBI in its second list of defaulters in 2017, but it was only admitted into the bankruptcy court last year. It is a flagship company of the JP Group and interests across real estate, hospitality, cement, engineering, construction, and is now facing claims of more than 57,000 crores from lenders. So a big case is, this is a big case, and now all eyes are going to be on how the bidding really unfolds with these high-profile names in the mix.
Okay, Ritu, thank you so much for that on the latest update coming in here. But let's also get some insights that are coming in from Mukesh Ambani. The Reliance Industries chairman spoke to McKinsey and discussed how clarity of goal and a purpose accompanied by the right people can drive innovation, unlock extraordinary talent and create impact. He also spoke about the big bets that Reliance had taken, emphasizing that Jio was the biggest risk the company had taken so far. Reliance was investing their own money into the venture, even as analysts voiced concerns over India being ready for advanced digital technology. The worst case scenario was that the company would not earn much return. Even at the time, the philosophy at Reliance was that it would be the best form of philanthropy for India, as they would have digitized and transformed the country. Mukesh Ambani also spoke of Reliance's plans in the domain of artificial intelligence, where the purpose is to solve complex problems and create wealth for the nation and the people. He highlighted that this would be the reason behind Reliance not entering the high-risk GPU game and deciding to take the downstream route. Reliance is also making a big-ticket entry into green energy with one of the world's largest manufacturing ecosystem for clean energy, covering solar, batteries, hydrogen and more. and the Reliance Industries chairman terms this to be the company's contribution to saving the planet from the looming climate crisis. Speaking of the future, Mukesh Ambani said that he remains confident that Reliance will continue to serve India and humanity well into the future, but also warns that the confidence of the next generation to succeed in a developing landscape will be the key. Okay, on that note, we're going to slip into a very short break. But before we slip into the break, remember to tune into all the new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC-TV18 Prime decodes the global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC-TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m. Welcome back to Business Lunch on CNBC TV18. And now getting some updates from the US. US Fed Chair Jerome Powell told the members of the Congress on the central bank's current policy of keeping rates cut on the hold and that is geared to dealing with the expected impact of tariffs on inflation. Listen to what he had to say.
The effects of tariffs will depend, among other things, on their ultimate level. Expectations of that level, and thus of the related economic effects, reached a peak in April and have since declined. Even so, increases in tariffs this year are likely to push up prices and weigh on economic activity. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It's also possible that the inflationary effects could instead be more persistent. Avoiding that would depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored. What will actually happen with rates is going to depend on the path of the economy, and that's highly uncertain. So I would just say what that means at this moment in time is that a significant majority of the committee, but also there's a pretty significant minority that doesn't agree, but a significant majority feels it will be appropriate to reduce rates later this year. And what that means is that each of those persons who wrote down a cut in rates later this year, they think that there's some state of the world where inflation doesn't prove to be as high, or the labor market weakens, or some combination of those two things, that it will turn out to be more likely than not appropriate to reduce policy rates, subject to great uncertainty.
An initial American assessment from the Defense Intelligence Agency found that the U.S. strikes failed to destroy the core pieces of Tehran's nuclear program. The assessment also found that U.S. strikes set Iran's nuclear program back by around 3 to 6 months. Let's take a look at this report.
A preliminary U.S. intelligence assessment determined that U.S. strikes on Iran's nuclear facilities over the weekend only set its nuclear program back by a matter of months. That's according to 3 sources with knowledge of the matter. The classified assessment is at odds with the statements of President Donald Trump and Defense Secretary Pete Hegseth, who both said that the strikes had, quote, obliterated Iran's nuclear ambitions. Trump has said the attacks were necessary to prevent Iran from developing a nuclear weapon. Iran denies it is seeking such a weapon and says its nuclear program is for peaceful purposes. One source said the initial assessment was not universally accepted and had generated significant disagreement. A U.S. official speaking on condition of anonymity said the U.S. did not know the extent of the damage yet. Still, the preliminary assessment indicated the strikes may not have been nearly as successful as the Trump administration has claimed. One of the sources said Iran's enriched uranium stocks had not been eliminated, and that the country's nuclear program may have been set back by only a month or two. The Pentagon disputed the notion that the damage to Iran's nuclear program was minor. In a statement provided to Reuters, Hegseth said, quote, based on everything we have seen, and I've seen it all, our bombing campaign obliterated Iran's ability to create nuclear weapons. The White House did not immediately respond to a request for comment. In a statement to CNN, which first reported the intelligence assessment, White House Press Secretary Caroline Leavitt said the conclusion was, quote, flat out wrong.
And moving on, the 2-day NATO summit has begun in Netherlands, Hague, and the meeting is expected to mainly focus on Europe's rearmament, and this is in the wake of Russia and Ukraine war. The summit is expected to discuss the roadmap for increasing NATO's budget to at least 5% of the GDP, and the 2-day gathering is also intended to signal to Russian President Vladimir Putin that NATO is united despite US President Donald Trump's previous criticism of the alliance. And meanwhile, the US President Donald Trump has reiterated his call for the NATO countries to ramp up their defense spending. He also spoke about Article 5, the cornerstone of the NATO pact, which assures US military support in the event of external threat.
We should pay what everyone else, they're in Europe, we're not. A lot of that money goes to rebuilding their bridges, their roads, so it can take heavy equipment. And, we don't have any roads in Europe. We don't have any bridges in Europe. So, no, it wouldn't be quite the same thing for us. But we're with them.
Are you still committed to Article 5 of NATO?
Depends on your definition. There's numerous definitions of Article 5. You know that, right? But I'm committed to being their friends. I've become friends with many of those leaders, and I'm committed to helping them.
Okay, on that note, we're going to sip into a very short break. On the other side, we'll get you the latest on NASA's Axiom Mission 4, so stay tuned in. Welcome back to Business Lunch on CNBC-TV18. Now, after multiple delays, Axiom Mission 4 carrying Indian astronaut Subhanshu Shukla and 3 fellow crew members have successfully lifted off from the NASA's Kennedy Space Center in Florida to begin their journey to the International Space Station. The astronauts are scheduled to be at the space station for 14 days, where they will conduct multiple science experiments. Shukla is the first Indian to pilot a commercial crew mission to the International space station. He is also the only Indian to go into space in 41 years after Rakesh Sharma. In fact, there's Axiom 4 missions group captain Subhanshu Shukla's message from the compartment crew.
नमस्कार मेरे प्यारे देशवासियों, what a ride! 40 साल बाद हम वापस अंतरिक्ष में पहुंच गए हैं और कमाल की राइड थी। इस समय हम 7.5 किलोमीटर प्रति सेकंड की रफ्तार से पृथ्वी के चारों तरफ घूम रहे हैं और मेरे कंधे पे मेरे साथ मेरा तिरंगा है जो मुझे बता रहा है कि नहीं हूँ, मैं आप सबके साथ हूँ। ये मेरी इंटरनेशनल स्पेस स्टेशन तक की जर्नी की शुरुआत नहीं है, ये भारत के ह्यूमन स्पेस प्रोग्राम की शुरुआत है और मैं चाहता हूं कि आप सभी देशवासी इस यात्रा का हिस्सा बने। आपका भी सीना दिल से चौड़ा होना चाहिए, आप भी उतना ही एक्साइटमेंट दिखाइए। आइए हम सब मिलकर भारत की इस ह्यूमन स्पेस प्रोग्राम की जर्नी की शुरुआत करें। धन्यवाद। जय हिंद, जय भारत।
Okay, and with that, we're absolutely out of time on this edition of Business Lunch on CNBC TV18. Thank you so much for tuning in. Nifty at the day's highest point, 0.8% of gain. But don't go anywhere. Up next, your Midcap Radar.
Good afternoon and welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I am Vamakshi Thoria and with me is Vivek Iyer. Well, Vivek, a very good afternoon to you. It's turning out to be a very good afternoon for the markets as well. Nothing to complain. It's green across the screen.
Absolutely. A little bit of cooling off from the day's highest point, especially as far as the defense pack is concerned. But we have quite a lot lined up on the show. We have two managements, very interesting interactions over there. Let's start off with the key headlines. Stocks climb on a halt in hostilities in West Asia. FMCG and auto perk up while realty and private banks sulk. Mid-caps lag.
KEC International in focus after it bags orders worth over 1,200 crore rupees for civil projects, the company's largest order in the buildings and factory segment.
Torrent Power gains after Maharashtra Electricity Regulatory Commission issues a public notice expressing satisfaction for granting approval to the company for parallel DISCOM services in Pune, Nagpur and MMR. This approval, when granted, will enable the company to act as a DISCOM in Maharashtra.
Dixon Technologies under pressure after Phillip Capital maintains sell call with a target of 9,085 rupees, flags that Dixon's largest client, Motorola, has begun outsourcing domestic volumes to Carbon.
MCX rises over 6% as UBS maintains its buy call and raises its target price to 10,000 rupees a share from 7,000 earlier, expecting new product launches to drive further growth.
Well, 25,250 thereabouts is where the Nifty is at currently. It's comfortably sitting out there. And, if the index manages to hold on to this, it'll be the second consecutive day of gains for the benchmark indices. The mid-cap end of the market is doing quite well as well, but not as well as the benchmark indices. The mid-cap index is up 0.3%. The broader markets will come up for you, the advanced decline ratio out there. We have almost 2,000 stocks advancing for 619 stocks that are declining. That will show you that the broader markets, specific stocks are doing quite well. Now, as far as sectoral indices are concerned, most of them are in the green with the exception of Nifty Realty. We have Nifty Media as well as the Nifty IT index that are leading the gains in today's trading session. But lots of individual stocks that are moving around in trade. And to highlight just those, we now have Hormaz to take us through in our special segment, Midcap Movers. Good afternoon, Hormaz.
Good afternoon, Vamakshi. And one of those days when the broader markets are not outperforming the benchmarks, but the advanced decline ratio is here to give you enough comfort. Starting off with some of the movers, then Samman Capital is the top gainer on the Nifty 500 today, 16% higher on that stock. MTNL goes one step further, now 18% higher there. Solara Active Pharma also saw a big spike after 11 a.m. and since then has been around about those 12 to 13% gains. And Endurance Technologies too having a good day at the office. Lots of brokerage notes came in earlier in the day, and MCX with a 10,000 rupee target price from UBS is now up 6%, slightly off the highs of the day though. IndiaMart after the Nuvama upgrade has seen a bit of choppy moves but still holding on to gains of around 6%. Hyundai Motors is a post-listing high for the stock and initiation from Avendus Spark earlier in the day today. So positive moves here, and Dixon of course on the sell recommendation from Phillip Capital. Some of these industrial names have done very well in today's session. Look at Bharat Bijli, 12.5% higher there. Kirloskar Brothers, a good day. Maharashtra Seamless, ITD Cementation is a new high for the stock, 5% higher there as well. Stocks doing well on the volumes front in today's trading session. Look at Welspun Corp, but of course Balaji Amines, Bazaar Style, Den Networks too, 10% higher on very strong volumes. And lastly, some of the pockets not doing well, of course it is defense. The profit booking continuing here. Garden Reach down 9% yesterday, another 5% today. Masgao Docks down 3% and Data Patterns too at the lowest point of the day. Back to you guys.
Thank you so much, Hormaz, for joining in and giving us all of those important stocks to track, especially as far as the broader end of the markets are concerned. Well, before we slip into a short break, remember to tune into the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and for the Global Lens at 8:30 p.m. Welcome back to Mid-Cap Radar. Well, the first management on the show is Raymond. Remember, Raymond Realty's T3 debut is scheduled on July 1st. It plans to launch 14,000 crore rupees housing projects in FY26. We are joined by Amit Agarwal, who's the Group CFO at Raymond, to discuss more. Thank you so much, Mr. Agarwal, for joining us. Well, first up, Raymond Realty lists next Tuesday. Quite a lot of expectations from the street. Take us through the key details of that particular entity. We understand, you have almost 6 projects lined up. So what is the total GDV of those projects? What is completely belonging to the Raymond stable? And what is being done via the JDA route?
Thank you for having me on your show. Friend, look, Raymond Realty has got 2 large verticals of the business. One, the 100-acre land, which is owned by Raymond Realty, which we are developing as we speak today. Of that, 40 acres is currently under development, and the balance 60 acre would get developed over the next few years. So that is one revenue stream for the business. The second revenue stream is primarily the JDA projects, and these JDA projects, we have already signed 6 JDA projects, which is almost 14,000. So put together between the two is almost 40,000 crores of the gross development value. And between these 2 projects, as we speak today, 9,000 crore has been already launched, and another 5,000 to 6,000 crores we plan to launch in this year. So thereafter, what happens, everything keeps on getting launched one after the other years, and we continue to evaluate more and more JDA projects because the Thane land is a finite land. So in order to have a growth of the business, we continue to do JDAs in MMR region. And if I look at it, as far as the JDAs, there are enough and more opportunities coming on our way. And we have evaluated more than 600 projects in order to sign up for the 6. So we are very cautious and careful in which JDAs we want to get into and what is the right project which fits in our scheme of things and the fundamentals. That's the way the business.
Sure. Mr. Agarwal, this is Vamakshi joining in. Now, if I'm not wrong, in your outlook for FY26, you've said that you're expecting 20 to 25% growth in your booking value. So roughly back of the envelope calculation suggests that the booking value would come up to roughly 3,000 crores. So isn't this a modest, growth guidance, and I mean, just would like to understand from you, is this a function of the projects lined up, or do you see some softening of demand that is taking place?
Actually, if you ask about the demand, I think we have seen a decent demand. And even as late as in the month of June, we have seen very good bookings. Actually, what you're seeing a little bit pressure is absolutely in the top end luxury segment. If I look at the affordable luxury where we operate 99% of our business, there we have not really seen any kind of a dip in the demand. Second thing, it is the lifestyle which we sell. It is not really just an apartment. And I think that is one of the reasons when we launch our project, the day one, we get a very, very, very good bookings. And if you see across over the projects which we have launched so far, we have sold most of the projects anything between 65% to 97, 98%. So therefore, we have not seen any way in our projects, there is a weakness in demand. Second thing, when you're talking about a projection that we are talking about 20 to 25% growth, the fundamental reason for that is that we want to be very clear that this is a minimum which we know that we will be able to deliver. And beyond that, as we continue to launch the projects, the bookings will come. So this is the minimum, so to speak, that we are 101% assured that this is going to happen. And if you look at the demonstration of our performance between 25 revenue to 26 revenue, there's already a 46% growth. So the company has been able to demonstrate a significant growth and improvement in all across parameters.
Understood that. For the next couple of years, 50% of the annual pre-sales is targeted from JDAs. So the first question is, how do you fund these JDAs? What is the funding requirement from Raymond's end? How does the interest rate differ compared to other developers? And what does it mean for EBITDA margins? I mean, own land versus JDAs, what is the EBITDA margin differential?
Look, first of all, when we talk about, you asked 2 questions, one about the funding and about the margin. Let me talk first about the funding. If we do our JDA model is very simple mechanics where our philosophy whether it is our own land or a JDA project, is sell fast, construct fast, and collect fast. Every project in Mumbai MMR in India is on a construction link payment. So if you have sold the inventory, you are bound to get the collections. So I'll give you a simple example. On a 2,000 crore project, your peak cash funding requirement is in the range of 450 odd crores, of which the 250% of that is 225, 230 crores comes from the Raymond equity, and the 230 is a project finance debt. Project debt, we are able to get it from the various Indian banks, which they are very, very supportive. And at the end of the day, the Raymond Group has a very strong, credible history with banking relationships. And therefore, we are having no challenges in getting that funding. And that also, because we are able to complete the project in a faster pace, our peak cash requirement is on the 18th month in a cycle of 60 months. And by 32nd, 33rd month, the project starts to generate cash so that the debt starts.
And a word on the margins, sir?
Sorry?
And a word on the EBITDA margins?
So the EBITDA margin, again, for different projects, it will be different, because at the end of the day, each project will have a very different structure. There will be a different margin profile, different sharing of the land which you need to do in terms of the square feet you need to give to the tenants, in terms of the people who are there, who are to give the land. Sure. So it will be very different. But broadly, the way we have defined is across the board, we will not be entertaining a project which will be below a 20% EBITDA margin, and all our projects should deliver minimum of 20-22% IRR.
All right. Thank you so much for that, Mr. Agarwal, for joining in with CNBC TV18. But as we slip into a very short break, here is some good news for our viewers. India's business news leader is only just a click away. Introducing CNBC TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen. Welcome back. You're watching Midcap Radar on CNBC-TV18. Let's shift our focus to quality power equipments. The company has announced the launch of Global Coil Factory in Maharashtra. It will address growing global demand for high voltage reactors and coil-based components. Bharnidharan Pandian, who is the joint MD and whole-time director at Quality Power Equipments, joins us now to discuss more on this. Well, good afternoon to you, sir. First of all, congratulations on your groundbreaking ceremony. I'd first like to ask you, about the timeline of this project completion, because earlier you had indicated that this would get completed in Q2 of FY27. So, number one, is this on track, and what is the kind of capex that you have outlined for this?
Mr. Pandian, I believe you're on mute.
Good afternoon, Vamakshi. Thank you for getting in touch. Yes, we are on schedule to come in Q2 next year. We have envisaged a capex of between 125 and 150 crores, most of which is being funded through a promoter soft loan on the company at this point.
Understood that. So, what is the peak revenue potential and the peak EBITDA margin potential when you consider utilization at peak levels?
We presume the plant can deliver about 1,500 crores, give and take, and the margins for the product chosen at this moment is about 20% before tax.
All right, and your Cochin facility is also expected to come on stream in November 2025. So how quickly would you be able to ramp this up, and what is the kind of revenue contribution that you expect from this facility in FY25, whatever part it comes on stream for, and what is the kind of products that you're targeting in the Cochin facility?
So the Cochin factory delivers to the basic power quality markets in the medium voltage AC grids. This is our bread and butter customers across the globe, the OEM customers. The factory that we are building in Sangli is a global factory. We serve more than 100 grids in the world. With the amount of HVDC and fax contracts coming across the world, especially being announced in Europe, US and Australia, we believe the entire factory shall be booked for the HVDC and fax market for a global scale.
Okay, Mr. Pandian, end of FY25 order book was at close to 750 crore. Where does it stand at currently? So given that order book, what is the kind of gestation period, and over how many quarters will you go ahead and execute the current order book?
So the order book is increasing on a daily basis. So we have only good news coming in the next quarter results as and when it turns up. What we are...
A tentative, or if you could give us a ballpark figure of how much it's increased by?
It is increasing at a good pace. I don't know. I'm allowed to talk about the numbers on a compliance standpoint. I'm sorry, we are a newly listed company. However, I can only speak a healthy rate of growth. We are seeing that we will take a lot more HVDC orders coming in the H2 of this year. That's where we are seeing a larger focus.
If not a specific order book value, can you help us with maybe a pipeline then for, a quality power for Meru, and what has been your historical strike rate?
So we've already declared that we anticipate another 500 crores of minimum order book coming in this year, which puts our new order book at about 1250 crores for the year. And the revenue guidance is already between 700 and 800 crores. We believe we should have some positive surprises there also. We also believe a lot more in inorganic growth. We are looking at options in that region also. So we are busy at this moment building our own pipeline of orders, our factories, and also looking at other opportunities.
Have you zeroed in on any acquisition targets? What will be the likely size of the acquisition, and what will be the target, the targeted entity? What will be the peak revenue potential that you envisage there?
At this moment, we are talking to multiple opportunities. We look at culture fit, technology and price. Eventually, price is also important. As and when we close something, I think we will inform the markets.
Well, sir, I'd also like to understand from you. So 210 crores of cash on books. You're also spending a lot on, your capex plans as well, and you're also eyeing some acquisitions. So overall, how do you expect to fund all of this?
We believe we are still a promoter-driven company. We, as a family, we own more than 74%, almost close to 74% of the company. We believe as and when the cash is called for, the promoters will put in a soft loan into the company that can fund the initiatives. So we are also delivering more than 100 crores of PAT last year. So as our revenue grows, so will our PAT and the free cash that is generated. We have also focused on capital allocation. We have not used the PAT and the free cash being generated to deliver a capex. So the capex is being already funded by a promoter soft loan. So the company's free cash is all for growth.
Okay, thank you so much, Mr. Pandian, for joining us. It's very brief conversation today, but we hope to get you on the channel once again for a more detailed conversation post your Q1 results. But with that, it's all the time we have on this edition of Mid Cap Radar. Your stocks when we return.
Hello, good afternoon and welcome to Your Stocks, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in. As always, markets trading almost at the day's highest point is what we're seeing. Nifty 25,232 is what the Nifty 50 is trading at. 0.7% of gain is what we're seeing coming in for the Nifty 50. Benchmark indices like Sensex also managing to hold on to similar levels of gain, almost 0.8% of gain for the Sensex as well. Broader end of the markets, that is also doing well. 0.3% of gain for the Nifty mid cap, that's continuing. Nifty small cap also managing to hold on to gains in today's trading session as well. So yes, Nifty mid and small cap also seeing good gains. Nifty bank also among the good gainers in today's trading session. All the sectors are trading in the green except for the realty, which was a bit under pressure. Nifty realty, the last time I checked, it was down almost 2/10 to 0.3%. So that is something that we'll be watching out for. But on that note, let's get started with the show for today. This is the show where we solve all your stock-related queries, and to do just that, today we have Richard Jain of Motilal Oswal Financial Services joining in with us, as well as Asta Jain of Hem Securities to answer all your stock-related queries. Richard as well as Asta, good afternoon, and thank you so much for joining in with us. Richard, what are the levels that one should be keeping an eye out on in terms of the markets? And given that tomorrow's monthly expiry, could we expect a beat of a volatility and a fall for the current levels for the Nifty and the Sensex?
Yeah, hi, very good afternoon. Well, we can clearly see that the broader trend for the markets is strong, because whatever dips we are getting, even yesterday's trading session, we saw some good dip from the opening highs, but those dips are getting bought into. And the good thing is that the broader market breadth still remains quite strong. So we believe that on the higher side, 25,300 would be one level to watch out for as a resistance. And once that is surpassed, I think we should head towards 25,450 to 500 very soon. Whereas on the lower side, 25,000 to 24,900 would be the immediate support zone. So I think it's a kind of market where stock picking would give you better trading opportunities. But yes, on the index front, it remains a buy and dip market, and any dip towards the supports should be bought into.
Okay. On that note, let's get started with the queries for today. We have Gaurang, who's writing to us from Nagpur. 500 shares of BPCL is what he's holding at a price of 304 rupees per share. Wants to know the outlook of the stock and wants to know if he should continue to hold or look to exit. 304 is what they bought it at, making some bit of a profit right now. Asta, your view coming in for BPCL. What are you watching out for now? Given, we've seen so much volatility coming in crude as well. So what should we keep an eye out on in terms of factors for BPCL?
Hi, good afternoon to all of you. So yes, there are certain factors which we really need to look after if we talk about BPCL. First of all, would like to give my strategy. This is hold from my side with a price target of 355. Now the basis on which I'm giving a hold is, first of all, there's strong refining performance, there's strategic expansion plans which we are seeing, and with the Mozambique plan and the city gas distribution business, definitely this company has certain plans which can really lead to strong financial performance going ahead. So on the basis of all these, I believe that BPCL is well placed to post some more gains from here. Hence, we are recommending hold on this counter with an initial price target of somewhere at around 350 to 355.
Okay, 350, 355 is the target that you all are giving. Ruchir, on the charts and technicals, are the targets at similar levels, short-term and long-term targets? And you think the viewer should hold the stock then?
So last 2 months, we have seen some sideways action in the stock where 300 to 335, this has been the trading range. But if you look at the broader trend, I think the broader trend still remains positive, and hence this entire consolidation seems to more of a time-wise correction within an uptrend. So I think since the buying price is around 304 and the support is at 300, the risk-reward ratio is definitely favorable to hold on the long positions. And what you've seen in last couple of days, that the crude oil prices have also dipped sharply. So definitely being an inverse correlation. So I think going ahead, once this time-wise correction is over, the stock should see a resumption of the uptrend for potential targets towards 350 to 360 zone. Similar, I think, what Asta told. So yes, should hold on, keep a stop loss below 295 on your existing long positions, and review once you get the stock around 350 to 360 zone.
Okay, keep an eye on those levels over there. Let's move on to the next query for today. We have Shankar Das, who's writing to us from Hyderabad, holding 200 shares of M&M. This is at a price of 2,647 rupees per share. Wants to know if he should continue to hold or book out his profits. Asta, M&M, what is the story that you see playing out here as well? Obviously, they have those, the SUV segments that they are talking about. That is expected to do well. What are we watching out for other than that? And should they continue to hold the stock?
Yes, because we are also looking about the realization growth which happens from their EV models. So we are taking it to at around 8% realization growth going forward. And in fact, this company has continuously gained market share in PV, CV, and tractors business. In fact, we are expecting the volumes in these businesses to grow at a CAGR of around 12% overall. So talking about this counter, we believe that this counter is well placed in our automobile space to show more upside from here. So we are recommending buy as well as hold. Both the strategies we are giving on this counter with a price target of 3,300 to 3,500 in the longer term.
Okay, and Ruchit, your view on the technicals?
So technically, the stock seems very strong because the stock has shown a good relative outperformance compared to sectoral move. Now, if you look at this entire corrective phase, which we which we had seen from the month of October 24 to recent lows in the March 25, the Nifty Auto Index had corrected sharply. Nifty Auto Index is still, I think, much below its previous all-time highs, whereas the stock Mahindra & Mahindra is quite close to its all-time highs. So clear relative outperformance compared to other stocks within the sector has been seen in Mahindra & Mahindra, which could continue going ahead. We expect targets somewhere around 3,480 to 3,500 in the near term. So I think it's better to hold on this outperforming name. You can expect targets around 3,500 in next couple of months.
3,500 in the next couple of months, so can look for some bit more of a profit before actually selling. That's the view coming in from our experts for today. So do hold on maybe for some bit of a time. 3,500 is on the cards. Let's move on to the next query for today. We have Sayan Indranath, who's writing to us from Hyderabad. He's holding 600 shares of IEX. This is at a price of 180 rupees per share. 6 months ago is when he purchased the stock, and he's saying if he can hold it for 6 more months, wants to know the outlook coming in for the stock as well. IEX, today we have a brokerage note also that has come in right from Bernstein. They were also quite positive on the stock. So, Asta, what are we watching out for in terms of IEX levels? And would you suggest that the viewer continue to hold for some bit more of a time?
Yes, one should continue to hold for this counter with the price target of 200 to 215 at the initial levels. Now, talking about this counter, what we have seen in the quarterly result was an increase in the revenue by 17%, but that was mainly due to the increase in the volume. We have seen a surge in the increase in the electricity trading volumes. And going ahead also, what management is anticipating that these volumes will continue to grow, looking after the strong electricity demand, and they are expecting it to continue to grow in the double digit if we talk about future or futuristic FY26 figures. So I think on all the spaces, I think this counter is well placed to show more gains from here. So a buy is also recommended from our side for this counter, but it should be on the dips at around 185 odd levels. But price target can be set at around 200 to 215 at the initial levels for this counter.
Okay, keep an eye on those levels over there. Richard, IEX on the charts and technicals, what are we watching out for? Because last 6 months, it's been quite in that range. Nothing sort of an exciting move or an up move that one has seen, right? So does it merit holding it on the charts also? Or would you say that, might as well exit the stock?
So relatively, there has been an underperformance in the stock, and what we've seen in this 4 to 6 months has been more of a consolidation within a broader range. The stock has 200 DMA support around 175, but the trend is not yet positive, but more of a sideways kind of thing. I think 210 to 175 is the trading range for the stock. So I would suggest to look for exit opportunities if you get some pullback move near the higher end of the range. I think there are much better opportunities available in the market where you could see some make relatively better gains than what one can see in IEX.
Okay. That's a view coming in there for IEX. Let's move on to the next query for today. This is coming from Ravi, who's writing to us from Hyderabad. He's holding 100 shares of ICICI Bank. This is at a price of 287 rupees per share. They're making a profit on this one. They've been holding it for a while. Wants to know if he should continue to hold or book out his profits. Asta, your view, is it time maybe to just take some bit of the profits and then at least get out your cost and some bit of the profit and then enjoy the remaining profits if it comes going forward?
While my idea here is to stay invested rather than booking profit at this point of a time, because we are very much optimistic on the banking space, and this being the bank which has got a very strong credit quality, very strong financials they have posted. And going ahead also, we believe the kind of franchisee this bank is having, and they are putting in various strategic initiatives in order to increase their financial performance. So my idea here is to stay invested in this counter, because we also believe that with this interest rate cut scenario, the banks are well placed to enjoy all this macro developments which are taking place. Overall, we believe that this bank is well placed to show more upside from here. So there is no need to take out profit at this point of a time. Maybe at around 1550 to 1600 odd levels can be the ideal levels where one can book partial profit. Not full profits I'm recommending right now. So idea here is to stay invested in this counter with the initial price target, which can be set at around 1550 to 1600.
1515 to 1600 initial target. Do not book out your profits. That's the view coming in from Asta. Richard, your view also. Would you also suggest the viewer continue to hold ICICI Bank instead of booking profits?
Yes, definitely. I think if you look at if you compare the stock with other private sector heavyweights over last 1 or 2 years, then certainly it has been one of the outperforming stock. And still the broader trend continues to remain positive, or the price up moves that we are witnessing are supported by good volumes. Whereas, small corrections which are there, we are not witnessing any volume-based selling happening over there. So, and overall, the banking and the NBFC space has definitely taken the leadership since this recent low in the month of March. So I believe that you might see some in-between time-wise correction or some phases of consolidation, but the overall trend remains positive. So it's better to hold on to the name, have some positional view. I think you should get some more gains in this stock.
Okay, have some positional view, could make some more gains as well. So continue holding ICICI Bank. That's a view from both our experts. But on that note, we're going to slip into a short break. But before we slip into the break, tune in to the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and the Global Lens at 8:30 p.m. Welcome back to Your Stocks on CNBC-TV18. We still have with us Richard Jain of Motilal Oswal Financial Services and Asta Jain of Hem Securities to answer all your stock-related queries. Keeping it going with that, the next we have a query coming in from Jagdish Kumar, who's writing to us from Bangalore. Two stocks he wants to ask us about. One is LIC. He's holding 2,000 shares of this at a price of 988 rupees per share. So he's making a loss on this one. While other one is IRCTC, 2,400 shares of IRCTC, price of 842 rupees per share. So loss here as well. He's ready to hold it for the long term. What should he be doing with both these stocks, IRCTC as well as LIC? Asta, your view coming in here for both the stocks.
So for IRCTC, I would recommend to hold because what we believe that yes, the quarterly results were a little soft due to the non-performance of catering business. But with the kind of the new trains, new circuits they have introduced, definitely the catering business will get a boost. And that's why we can see a strong or a better financial performance in the coming quarters by this counter. So idea here is to stay invested. There is no need to book loss because right now 767 is going on and the investor has a cost price of around 820 or 840 odd levels if I remember it correctly. So better to remain invested in this counter with the initial price target somewhere at around 820 to 840 odd level, which is the cost price also. Talking about LIC is looking good to us. We are recommending hold on this counter with the initial price target of 1,045 to 1,080. Now, if we see the performance from this counter, they have taken certain strategic initiatives which are really working in track in order to improve their margins, product, as well as channels. And in fact, the increased share of non-participating in their product mix is definitely helping this counter. In fact, they are expanding the non-agency distribution business also, which I believe is a good choice going ahead. And hence, we are recommending hold on this counter with a price target of 1,045 to 1,080 at the initial levels.
Okay, that's a view coming in there on the fundamental front. Technicals, Ruchit, what are you watching out for here? IRCTC seen a correction in the last 1 year specifically, right? They bought it at 842, currently at 766. And LIC, they bought it also at those higher levels only, 988. And now currently somewhere around 700 is what the stock is trading at, right? So what should they do now with both the stocks on the technical front?
So I think these are not the levels where one should think of booking losses in IRCTC. Although the stock has been a relative underperformer, but at least the price-wise correction seems to be behind and the stock is going now through some time-wise corrective phase. On the high side, the major hurdle positionally would come around 840, 850. I think that's where the cost price is. So wait for the stock to come around the cost price of 840, 850, depending on how the price volume action pans out during that up move. One can take a review again over there and then decide. So as of now, continue to hold on. LIC, I think this also I would recommend to hold on because the stock has seen good volumes in the recent up move. Finally, after so long period of underperformance, we have seen started formation of higher top, higher bottom structure on the daily charts, which gives a potential targets around 1,050. So both the stocks I would recommend to hold on, and LIC around 1,050 would be good levels where you can take a review again.
Okay, keep an eye on those levels over there for LIC as well as IRCTC. Next query for today coming in from Parmeshwaran, who's writing to us from Mangalore, holding 120 shares of JK Paper at a price of 235 rupees per share. Stock is at 365. They're making a profit on this one. Wants to know if he should add more shares, exit or shift to some other paper company is what they're looking at. Also wants to know the outlook of the paper industry in the medium term. Asta, your view.
So outlook is still not very positive on this industry, but looking after the JK paper, we recommend to hold this counter with an initial price target of somewhere at around 400 to 410 odd levels. Now, yes, due to increase in the raw material cost, increase in the wood prices, we have seen the financial performance was not that very much encouraging, but they have made certain acquisitions. I think that acquisitions can be accretive in the financial performance terms to this company, and hence I would just like to wait in this counter at least for the coming quarterly results. So idea here is to stay invested till the quarterly results arrive. Meanwhile, we are setting our price target for this counter somewhere at around 400 to 410 odd levels.
Okay, that's a view coming in on the fundamental front. Wait out for the earnings before you take a call and keep an eye out on the levels also that Asta mentioned. Ruchit, what are the levels that you all are keeping an eye out on for JK Paper? And overall for the medium term is what they are looking at in terms of holding time period. So what should they do now?
So overall, the trend does not look to be that positive, because what we have seen that in spite of that good rally in the broader markets over the last couple of months, the stock has not seen any kind of volume-based buying happening over there. So I believe that the stock at the most, I think, should be sideways from the range of 340 to 410, 420 on the higher side. So I would suggest to look for exit on the higher side if the stock rallies towards 410, 420 in the near term, and one can keep a stop loss below 345 on the existing long positions.
Okay, keep an eye out on the stop loss levels as well as the target also that Ruchit mentioned as well. But that was the last query for today. So thank you so much, Asta, as well as Ruchit, for joining in with us on the show as always and helping our viewers solve all the stock-related queries. And viewers, thank you so much for tuning into Your Stocks. Always remember that you can send us your queries. The email ID will be flashing on the screens for you all as well. So do send us your queries. We'll solve them Monday, Wednesdays and Fridays with our experts. But the last hour of trade is still left and you have closing bell to take you through that action.
beyond market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
The Hang Seng currently trading close to 1% higher. The Taiwanese index is up 0.5%.
Increases in tariffs this year are likely to push up prices.
Support stands at the 20-day moving average, 24,872. 25,160 on the Nifty is what you have.
Because we chase a set of customers which are fairly distinct from what the bank does.
We get the entire monazite for processing, then we can go up to 800 ton.
Fairly steady so far in the first 120 minutes of the trading session so far.
For three nations, a new chapter in space takes flight.
The index manages to hold on to this. It will be the second consecutive day of gains for the benchmark indices.
Okay, well, that's the day so far. It's a good session. No hesitation like yesterday. Yesterday, of course, by this time, gains had all but disappeared, and we were up about 1/3%. Right now, just under 1% gain on the Nifty. So looking good. Market breadth quite positive as well. Just the two of us today, and we're going to take you through the last hour coming up. We're coming to you from the CNBC-TV18 Motilal Oswal studios. Nigel, hi.
Well, today's action actually reminds me a little bit like the Indian pace attack yesterday, because we bowled pretty okay. Bumrah was leading. Unfortunately, he couldn't pull back too many wickets. And today you have the Nifty Bank, that's actually the largest component, which is not performing. So we're missing that kind of a little bit of fire that will come in from the Nifty Bank. For the time being, it's underperforming. The next 60 minutes, if the Nifty Bank can get its act together, it can very well take the Nifty even higher from here. And tomorrow being the expiry day, I'll keep an eye out on this index. It underperforms today. It's been the one that's been in form. But let's see whether or not it can propel the Nifty higher from here on.
No, absolutely, Nigel. And, if that joins, the proceedings, I mean, I think that 200-point gain on the Nifty will look much bigger. For now, though, it's just 200 points, which is absolutely fantastic after yesterday's, about near 100-point, under 100-point kind of move. So, the level, of course, is once again, it becomes the last reference point, which is nothing but yesterday's high. 25,318 will be that number, which is where the market got to and then sold off. But much lesser hesitation in that sense. Banks are lagging, as Nigel also pointed out. And about just 1/3% under that, actually. Small cap index is doing very well. The Nifty small cap index is up 1.5%. Mid cap's not so much. But the small cap space is buzzing. And sectorally, if you just look at it, IT is the big winner. And that index is up 1.5, 1.6. The defense index is down for the second or the third straight session now. Defense index is down a full 2%. So, some food for thought, some discussion points as we go along. Nigel.
Well, that's right. Well, let's get a quick technical call going on the markets. We have Mitesh Thakur who joins us back on the show. Well, Mitesh, we've put on a good amount of weight today. The breadth of the market is positive. I think that, at around 2,000 stocks gaining, that's the most encouraging sign, I think so. But let's talk about the Nifty first. What are the levels you're looking at from here on? And also the Nifty Bank, a bit of an underperformance, but as long as it's holding above the 20-day MA, you'll pretty much say that the uptrend is intact.
So the uptrend is there, Nigel. I think what's happening is that we've seen that the range on the Nifty has shifted on the upside without giving a proper jerk, which would possibly suggest some kind of a strong move. So that momentum is missing. I think the indicators are still, not giving you a strong signal of an up move. But yes, the bias, the drift is on the upside, but the jerk which is required, I think, which traders will prefer is missing. So trading long bias, at least on stock side. On the index side, I think a good idea.
Oopsie. Mitesh, we miss you. All right. I think yesterday as well, unfortunately, it snapped at that point of time itself. But we'll try to get Mitesh back. I'm not sure whether we have him, but we'll wait for Mitesh to come back. Well, from the Nifty itself, let's highlight a couple of big movers. Adani Ports is putting on strength yet again. That was one of the stocks actually that were not participating. I recall at around 2 p.m. that stock was more or less flattish. So that's perked up a little bit. Mahindra and Mahindra finding its form again. That's on its way to making a fresh 52-week high. Just take a look at that beautiful looking chart. All through the day, it's been trending up. And the last one I want to pull up is ICICI Bank. That was trading in the red. That's trying to get its act together. It's moved into the green. Well, that's good, right? Because that's a large weight on the index itself. The problem is some of these defense-related names, they have come in for some selling pressure. And in fact, BEL, the stock that's done so well, that's down closer around 3%. That said, we'll get back to Mitesh's call. But for the time being, let's focus on MCX. Brokerage has come out with a note, and they're quite bullish on the prospects of MCX. Vamakshi joins us to tell us what do they find so impressive. Vamakshi, take it away.
Well, Nigel, it's a big thumbs up coming in from UBS on MCX. They've gone ahead, maintained their buy rating, but upped their target price to 10,000 rupees per share. And this is the rationale behind that. First up, they are expecting a very robust Q1 ADV, which is the average daily value. In Q1 so far, they report that the futures ADV saw growth of almost 50% sequentially, largely driven by a sharp rise in bullion. The options premium ADV was also quite healthy at 4,300 crore, an uptick of almost 30% sequentially. This in turn translates to an estimated trading revenue growth of 34 to 35% quarter-on-quarter and a net profit growth of 50% sequentially. In addition to that, they believe that new product launches could support growth both in the near term as well as the medium term. Conservatively, they are expecting electricity derivatives to contribute to 3% for their FY28 revenues, but they do see some upside potential here as well. They're expecting some very good traction in the new silver options as well. And given all of these factors, they've gone ahead and revised their estimates. So they're expecting an earnings CAGR of almost 26% from FY26 to 28, and they've also gone ahead and increased their EPS estimates by 13 to 17% from FY27 to 28 respectively. Now, as far as valuation is concerned, MCX currently trades at 42 times FY27 price to earnings multiple, but they believe that the market currently is not pricing in the growth from new products, the operating leverage, as well as the benefits from higher volume. So overall, they have a positive rating on this counter.
Got it. All right, Vamakshi. Thanks a lot for joining in and giving us that detail. Just take a look at the stock. Wow, what a beautiful move, right? Today it's up closer to 5.5%. I think the last 1 month or so, that's up closer to 30%. So, that's clearly been the stock to go to. Prakash Diwan joins us on the show. Hi, Prakash. Good afternoon. Good to see you win. MCX has said, why should BSE have all the fun? That was the only one that was running along. So it's playing catch up in that sense. What's your take on this exchange?
Good afternoon, Nigel. So I know, when commodities are doing so well, and especially thanks to today's, rarefied digital era, there's so much of volatility according to the news flow that people who are making, taking trades on the commodity side are probably much more happier than what we've done on the equity side. Be it gold, be it silver, crude, copper. So I think very clearly there is a shift towards there's a shift within the asset classes. There's much more institutional money that's coming in. And very soon you'll probably have products which are driven using MCX contracts as well, maybe some sort of smart alpha strategies on the ETFs and all of that. So my sense is there's definitely more play, and all the overhang that it had in terms of, the issues related to the IT, the kind of money that they were spending on in terms of getting that right, that's probably been sorted and behind us. So people are kind of wanting to look at. But if you really ask me, the valuation, I don't know what UBS has estimated, but our expectation is that on FY27, it's probably trading at higher than 50 times P multiple, which is steep. It's just the environment that's kind of making things look up, but it could very easily come down to 30, 35. So the PE contraction could happen. It's vulnerable to that. But I would definitely believe it's a secular story. You make sense. It makes sense to buy and add on dips, not get so charged up about it, just because the environment, as I said, for exchanges is looking very positive.
Okay, all right. Let's stick to the exchanges theme then. Let's put the spotlight on the latest in the NSE IPO front. Sources say that NSE has filed for settlement with SEBI in the co-location case. Yash joins us to fill us in with all the details that he's picking up. Yash, take it away.
Well, Nigel, this would be the biggest settlement application in the history of Indian capital markets. NSE, according to our sources, has filed for a settlement application with SEBI in the co-location matter. The size of this is slightly upwards of 1380 crore rupees. Now, it is very important for NSE's aspirations to bring out an IPO for this application to get accepted by market regulator SEBI. Now, in a situation where SEBI accepts the settlement application of 1388 crore rupees, in that case, what will happen is that after that, SEBI is likely to give a no objection certificate for which NSE had filed for, which will enable the National Stock Exchange or NSE to go ahead and file for DRHP when it comes to its IPO. Simultaneously, what SEBI will do is to bring an end on the legal matter against NSE. It will move to Supreme Court according to sources. If, of course, all depends on that settlement application getting accepted, to withdraw that case against the National Stock Exchange in the co-location matter. After that, it's going to be a normal process once all of these steps are taken care of for NSE to sort of launch and start the process towards its IPO.
Yash, thank you very much for that. Remember, even after, I mean, if the regulator accepts that settlement offer from NSE, of course, that will get the ball rolling. But then, as Yash pointed out, there are things to be done in the court. And then, you know, it sets the ball rolling. It will still take many months before, you know, we'll actually see a filing with the regulator for the IPO, or I mean, you know, actually the IPO happening. So keep that in mind. But this does kind of sort of take them one step closer, but it's a crucial step in that sense. Prakash, any thoughts here? This, of course, you were just talking about the mood looking up for exchanges. Any thoughts on this one, NSE?
Yeah, so, you know, I mean, there's been so much of, discussion and chatter going around, but at this 12,500 crores PAT for what the year that's gone by, I mean, you know, if you expect some sort of a market cap of 4.5 lakh crores, I don't think that's unreasonable, and that makes the price very attractive, at least, you know, for the IPO itself. But, you know, remember, a lot of people who like the stock own it. A lot of the institutions who had to offload have offloaded it. So I don't know how much of residual activity it will generate. But it is important for the exchange to get listed for various reasons. And you will also have an alternative to the BSE, which trades at, 82, 83 times trailing. So, you know, there will be a depth created in the space once this happens. As you rightly said, there's still some time, but hopefully, you know, before March 26 is when you could probably see it getting traded in our markets, and that will be very interesting.
All right, Prakash, I wanted to ask you about a cement name that we would have discussed sometime in the last 13, 14 years, Deccan Cement. The stock is buzzing around. You know, is there a buyer or is this a bluff? We'll get to know soon. What's your take? You know, today it's up close to 7-8% on massive volumes.
Yeah.
You know, and obviously I'm trying to work the phone lines and trying to see what I can pick up as well on that front. Valuation-wise, there appears value, but that's always been the case. A lot of these South-based companies, they don't function at optimum utilization levels. What is your take at around 800 rupees? Do you think the best is in the price?
So your guess is as good as mine. In fact, you'd probably be closer to figuring out what Hyderabad people think about this transaction going through. But, you know, you're right. The capacity that it is at is probably where it makes for a very good acquisition candidate. You know, the sellers probably would not mind selling off, you know, getting rid of an asset that's not optimally sized. And as you rightly said, you know, what they've done in the last 2 years, which has helped scale up, at least on the volume side, is improve distribution, which is a smart thing to do, but the capacity still remains underutilized. So anybody who buys will probably be able to pay a premium on it. We've seen this come in the news many times, and probably, you know, a lot of that has started getting factored into the price, Nigel, and because of the small size, float, and all of that, all those things come into picture. But I would buy it on the anticipation that somebody is acquiring it. But given the M&A wave that we have, and especially very few in the South have been eligible, this does make for an interesting, topic. But we'll of course have to wait for it. Organically, also, cement is looking very strong. I spoke about Shree Cement the other day. I still believe there's a lot of value in these larger players, given that they've expanded at lower metrics, and now the metrics have improved or started improving. So you'll probably see a lot of that activity happen, but it'll probably be post-monsoon.
Okay, all right. The other one that you had spoken about besides Shree in the past has been Welspun Corp. Now that's done well. It's 20% higher from the price that you spoke about it.
Yeah.
Good news in the price or more to come? You know, every time Mr. Trump talks about drill, baby, drill, they'll require the pipes, right, for transportation. So that's why. But how much of it is in the price? After all, this stock as well has given big returns and it's near its all-time high.
No, I think you're right, Nigel. There is a lot of positive tailwinds that have supported the price and supported the business. But I think given the fact that their focus continues to be in expanding within this space, we spoke about that 700 odd, and it's kind of done exceedingly well. So you could somebody could look at booking profits and waiting for some consolidation to re-enter. But my sense is the business is very clearly secularly trending towards a scale which will be very difficult to replicate. All the other players have been struggling with something or the other, either capacities or geographies. They've got both these things right, and not just the Trump administration. I think overall the way gas is likely to kind of start making waves next year when Qatar produces so much of it, and there'll be a host of recalibration in the underlying markets. They will definitely benefit. So they still have an advantage, and that could continue for at least another year or so.
Okay, as promised, it's exchanges all the way in this segment. IEX is the next one we're focusing on. Bernstein's written a note on it. Vivek is here with more details. Vivek, sorry about the short lunch, but take us through IEX.
Well, a quick one over there. But see, a very interesting note coming in from Bernstein, a very timely one. So what basically Bernstein was, or rather the earlier stance of Bernstein was that of an underperform rating. In fact, they had highlighted a few key issues that on the basis of which they actually had an underperform rating. Number one, they actually expected the spot market to have low volumes. And one of the key reasons was that they actually expected very low volumes coming in from renewable energy power producers to come onto the spot market. They actually expected longer-term PPAs as far as the RE developing was concerned. That particular thesis has actually not played out the way they anticipated. In fact, there has been quite a lot of liquidity, sell-side liquidity, that has come in from the renewable energy generators, especially as far as the spot market is concerned. Number two, as far as transaction charges are concerned for the exchanges themselves, in India, they are much higher compared to the rest of the world. And Bernstein earlier believed that this is something that was unsustainable. While they have not clearly changed their stance, they still believe that this is one key risk to watch out for. But so far, it has not played out the way they expected, which has also made them change their stance as far as the stock rating itself is concerned. And thirdly, they continue to have a 50-50 view as far as market coupling is concerned. Remember, market coupling continues to remain the biggest risk. And at this point of time, there is no clarity, number one, if market coupling will be implemented, and number two, when it will be implemented, if at all it is implemented. So overall, on the back of the fact that RE volumes are now on the spot market, they've gone ahead and upgraded their rating. Timely upgrade, given the fact that the stock has seen a significantly steep correction from recent highs.
Okay, Vivek, thank you very much for that. Prakash, just one more exchange your way. IEX, any thoughts?
I think the market coupling decision is still some time away, and you'll keep seeing this vaccine win kind of approach. You buy when there is the bad news for the stock, and you kind of trade on it if you want. But I think from a long-term perspective, at lower valuations, you could kind of live with it. But there's nothing very spectacular which could have. What's going to change, Prashant, is not exchanges on the power side, but it's actually transmission. And there's a lot of work that needs to be done in that. And suddenly, the way you saw this whole bull run in transformers and allied equipment, you'll probably see a repeat of that, given that producers are going absolutely hammer and tongs on the generation side. So I would rather look at some more secular trends which last for 3, 4, 5 years, rather than just an exchange which could get vulnerable to any kind of a new addition of a newer player coming in. It could be any of the larger players who decide to throw their hat in the ring and say, okay, we are also going to get into power futures. So there could be a lot of risk attached to it. I'm not very positive on this one.
Okay, all right. We'll leave it there. Prakash, thank you very much for joining us. Good conversation as always. We'll take a break. We are back with Aditya Sood from InCred Asset Management on the other side. Stay tuned. Okay, welcome back. We've got the market, which of course is doing very, very well. And we've got 25,230, 180 odd points gain. Aditya Sood is with us, fund manager at InCred Asset Management. Aditya, always a pleasure to have you on the program back in Closing Bell. And we've discussed a bunch of things that you own and have liked in the market. So I want to just start with a broader sort of question to you in terms of what you've been doing since the last we spoke, Aditya. Anything you've added, anything you've sold, any action at all?
So I think so the context of the market has completely taken a U-turn, essentially because if you think about markets today, we have not seen risk-free rate coming down or collapsing. The second point is that the risk premia of India within the emerging markets obviously has collapsed, and that is getting reflected in the bond yield differential between India and US. The third point is that, money is moving out of US. Now, if you look at markets, YTD, the best performing markets are in Europe, possibly. We all know what is happening with the Tel Aviv Stock Exchange also. The market itself is up, 30% YTD. So our belief is that, this is a perfect recipe for PE multiple expansion going forward. And it is going to be only a function of, how earnings growth gets delivered. Last 7-8 quarters, we have seen a lot of disappointment, particularly in terms of, earnings getting cut in mid and small caps versus large caps. I think so we are very close to that cycle playing out. So two-pronged approach as far as we are concerned, we are looking at, stocks which possibly have corrected by 30, 40, 50% from peak prices. Not necessarily new ones, the stocks that we already own. For example, Tejas has corrected by close to 50% from the recent high that they made. Newled had corrected, very, very sharply. So did, Indraprastha Medical, close to, sort of a 30% knock in each of these names. These are our top holdings, essentially. So that is one focus area in terms of, sizing these companies well. The second focus area is that, wherever we get earnings growth and multiple year of visibility, I think so Intellect Design Arena, the stock has obviously done well. So we have added as the stock was doing well. Our belief is that going forward, the AI initiative can take this company, to a different level. We have seen breakout in terms of, margin trajectory from 21% to 26% very recently for this company. So our belief is that, it is more going to be a market wherein concentrated portfolios do well. The context of the market has completely changed because from 2001 to 24, we saw 25% earnings growth. Going forward, earnings growth itself is going to be very, very tepid. So if you can construct a portfolio wherein earnings growth is 18 to 20%, and this is what we have precisely done with very minimal risk to earnings, which is 2x of the market earning growth at a reasonable valuation. I think so we'll be better off in terms of, returns going forward.
All right. Hi, Aditya. Good afternoon and good to see you, Ben. What about Religare Enterprises? That's another one that you'll have, I think, close to 4.5% weight. That's the turnaround story. You have a new promoter that's coming in there. Lots of those litigation issues have gone behind. What is the call on the stock from here on? Is it an add at current levels as well? Because I think at its height it was 280 to 90 bucks. Now it's around 220.
So I think so corporate change events, take a lot of time to play out. We have not seen an appointment of a CEO till now. I think so that is one trigger. Care getting listed at some point in time. Care Health getting listed is another trigger. I think so there is a lot of optionality in terms of the broking business that they already have, in the sense that they at some point in time can do wealth management. Religare, by the way, used to have a wealth management, very successful wealth management practice with Macquarie at some point in time. So our view is that, there is very, very little or minimal downside essentially in this name, because Care gets traded in the unlisted market. They own 63% of Care. And at some point in time, Care would require capital. So our view is that, there are enough catalysts which are around the corner in this name.
That offer is done now, or that open offer is on, Aditya? I lost track. The Burman's offer.
Yeah, so that is done.
That is all done. Okay. Basically, it's back at those levels now, right? I mean, I think 230, 240 was the offer price. It's come off now. So to about 223 or so. I think another one that we've discussed, I think last time also, was Tejas Networks under 700, Aditya. This kind of is also a business which feeds into a lot of other industries which are doing well, and all of them. Is this a function of how well it's done in the past, which is leading to a bit of an issue here? So time just correcting?
I think so. It is more of a order visibility issue at this juncture. But our take on the company is that, last year they have done $80 million in terms of R&D spend. Just think about it. How many companies have got this capability of doing a R&D spend, which is purely focused on R&D in terms of, $80 million number? It is more like a $360 million number globally, because in India, our R&D is like 1/4 of the global cost. So that is point number one. Point number two is that, we believe that the NEC tie-up for them is a game changer. In the BSNL contract of these 1 lakh towers, which has now been extended to 1,18,000 towers, possibly there is another talk that possibly it could be extended to 2 lakh towers, because it has been a very, very successful rollout, and BSNL is now profitable. We have seen 260 and 250 crores of PAT flowing through BSNL. So for 2 quarters in a row, they have been profitable. So that is one opportunity. Our view is that this NEC partnership is a two-way partnership. They would be paying a $60 million royalty to NEC of Japan. But more importantly, the go-to-market completely changes in the sense that the core network of NEC is being used by Docomo in Japan, which has got 22 million subscribers. So if you look at, going forward, Tejas can supply the RAN to NEC customers in Europe, in Southeast Asia, in Japan. So our view is that, the TAM is expanding at a very, very rapid pace. The only visibility that the market requires here is order inflow. And I think so. Just think about it, that a company, which was doing 550 crore of top line is now a 9,000 crore revenue company. The kind of bandwidth that it takes, to transform this company meaningfully. If I look at the TAM of the other players in this industry, Huawei is a $120 billion telecom networking equipment giant, and Ericsson and Nokia combined itself is like a $60 billion number. So if Tejas, sort of has to have or even target a 3-5% global market share over the next 3, 5, 10 years, they would have to scale up very, very fast. And that is why they are very aggressively, spending into R&D.
Okay, all right. Interesting times for the stock, Aditya, because the others have got that BharatNet orders. We've been hearing, I think, Sterlite and Polycab, I guess. So their time will be due is what you believe. Is that correct?
The system integrators, Tejas, safe to assume that Tejas has tied up with, enough and more system integrators. So it is only a question of time wherein they get the BharatNet order. BharatNet obviously is going to be a 6,000 to 8,000 crore opportunity. It is very well known. BSNL is an added on opportunity, which is equivalent to 7,500, even if I have to extrapolate 1 lakh towers going to 2 lakh towers. And then there is an element of, BSNL also rolling out 5G in due course in 2-3 year period. And then there is a railway coverage opportunity of 1,000 crore. Now, if you do the maths, everything put together is a 16 to 20,000 crore opportunity for Tejas. The good thing is that there is no competition per se here. So it is pretty much, it is a question of time, when the orders flow in and when they are in a position to execute. But what they have demonstrated clearly is that they were supposed to be executing this in FY 26 to 27, the 1 lakh initial towers for BSNL. They have clearly executed, ahead of time.
Okay. All right. Great. Thanks a lot, Aditya, for joining in. We'll keep an eye on some of these stocks. Some of them brave calls out there. You're seeing some of these stocks have come off the top, but actually, according to Aditya, they're providing good entry opportunities as well. Intellect Design, we discussed. Tejas Networks, and I think Indraprastha Medical, that was the other one we spoke about. Well, for the time being, we'll slip into a short break. On the other side, Nimesh is waiting for us. He's going to tell us what dealing rooms are picking up. Don't go anywhere. Welcome back. As promised, we're getting straight to our favorite segment, D Street Chatter. Nimesh joins us to tell us what's he picking up first in terms of market construct as well as flows. Hey Nimesh, good afternoon.
Hi Nigel, afternoon. So a good day for the markets at days high, virtually at days high, and that's backed by institutional buying as well. So I understand there could be a decent buy number from the institutions today. In fact, there is a small MOC basket buying as well at a leading FI desk. Largely the MSCI stocks is what I understand. So numbers could look much better from an FI perspective. But the bigger rally has come in the broader markets today. The mid cap, the small cap index, and the micro cap index is up 1.5%. And there are a lot of individual stocks which are buzzing and have gained very smartly in today's market. So clearly the focus is shifting towards the small and the micro cap stocks in today's market. I guess we'll see the last leg of PE, the promoter stake sale, in the next couple of days from here on, because the closure of window will start from July. So before that, you will see a lot of block deals and a lot of fundraising happening in the next 4 or 5 days from here on. But clearly, the focus seems to be towards the broader markets, and within that, the small and the micro caps are buzzing in trade today.
Nimesh, in terms of individual names, what's on your radar?
So the first stock is Welspun Living. In fact, I'll talk about both Welspun Living as well as Star Health. Both saw block deals, and then there is a bit of a recovery as well in today's market. For Welspun Living, I understand there was a clean out trade from an FI, and hence a big up move on that stock. Even in Star Health, I understand it's between the FIs to FIs. So the large individual investor has not sold out in Star Health. That's the feedback. So that's the first set of stocks. Second, as I said, there's going to be a slew of block deals until the end of this month. So a lot of names to talk about there. Couple of names which are under pressure today: PB Fintech as well as Angel One. Both are expected to see block deals, and looks like the promoter entity could be selling in both those names. So that's the reason why both stocks are under pressure today. Second stock is Taj GVK. Now this is going to be quite interesting. The stock has been consolidating, but I understand there could be a very large block deal in Taj GVK very soon. The strategic investor is the likely seller, is what I understand, in Taj GVK. So that's something to track there. The third, the new listing which got listed yesterday, that is Aditya Birla Lifestyle Brands. That's picked up in today's market. The volumes are higher on the higher side. I understand some HNIs are buyers as well. But even there, the FDI investor could be a seller, and if they has to sell, has to come before the end of this month. So again, a large block expected there as well. So these are the part of block deals. The third stock on my list is Jubilant Pharmova. After the block, you saw some bit of correction there, but now the rally has picked up 5% up in today's market, and that's backed by FI buying. So expect high delivery volumes there. And the last, and this is interesting, both Interglobe as well as SpiceJet. While it's a correlation to crude and should ideally go up, both are seeing block offers from large institutions. So looks like there is a bit of profit booking now at these levels, especially in Interglobe after the recent rally. And for Interglobe, there is a risk of a block as well, which is impending. So that explains a bit of softness in Interglobe in today's market.
Interesting list of names. Nimish, on Samman Capital, it's up big time. Anything you've heard?
So there are a couple of things which needs to watch out for. The one, of course, is today's delivery data. I understand there is a block bid at a leading FI desk, so need to see whether that executed in terms of delivery buying. And also for Samman Capital, the next big trigger would be, my sense is there's going to be a senior level appointment in Samman Capital. That, to my mind, is still some time away. Looks like it should happen in the month of August. So that's going to be the next big trigger as far as Samman Capital is concerned. So maybe today's move looks like it's on back of some bit of bid offers from large institutions.
This is, for our viewers, the erstwhile Indiabulls Housing.
Indiabulls Housing, correct. So again, we all know that Gagan has been at the head for a very long time. He's going to continue, but maybe there are a couple of more senior appointments which are likely there.
Okay. All right. We'll keep an eye out on this one as well. Thanks very much, Nimish, for that. So that's the list of stocks. Flashes at the bottom of the screen. Cabinet has approved almost near 6,000 crore allocation for something in Jharkhand. I missed the last bit. 3,600 crores for extension of Pune Metro Rail. So lots of decisions coming in from the cabinet meeting. And we'll come back to this in a bit. Mitesh is with us with what to buy today or buy or sell today for a reverse trade tomorrow. Mitesh, what do you have?
Nykaa, I think, is a BTST and Tata Chemicals. So Nykaa is a BTST with a stop just below levels of 202.5 and look for a target of 208 for tomorrow. And Tata Chemicals, the other one. That's the BTST is closing at the day's high. So BTST here with the stop at about 932 for targets of 950.
Got it. Okay, all right. Thanks a lot for that, Mitesh. Well, let's get into Upasana. Phillip Capital has come out with a note highlighting some risk for Dixon Tech, and that's weighing on the stock. Upasana joins in to detail that note. Upasana.
Well, Phillip Capital has highlighted some of the growth concerns on this stock. Now, it has given a sell call. It has maintained this call rather with a target price of 9,085 per share. Now, the brokerage says that the Dixon's largest client, that is Motorola, has begun outsourcing volumes to Carbon. Now, Dixon was Motorola's sole manufacturing partner last year, but this trend has changed this year onwards, in which Motorola is routing some of the volumes to Carbon in current year 25. Now, talking about March and Feb of this year, the outsourcing was minimal, but April and May months have seen nearly 25% of Motorola's monthly volume, which were outsourced to Carbon. Now, brokerage feels that this initial estimate suggests that this figure can rise as high as 35% by June. Even Longcheer, which is the Dixon's second largest client, may also outsource incremental volumes to Carbon, is what they have indicated. Looking at the past trends, Dixon's volumes from Longcheer have gained, but May CY25 onwards, the Longcheer began outsourcing a small chunk, that is nearly about 2%, to Carbon as well. Now, brokerage believes that this could also scale up quickly in the coming months, hence highlighting some of the growth concerns. So on the back of this, the brokerage has reduced its FY27 estimates, revenue estimates by 4%, EBITDA by 6%, and PAT by 9% to account for higher competition in the mobile phone assembly space. So overall, we can see the stock reeling lower in trade today on the back of this.
All right. Thank you very much for that. So keep an eye out on some of these cues. Dixon and Focus 2% lower right now. Now, earlier in the day, I spoke with Benjamin Heelan of Bank of America Securities. Remember that big NATO summit is underway where countries as part of the security alliance are deciding to increase defense spending substantially. We've spoken with defense companies here in India quite a bit over the last many months now, and many have said and focused on and told us that maybe Europe is a potential market and a large growing market. Listen in to Benjamin with some of his thoughts. And if you want to get there quickly, you're going to not sort of make all of it at home. You're going to be buying it from elsewhere as well. US defense contractors, we spoke about some of this last time. Companies out of Korea, for example, I've seen one or two reports how they want to make in Europe. I mean, they're setting up manufacturing within some of these countries, Korea Aerospace, Hanwha, etc. I mean, just take us through your latest thoughts on how your thinking has evolved on this.
Yeah, look, I think that there is a very, very strong buy EU mandate from the European governments, right? The European governments want to make sure that we are investing in and building up the European defense industrial base. And obviously there is a multiplier effect because you're putting capex and employing people in the region. And so, yes, I think what we've seen over the last couple of months, we've seen a lot of JVs announced between US companies and European companies. So there was a Lockheed Rheinmetall joint venture. There was an Anduril Rheinmetall joint venture. And obviously there are a lot of companies looking at putting capex and actually building businesses in collaboration with certain countries in areas like Poland. So you mentioned a couple of them there. So I think that how are you going to be able to gain access to the EU defense industrial base and the defense market here? You need to put money and investment in the region. And I think if you do that, you can be seen as a local player because you're producing stuff locally. And that's what will give you access to the European defense market over the medium term. And I think that theme is going to be very real for India. It's going to be very real for Japan. It's going to be very real for Australia, countries that are looking at building their own defense industrial bases as well. This idea of sovereignty around the defense industrial base, I think is just going to be an extremely core principle of what governments are looking to achieve over the next decade.
Okay, well, that's the view coming in on European defense. Essentially, the point Benjamin is making is, there is strong mandates for all these European countries to buy local. So essentially, foreign companies, if they want to sell to Europe and European countries, they've got to make there. So interesting conversation. Remember to tune into the all-new CNBC-TV18 Prime, and essentially an effort to bring you insights from policymakers, business leaders, and economists. And of course, decoding global shifts and their impact on Indian businesses. Well, we've got all new lineup of programming at 12 noon every day. There is the Global Reset, which airs at 1 o'clock. You've got to focus on commodities, currencies, crypto. We're calling it the Big C. And you've got Global Lens at 8:30 in the evening. Okay, back to the here and now as far as market action is concerned. Bharti, of course, has hit a new high. Earlier today, we spoke with Balaji Subramanian, Vice President at IIFL Capital, and I asked him whether Bharti as a stock continues to do well from here. Here are his thoughts.
If you look at Bharti Airtel, they are at around 245 as of last quarter, 4Q FY25. I would expect them to almost hit 300 rupees by the end of FY27. Which includes, the next round of tariff increase and some, organic upgrading from 2G to 4G data consumption increase, etc., that keeps happening on a regular basis.
Well, let's get in Mayuresh Joshi. Hi, Mayuresh. Good afternoon. What's your take? People were wondering whether Vodafone will survive, not survive. What is the story out there? In the meanwhile, last 3 years, Bharti has gone up almost 3x. Would you believe now it's time to take that punt and buy Vodafone idea, or just stay? You want to play telecom, stick to Reliance, stick to Bharti Airtel?
Afternoon, Nigel. I think we don't like taking punts at markets with India. More or less stay with the short stories where earnings growth probably remains strong. And therefore, I think Bharti as a story is a structural story in play. Obviously, I think the ARPU increases that are expected to happen over the next few quarters will very well continue. And with ARPU increases, you're obviously going to see a lot more happen in terms of both the revenue market share, the subscriber market share being stable. And therefore, I think the kind of numbers that will keep on coming in for Bharti Airtel will be relatively better. The second aspect, obviously, is in terms of their core growth dynamics in key markets itself. And therefore, I think with a lot of capex already having been done, with ARPU increases, cash flows probably improving, the net debt to EBITDA levels are expected to come lower as well, which creates the cash flow support that the balance sheet probably needs. So in our opinion, again, I think it's a structural story. I think the stock has obviously moved significantly higher. But again, I think both Bharti Airtel and Bharti Hexacom, the rating, rankings, institution holding, look very solid, and there looks earning stability in place over the next few quarters in terms of visibility. So I think we continue holding both these stocks, both in our local and global portfolios.
Okay, all right. Mayuresh, I wanted your view on KNR Constructions. The market cap that I saw is, I think, close to around 6,000 crores. The order win is more than 4,000 crores. May not be the ideal way to look at it, but it's telling you the kind of size of the order that they won, and that's why KNR Constructions is now up 10%. Any view on this name or something you like from this space?
So it's a very interesting stock, Nigel. And again, I think that, if I'm not mistaken, there were some regulatory concerns which had cropped up for this one in the past few months. But generally, I think if you look at the order book, I think well diversified, both in terms of EPC, roads, irrigation as well. And therefore, I think if you probably have a construct in terms of road companies, the kind of IRRs that they can deliver going forward, I think that can be stellar. At the same time, if you're looking from a balance sheet perspective for KNR, I think very, very clean balance sheet, almost net debt zero on a net basis. ROEs have shown significant amount of improvement. EBITDA margins have shown significant amount of stability. And I think a large part of the work orders, if they are able to complete before time, I think the kind of completion bonuses that accrue onto the balance sheet are significant as well. So from a balance sheet perspective, healthy balance sheet, it's obviously corrected significantly, as have a lot of other road companies as well, including the likes of PNC Infratech as an example. But I think both these stocks, KNR and PNC Infratech, have all the tailwinds that are there behind them. Good order wins, better margin, and a very, very strong balance sheet.
No, absolutely. 200 points now, 25,243 is where we are now trading at. lots of single stocks which are moving, which we've not highlighted. Maybe I can use a minute or so to highlight some of them, right? So MCX, Saman Capital, etc. we've all highlighted. Kirloskar Brothers is up 18%. So that's a big move coming through on Kirloskar Brothers. We've got Balaji Amines, which is up 13%. I mean, that's a sharp move which has come through here on Balaji. Endurance is up 9%. These have all got very large volumes, by the way. India Mart is up 6.5%. There was, of course, that brokerage call on India Mart. RK Forgings is back up about 5%. The recent high was about 675, 678 now. Bellrise recent listing 6% on this one. Fino Payment Bank is up 7%. So that should come up as well. Alkyl Amine is the other one, 6.5% on Alkyl. And boy, it's really moved last few sessions now. I mean, I think 4 days back was at about 1900. Stocks at about 2350. So that's a super strong move coming through very quickly on this one. EID Parry is another one. 1064, 10% higher on EID Parry. Parag Milk is up about 7.5%. So many names, I can go down, but there's enough volume, by the way. It's not as if Ather is another one. Recent listing 7% on Ather, 341. Solara is up about 17%. It's coming up with large volumes as well. Style Bazaar has got about 11% on it. Nesco is up 7%. Uptown is up about 6% or so. And Ixigo, which is the travel aggregator, 7% higher, 177. No dearth. Barbecue, which is a huge underperformer, 5% on Barbecue right now. So it's really, very vibrant screen out there. 3:1 is the advances to decline ratio. I mean, if you look at what's happening on the NSE. We'll continue the conversation with Mayuresh and touch upon some of these names, but let's take a quick commercial break here. Just leaving you with this market opinion from Sandeep Bhatia, Managing Director, Head of Indian Equities at Macquarie Capital. Hear him out. Come back with Mayuresh.
There's going to be a slow grind up. On the whole, I think we are not in a zone where we will see a major downfall of over 10%. So let's say between 15 to 20%. I'm not in that camp, but it will be a slow grind up. There are positive factors which are helping the market. The only negative I can see is the amount of supply and the quality of supply.
Welcome back. You're tuned into Closing Bell. Well, Mayuresh Joshi is still waiting by. Mayuresh, I wanted your view on Dixon Technologies. Yes, longer term story is good. There's going to be, they have fairly good return ratios. The problem is on the margins. And just a couple of sessions ago, the promoter entity went and reduced some stake a couple of percentage points. Now there's also some diversification from one of their key customers. Stock is down 2.5%. Buying opportunity, or it's way too expensive for your liking?
No, I think it is expensive in the first place, Nigel. And I think we will wait for further declines on this stock. Obviously, I think the product innovations that Dixon is probably bringing about will start accruing results over the next few quarters. But we'd like to ideally see in real earnest how the ODM is probably shaping up. Because as we all know, ODM is where I think the margin improvement will take place on the balance sheet. And therefore, as the proportionality of ODM starts increasing in terms of the product mix and in terms of the revenue share as well, that is where the margin expansion will come from. And as margin expansion starts coming through, I think that will translate into better numbers on the bottom line and better EPS growth. It's not that they are not having stable and strong earnings growth as we speak, but I think for more re-rating on that stock to happen, or for a more structural re-rating, I think that ODM component has to come through. So I think expensive, above pivot levels as we see it, the price action is probably correcting as we see it as well. And therefore, I think we will wait and watch for better levels to probably at least.
Mayuresh, any thoughts on these amine stocks, Balaji, Alkyl?
No, so to a large extent, Prashant, I think the moves have been stellar over the past few days. I think they're moving in terms of expectations that will probably come through. And the expectation largely, Prashant, is that DGTR is expected to approve anti-dumping for acetonitrile. Now, with that probably happens, acetonitrile prices, which have remained muted for a large part of the prevailing few quarters at around 140, 150 rupees on the kilo, because of heavy dumping from Chinese manufacturers, I think that might create a fillip in terms of all these stocks. Again, I think because of Chinese dumping, a lot of products, whether it's methylamine or ethylamine, which is a large part of alkyl, certain elements of Balaji as well, because of their expansion, has come under pressure because of pricing and demand supply issues. So I think it's all, in my opinion, of expectations of their anti-dumping on acetone.
Okay, all right. Well, Mayuresh, request you to stay with us. For the time being, I think we'll just wind down on today's market action. Yesterday, we did slip from around that 25,250 odd mark. Today, we end closer to that mark. So the Nifty goes home with a gain of close to around 200 points. The problem was the star batsman. The Nifty Bank didn't participate today. That was up only around 0.2%. In point terms, was up around 130 points. What did well? Titan, that was back in the reckoning, was up 3.5%. Grasim was up close to 2%, Mahindra & Mahindra up close to 2%, and Infosys, that's the big one in there that did bulk of the weightlifting in today's trading session. On the flip side, you had BEL that came in for profit taking. Kotak Mahindra Bank as well did see some selling in today's trading session. What else did well? Well, from the broader markets, there were plenty of winners. And you had a couple of brokerage calls that actually tickled stocks. So you had India Mart that was up, post Nuvama doing a U-turn on that name. So that stock was up and about. The other one that did very, very well in today's session was MCX, because UBS went ahead and hiked the target price out there. However, Phillip Capital was a little bit cautious on Dixon, and that's why that stock was down close to 2.5% by the time we wound up. From the broader markets, smaller names that did well, you had Sammaan Capital was up 15%, Jai Balaji was up close to around 15%, you had MTNL that was up close to around 10%, and Wellspun Living, as Nimesh said, there was a large trade out there. Stock goes home with solid gains today. What else, Prashant?
No, I think really a day of mid and small caps and so much action and so much activity. You can easily rattle off 10, 15 names with outsized volumes that you had today. And I think you mentioned a few of them. I think on the downside, I'll just take a quick bit because I think it's easier to count the gainers. Defense as a pack really took a breather for I think the second or the third day running. Second day actually, Garden Reach, Mazgaon, that's the index itself which was down 2. Garden Reach, Mazgaon, Data Patterns. You had Paras Defense, Idea Forge. So after again, these have gone up order of magnitudes of many times. So in that sense, in the broader context, larger context, These are small corrections that we really have seen. Lots to talk about, and that conversation on markets will continue on Markets Forward, which comes up in just a bit from now from us on the Closing Bell team. Thank you very much for staying with us, but Markets Forward in just a bit.
The market ends at its highest closing levels of 2025 amidst positive global cues over Israel and Iran ceasefire announcement, while the Nifty ends above the 25,200. The Sensex closes near 82,700. IT and FMCG stocks were among the top gainers today, while select banking stocks were among the top losers.
HDB Financial's 12,500 crore IPO opens for subscription after receiving a strong response from anchor investors. The management tells CNBC-TV18 discussions with RBI on overlap of business with HDFC Bank are still on, even as its operations are completely independent.
And MCX stock surges in trade as UBS maintains its buy call, raises its target price to 10,000 rupees from around 7,000 earlier, while India Mart gets a rating boost from Nuvama as it raises its target price to 3,800 rupees per share. Meanwhile, MGL powers up after Citi's bullish commentary. Well, hello and welcome to Markets Forward, your go-to show where we get you up to speed with all the key data points you need to track for today's trading session and to set you up for tomorrow as well. I'm Nigel, and with me is Ekta. Well, Ekta, it was a rather good trading session today.
Hi, Nigel. Yes, absolutely. Well, we have in fact got all our viewers covered for the next 20 odd minutes with all of the big news and the key developments on Dalal Street. We have the top corporate voices and events to track. But let's kick off the show with what took place in today's market. And yes, it was definitely a very strong day. We closed above 25,200, the best levels in 2025, as the geopolitical tensions eased. So that obviously was the key reason. We had the advanced decline ratio, which was positive. We had IT stocks, which really led from the front in today's trading session. And what was interesting was that the small cap end of the market really gained, giving you a sense in terms of the kind of risk-on sentiment we probably saw in today's trading session. So we had the small cap index, as you can see on your screen, was up around 1.5%, and the India VIX, which gives you a sense in terms of the volatility of the market, was down around 5-odd%, giving you a sense that there is some ease and some comfort which eased into the market in today's trading session.
Well, that's right. Well, here's what we have lined up for you for the next 20 minutes or so. We start off with all the top movers and shakers. Hormus will be joining in to help us out with that. Later on, we'll move to India Mart and MCX, which rallied in trade after bullish calls coming in from brokerage firms, while Dixon Technologies slipped in trade over a brokerage note. Last but not the least, we'll delve into the key market events you need to watch out for tomorrow's trading session. But first up, let's get to our first segment. We have Hormus, who joins us on the big wall to tell us all the top movers and shakers of the day. Hormus, take it away.
A lot better than what yesterday was. We opened higher, stayed higher, ended higher as well. So we'll take back a lot of positives from today's session. And one pocket that did really well today, apart from a lot of others, were the industrial stocks. And look at Kirloskar Brothers, look at Bharat Bijli, all of them seeing double-digit gains. KNR Constructions just a few minutes before close, winning a big 4,800 crore order, ending almost 9% higher in today's session as well. A lot of brokerage notes earlier in the morning, which led to a lot of these stock reactions as well. You just mentioned MCX, a 10,000 rupee price target from UBS, India Mart after an upgrade, Hyundai getting an initiation today as well. It's the highest level post listing that the stock has made today. Indian Hotels as well, and Dixon on the negative side in today's session. A lot of other newsmakers, Exicom Tele approved a rights issue, was up 12%. Surya Roshni and KC International winning orders. Reliance Infra 2 announcing an order win in today's trading session. And some stocks that ended at a 52-week high today. Look at EID Parry, 9% higher on that stock. Nesco, ITD Cementation, Narayana Health making new highs almost every single day. So strong going for all of these names. But the one pocket that continued to struggle today was defense. And profit booking continued here. Look at Garden Reach, 9% lower yesterday, 6% today as well. And a knock taken by BEL, Mazgaon Dock and Zen Technologies as well. Back to you guys.
Okay, all right. Thanks a lot for that, Hormus. Well, those are all the top moves of the day. But let's get our guest in. We have Mayuresh Joshi from Mark Smith India, who joins in, as well as Shrikant Chavan, EVP at Kotak Securities. Hi, gentlemen. Thanks a lot for joining in. Shrikant, first up, coming to you, what do you make of today's trading action? We still didn't manage to conquer the 25,320, which is the recent high that we saw yesterday. But it was a much, much better trading session today in comparison to yesterday. What's your take? Where are we headed from here?
Yeah. Good afternoon, Nigel and Mayuresh and everyone. See, like for Nifty, it is very clear that it is inching up gradually. Although there we are seeing good amount of volatility, the best part is that the market is closing on a higher side on a day-to-day basis. And as Hormuth said, yes, in one word, it is better to say that lot better as compared to previous close. Today's closing and today's formation is suggesting us that the Nifty is heading towards the levels of 25,500, 550 in the near term. The base part of today's trading session is that we saw a good amount of put writing at 25,200 levels. So the supports have shifted from 25,000 to 25,200, and tomorrow is the day of monthly expiry. So broadly, I'm of the view that in case if we see any dip because of any reason tomorrow, then there we should look for taking some long bet in the market. I'm expecting on the day of expiry, we may see the levels of 25,500.
Okay, all right. Well, we do have a couple of stocks in focus. India Mart stock rallied after a bullish commentary from Nuvama and believes that the business is entering a new demand upcycle and that headwinds have bottomed out. Vinny is here to tell us more about what the Nuvama note said. Vinny, over to you.
Hi, so yes, a bullish note coming in from Nuvama, actually a double upgrade because they've upgraded the stock from a reduced to a buy rating. Target price has moved up from 2,100 rupees to 3,800 rupees for India Mart Intermesh. And Nuvama is positive on this one. Why? Because they believe that the company is entering into a new demand up cycle now. They believe that the management has taken the right steps in the last few years, especially reducing the competition coming in on the supplier front. So that is a positive sign there. Other than that, they believe the headwinds have bottomed out from the company and they expect improvement now coming in for the subscriber addition, specifically from Q2 and Q3 FY26 and onwards. That's when we will see higher number of additions coming in for subscribers. They are on the back of this now. They've increased their earnings estimate to 9% by 9% for FY26 and by 10% for FY27. Other than that, they've raised their target valuation from 22 times to 35 times. Mainly, all these reasons indicate that the growth for the company is now coming in and growth prospects are much better, and that is why they're positive on the stock.
Okay, all right, that was flying away. But the other one that was doing well was MCX. It hit an all-time high in today's trading session after UBS issued a buy rating for the stock. Vamakshi joins us with the key highlights. Vama?
Well, Nigel, it's a positive brokerage note that has come in from UBS. They have maintained their buy rating but increased their target price to 10,000 rupees per share from 7,000 earlier. What they're saying is that the company could post a very robust Q1, especially in terms of the average daily value. Now, as far as the futures ADV is concerned, in Q1 so far, it's seen an uptick of almost 50% sequentially. Apart from that, the option premium ADV is also quite healthy, seeing an uptick of almost 30% quarter on quarter, and this roughly translates to a revenue that is a trading revenue of anywhere between 34 to 35% growth sequentially, and a net profit uptick of almost 50% quarter on quarter. Apart from that, they've also highlighted that the new product launches could support growth in the near term as well as the medium term. Conservatively, they're building in 3% revenue contribution from electricity derivatives by FY28 with potential for further upside. In addition to that, they believe that the silver options that they've just introduced could also see some very good traction. Given all of these factors, they've gone ahead and revised their estimates. They're expecting 26% earnings CAGR, and they've also gone ahead and revised their EPS estimates between 13 to 17%. The valuation for the company stands at 42 times FY27 PE, and they believe the markets are not fully pricing in the growth potential from introduction of new products, the operating leverage, as well as the benefits from higher volumes. So therefore, they have given a buy call, raised their target price to 10,000 per share.
Okay, all right. Thanks a lot for that, Vama. Well, meanwhile, Dixon Technologies was under pressure after Phillip Capital maintained a sell call on the stock with a target price of around 9,085 rupees. The note also highlighted that Dixon's largest client, that's Motorola, has begun outsourcing domestic volumes to Carbon in calendar year 2024. Dixon, remember, was Motorola's sole manufacturing partner. The note also added another client, Longcheer, may also outsource incremental volumes to Carbon, which in fact could be a bit of a risk to Dixon. Remember, a couple of sessions ago as well, Dixon's promoter sold close to 2% stake in the company. Let's get a technical view first on this name. Shrikant, what's your take? Dixon, I've seen this in the past. The stock falls very, very sharply, but the recovery as well is quite sharp. How is it looking on the charts? And then we'll go across to Mayuresh for what he likes in this space.
Yeah, Nigel, technically also, if we consider its technical pattern, then it is forming lower top, lower bottom, which is concerning, and it is finding difficulties to sustain at higher levels. So whenever we see such type of activity, most of the time the stock trades at the lowest level of the entire range. The entire range, if we consider, then it is between 12,000 to 17,000. In case if we see the stock is dropping to the let's say the levels of 12,500, there we should look for taking some contra bet of going long, because broadly I'm expecting stock to spend time within this range. But at this level, certainly we should look for avoiding of taking any specific long bet at current levels.
Okay. Mayuresh, what about you? Any technical call on Dixon?
Afternoon, Ekta. No, again, I think for Dixon, I think the structural improvement will only come through the ODM side of the business. Obviously, I think in terms of the earnings trajectory and the earnings matrix itself, they have been executing well over the past few quarters. So execution is not going to be an issue in terms of new clients, the new products that are getting into the PLI schemes announced by the government as a tailwind. However, I think if margin expansion has to happen, that has to happen with the ODM contracts, which is going to take time. They're trying to ramp up their ODM business. Otherwise, it's going to be that mid-single digit business as far as their core operations are concerned. And the valuations that the markets are giving to Dixon at this juncture largely incorporate strong earnings growth expected to come through. But I think the re-rating will only happen as the ODM component starts improving, which is obviously going to take time. So I think we will bide our time on Dixon as we speak.
Okay, all right. Got that call then on Dixon. But let's focus on NSE. They have filed a settlement application with SEBI to resolve the co-location case as per sources. Now, if SEBI approves the offer, it could clear the way for NSE to launch its much-awaited IPO. Yash is the one who's picking up all of those details. He joins in to fill us in with all of that news. Yash, take it away.
Well, Nigel, this is the largest settlement offer put forward to SEBI by any company in the history of Indian capital markets. What we've been given to understand from our sources is that the National Stock Exchange has filed for a settlement application. This is in the co-location matter with market regulator SEBI. The amount or the size of this settlement application is about 1388 crore rupees. As far as this settlement application is concerned, what sources tell us is that it was filed on Friday last week and it is on the desk of market regulator for its consideration. Assuming a situation where the settlement offer, which is in the co-location matter, gets accepted by market regulator SEBI, then in that case, market regulator SEBI's next move would be to give that all-important no objection certificate to NSE, which will enable the exchange to file for the DRHP of its much-awaited IPO. Also, simultaneously, in a situation where the settlement offer gets accepted, SEBI will have to move Supreme Court to withdraw its case against the National Stock Exchange as well. That will happen simultaneously, and once these two things are done, then, of course, it will be a normal IPO process to go about as far as NSE itself is concerned. We've written to the National Stock Exchange on this particular story, but they've declined to comment.
Okay, all right, Yash, thanks very much for that. As HDB's financials 12,500 crore IPO opened for subscription today, we spoke to the company, the MD and CEO G. Ramesh. He says HDB Financial operates independently despite being a subsidiary of HDFC Bank. He also comments on the draft regulations for overlapping business. Listen.
What we believe is that India is a huge opportunity for our business. And just to clarify to our viewers that we are a subsidiary of HDFC Bank, but we do not get any business from HDFC Bank. We are independently an entity. We don't get leads from HDFC Bank or any of the group companies. And that's been since inception. We run our own origination, our own risk management, our own collections, our own technology stack. Essentially, the draft rules came out about 8 months back, right? And the draft rules are really a document that's put out for discussion, which enables the industry to give its feedback. And the feedback has gone back to the regulator, and they're looking at the feedback. And as per the annual report, they're looking at the feedback. As I said, for us, the business is independent of the bank, right? And so very difficult to look at what might be the final circular at this point of time. The reason why we set up this business, independent business, is because we chase a set of customers which are fairly distinct from what the bank does, right? Or from what retail commercial banks in India do. For example, we have 19 million customers and 1,07,000 crore balance sheet, which means that our average ticket size is just about 1,65,000. We only do retail lending.
Okay, all right. Mayuresh, coming across to you, what do you make of this IPO? They've priced it actually attractively. The counter argument will be some of the listed players with maybe a little bit return ratios are available at a cheaper valuation on a price to book. What is your take first on the IPO, and do you believe there's any other stock that you like from this space itself?
I think they have positioned it well, Nigel. No two ways about it. And again, I think the management was very, very clear in the interview that they've probably given in terms of the business outlook going ahead as well. So there is a lot of scope as far as financial services as a domain is concerned. And that part of the business is nothing to do with the bank, but retail lending itself. And as disposable incomes improve quite significantly for India over the next few years, both urban, semi-urban and rural, I think there is going to be significant amount of growth that can probably come through. So I think very, very interesting IPO that is being put out by HDB Financials. I think within the same space itself, I think we continue holding some stocks like Chola as an example of the Shriram Finance as leading NBFCs, where our take is that the growth will continue for both these stories combined together based on the same rationale that we've already put through. And again, I think with better capital adequacies, with better managements, with a better corporate house at the helm, I think the kind of credit ratings that they probably get absolutely reflect in terms of financials. So I think in terms of cyclical times, I think they know how to sustain their business, and in good times, they know how to ride their business. So I think Chola Shriram might actually do well in an upside.
Okay, all right. Well, on that note, Mayuresh as well as Srikrant, thanks very much for joining in and taking us through all of your perspective. We need to take a short break on Markets Forward, but more coming up. Stay tuned.
Welcome back. You're tuned into Markets Forward. Well, let's go across to all the corporate voices that we had today. First up is Tata Motors. The management expected the demerger of both Tata Motors and its commercial vehicle business to be completed by year-end. They added that it expects healthy single-digit growth in the commercial vehicle segment in FY26. And that's not all. It's more bullish on buses and vans. Further, the company is working on an alternate plan as 20% on its commercial vehicles exports goes through the Strait of Hormuz. Commenting on the rare earth curve, the Tata Motors management says there is no production cut expected over this, at least for the next few months.
Next up is REC. The management doesn't expect a significant impact on the balance sheet, as additional provisions will not impact after tax. Further maintains NIM's guidance, maintained in the range of 3.5 to 3.75%. Further expects its loan growth to remain around 12%.
And before we wrap up on the show, let's get you all the key market events you need to track. Vama is joining by to tell us all of that. Vama, take it away.
Well, Nigel, we'll be keeping an eye out on a lot of economic cues tomorrow. The US GDP numbers will be out. Apart from that, also keep an eye out on the initial jobless claims. As far as board meetings are concerned, we'll be watching out for Bank of India. They will be considering their fundraising plans. Nestle will be considering a bonus issue of shares. So both of these stocks will be in focus. Keep an eye out on a couple of IPOs that will close tomorrow, which includes Kalpataru, Globe Civil Projects, Ellen Bari Industrial Gases, and one IPO actually opens for subscription, and that is Indo-Gulf Crop Sciences Limited. So we'll be watching out for all of this tomorrow.
Okay, all right. Thanks a lot for that, Vama. Well, on that note, we'll wrap up on this edition of Markets Forward. We'll be back on the other side with more news and updates. Don't go anywhere.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening: the ceasefire between Israel and Iran appears to hold after the 12-day war. President Trump dismisses a Pentagon report which claimed the U.S. strikes failed to destroy nuclear sites, calling it a perfect mission. The NATO summit kicks off in Netherlands. European nations are set to endorse increasing their defense budget to 5% of GDP. 26 people killed in a fresh wave of Russian attacks on Ukraine ahead of the summit. Strong global cues lift the Wall Street. The Sensex and the Nifty end at their highest closing levels of 2025 so far. IT and FMCG stocks lead the rally.
3, 2, 1, ignition, and lift off.
After multiple delays, the Axiom 4 space mission lifts off. Captain Shubhanshu Shukla becomes the first Indian in space after 41 years, accompanied by astronauts from US, Hungary and Poland. They're scheduled to dock at the International Space Station by afternoon tomorrow. Mukesh Ambani unveils the conglomerate's vision on artificial intelligence in an interview to McKinsey, says Reliance will not go chasing after GPUs and focus on using the existing AI infrastructure to create real-world solutions in healthcare, education, agriculture and energy. Mukesh Ambani says Jio was the biggest risk he took, adding that digitizing India would have been the biggest philanthropic effort for Reliance even if Jio had failed to take off. NSE offers nearly 1,400 crore rupees to market regulator SEBI to settle the co-location case. Sources say NSE could get the green light for its IPO if the settlement offer is accepted. At least 6 suitors submit bids for bankrupt JP Associates. Sources say Adani, Vedanta and Dalmia Bharat Group are among the bidders. Torrent Power could soon enter power distribution services in Maharashtra. The state's electricity regulatory authority expresses satisfaction to grant approval in Mumbai, Pune and Nagpur. Adani and Tata are currently the only private power distributors in Mumbai. Tata Motors will run out of rare earth magnets in a few months, but rules out any production cuts just yet. MD Shailesh Chandra expects sub 5% growth in the passenger vehicle sales this year, citing a slowdown in urban areas. Well, let's start with the market action. Positive global cues helped the Wall Street and the Sensex and the Nifty ending at their highest closing levels in 2025 so far. The Sensex gained 700 points, the Nifty up by about 200 points today, almost 2% higher for both the indices. The mid-cap index continues to gain ground, 260 points higher there, and the Nifty Bank closing 160 points higher this afternoon. Prashant is standing by to wrap up the market action for us. A strong close today, Prashant.
A much better session today. Yesterday, by the way, was also good, but I mean, gains petered out and we ended about 1/3% higher. Arguably, I guess, there was some worry whether overnight there would be violation of that ceasefire, which was announced by President Trump, and missiles will start to fly again. None of that happened. And the market here sort of really picked up from where it left off yesterday and built on gains through the course of the session. So the Nifty ending about almost 200 points higher. Bank Nifty was the underperformer. Mid and small caps, actually the small cap index was the one on your screen, which with 1.5% gains really stood out. And I'll highlight the stocks which moved because there's a long list of volume-led gains today. Sectorally, IT was the winner, just as a group, and defense continues to sort of see a little bit of profit booking. I'll start with the Nifty stocks. Titan was up 3% today. Mahindra & Mahindra 2%. Infosys, Grasim and JSW Steel were the 1.5% plus gainers. BEL, again, defense name, as I pointed out earlier, 3%. That was the, only, I guess, meaningful loser in that sense that you had as far as large caps are concerned. Now we get straight to the broader markets. The biggest volume-led gainer was 63 Moons with a 4.5% gain, but humongous volumes. You had so much else. MCX, 5.5% gain. Samman Capital was up 15%. Kirloskar Brothers, 17% gain. There was Balaji Amines and Alkyl Amines, which were up very, very sharply. India Mart on the back of a brokerage call, 7% gains. RK Forgings up 5%. Bellrise. There was Fino Payment Bank. EID Parry, Parag Milk. And I could go on with many of these names, but it basically, I think these are the 10 or 12 of the top volume-led gains that we had in terms of the session today. So really all about mid and small caps today. On the downside, I mean, I already highlighted BEL from the large cap space, but there were others like Garden Reach, Mazgaon, Data Patterns, Apollo, Paras Defense, which Idea Forge, these all saw some profit booking showing up on that defense index, which was down. Dixon was down 2.5%. There have been some selling from promoters. Angel One was down 3.5%. Chennai Petro, big gains earlier this week, 2.5% lower. And something like a Nelco, Dam Capital, etc. were also down a little bit. But all in all, unambiguously, a very, very positive session today after yesterday's slight hesitation. Back to you.
All right, Prashant Penny, thanks. Well, from equities to commodities, now crude oil prices edging higher today after declining over 10% over the last 2 days. This after investors assess the ceasefire between Iran and Israel. Growing expectations of an interest rate cut by the U.S. Federal Reserve also supported prices. So that's the story there as far as crude goes. The big global story that is moving markets worldwide, the ceasefire between Israel and Iran announced by U.S. President Donald Trump appears to be holding for now. Both countries are publicly committed to the truce, and both Tehran and Tel Aviv claimed victory after that 12-day war. President Trump also doubled down his claim that recent U.S. strikes had completely destroyed 3 Iranian nuclear facilities. This comes after an initial intelligence assessment by the Pentagon, which revealed that the sites had not been destroyed and Iran's nuclear program has been set back by only a few months. Speaking on the sidelines of the NATO summit in The Hague, Trump also described the ceasefire as progressing very well and equated the U.S. strikes in Iran to Hiroshima and Nagasaki, calling it essential to end the war.
We're actually getting along with them very well right now. But had we not succeeded with that hit ended the war. That hit ended the war. I don't want to use an example of Hiroshima. I don't want to use an example of Nagasaki, but that was essentially the same thing. That ended that war. This ended that with the war. If we didn't take that out, they'd be fighting right now. They fought like hell, and then they said, let's stop. And they're going to build themselves. And I really see it as sticking. I mean, we may do papers on it, Marco. Maybe we're going to do papers. I don't even know if you need them. They're not going to be fighting each other. They've had it. They've had a big fight, like 2 kids in a schoolyard. You know, they fight like hell. You can't stop them. Let them fight for about 2-3 minutes, then it's easy to stop them.
A preliminary U.S. intelligence assessment determined that U.S. strikes on Iran's nuclear facilities over the weekend only set its nuclear program back by a matter of months. That's according to 3 sources with knowledge of the matter. The classified assessment is at odds with the statements of President Donald Trump and Defense Secretary Pete Hegseth, who both said that the strikes had, quote, obliterated Iran's nuclear ambitions. Trump has said the attacks were necessary to prevent Iran from developing a nuclear weapon. Iran denies it is seeking such a weapon and says its nuclear program is for peaceful purposes. One source said the initial assessment was not universally accepted and had generated significant disagreement. A U.S. official speaking on condition of anonymity said the U.S. did not know the extent of the damage yet. Still, the preliminary assessment indicated the strikes may not have been nearly as successful as the Trump administration has claimed. One of the sources said Iran's enriched uranium stocks had not been eliminated, and that the country's nuclear program may have been set back by only a month or 2.
Well, that is the latest there between Israel and Iran. Now, Israeli forces have killed at least 31 Palestinians in fresh strikes on Gaza. This includes 10 people who were killed while waiting for food at an aid distribution point. This comes as health authorities said the number of Palestinians killed in the war has now crossed 56,000. The Israeli army has also confirmed that at least 7 Israeli soldiers were killed in combat in Gaza. Meanwhile, 26 civilians have been killed in a fresh wave of Russian attacks across Ukraine. Several were injured in the ballistic missile attacks on multiple civilian sites. This comes as Ukrainian President Zelensky sought guarantees at a NATO summit of further Western help to repel Moscow's invasion. European and North American leaders have gathered at The Hague in Netherlands for the NATO summit. The alliance members are set to endorse increasing their defense budget to 5% of GDP. President Trump praised the defense spending plan, speaking to reporters on the sidelines of the summit. The president also confirmed his commitment to the alliance's core collective defense promise, which he had initially undermined.
We're with them all the way. I mean, if you take a look at the numbers, we're with them. And they have very big things to announce today. I don't know if you've taken the vote or you're going to take the vote, but I've been asking them to go up to 5% for a number of years, and they're going up to 5%. That's a big, from 2%. And a lot of people didn't even pay the 2%. So I think it's going to be very big news. NATO is going to become very strong with us.
There is absolute conviction with my colleagues at the table that given the threat from the Russians, given the international security situation, there is no alternative. We've got to do this. Would you really think that the 7 or 8 countries not at 2% at the beginning of this year would have reached the 2% if Trump would not have been elected president of the United States? Do you really think that, of course, there is a threat from the Russians, China, etc., but that it would be doable to reach this commitment of 5% today? And I'm hopeful and cautiously optimistic we will get there.
Well, the NATO summit underway in The Hague. The big corporate story this evening, Reliance Chairman Mukesh Ambani laid out the group's vision on artificial intelligence and more. Speaking to McKinsey, Ambani revealed that Reliance will not go chasing GPUs and will instead focus on creating real-world solutions. He said the conglomerate has created its own purpose in AI. I quote, "Our big purpose is to solve the complex problems before society and create wealth for the nation and the people. For this, we need not go into the high-risk GPU game. Let's do everything downstream." End of quote. Ambani also revealed that Jio was the biggest risk he had taken so far. He said, and I quote, "At the time, it was our own money that we were investing and I was the majority shareholder. Our worst case scenario was that it might not work out financially because some analysts thought India wasn't ready for the most advanced digital technology. But I told my board, in the worst case, we will not earn much return. That's okay because it's our own money. But then as Reliance, this will be the best philanthropy that we will have ever done in India because we would have digitized India and thereby completely transformed India." End of quote. Speaking about the future, Ambani said he remains confident that Reliance will continue to serve India and humanity well into the future, but he also had a word of caution, saying the big challenge would be the confidence of the next generation to succeed in the new landscape. Now, the NSE has submitted settlement applications to market regulator SEBI to resolve the co-location and dark fiber matter case. Sources have told CNBC-TV18 that the exchange has offered a record 1,388 crore rupees to settle the case. Take a look.
This is the largest settlement offer put forward to SEBI by any company in the history of Indian capital markets. What we've been given to understand from our sources is that the National Stock Exchange has filed for a settlement application. This is in the co-location matter with market regulator SEBI. The amount or the size of this settlement application is about 1388 crore rupees. As far as this settlement application is concerned, what sources tell us is that it was filed on Friday last week and it is on the desk of market regulator for its consideration. Assuming a situation where the settlement offer, which is in the co-location matter, gets accepted by market regulator SEBI, then in that case, market regulator SEBI's next move would be to give that all-important no objection certificate to NSE, which will enable the exchange to file for the DRHP of its much-awaited IPO. Also, simultaneously, in a situation where the settlement offer gets accepted, SEBI will have to move Supreme Court to withdraw its case against the National Stock Exchange as well. That will happen simultaneously, and once these two things are done, then, of course, it will be a normal IPO process to go about as far as NSE itself is concerned. We've written to the National Stock Exchange on this particular story, but they've declined to comment.
Yash, many thanks. At least 6 bidders have submitted resolution plans to acquire the bankrupt Jaiprakash Associates. The bidders include major names like Adani Enterprises and the Vedanta Group. Ritu's here with more. Ritu, what are you picking up?
That's right. Some of India's top corporate houses have lined up to bid for Jaiprakash Associates. And out of the 25 entities that had initially shown an interest, our sources indicate at least 6 have come forward with binding offers, with a deadline ending on Tuesday. Now, the bidders include heavyweights like the Adani Group, Vedanta, Dalmia Bharat, Jindal Power from the Naveen Jindal Group. Also, listed infrastructure player PNC Infratech is in the fray, as is JP Infratech, which is another JP Group company that is now controlled by Suraksha Realty after going through the IBC process itself. Now, JP Infratech, in fact, in a statement to us, confirmed the bid, but they did not share any further details. Now, while the financial terms of the offers are not yet known, some of the bankers we've been speaking to tell us that 12,000 crore rupee offer that was made earlier by the National Asset Reconstruction Company to acquire JP's stressed loans from banks could be used as a benchmark by the bidders. Some even expect the offers to be lower still with the ongoing litigation around the company's land in Noida. But that said, this is a major milestone in what has been a protracted insolvency process, because remember, JP Associates was first flagged by RBI in its second list of large defaulters back in 2017 and only admitted to the insolvency court last year. It is the flagship company of the JP Group with interests across real estate, hospitality, cement, engineering and construction, and is now facing claims of more than 57,000 crore rupees. So all eyes are now on how the bidding process will unfold, especially with these high-profile names in the mix.
All right, Ritu, many thanks. Now, Torrent Power could soon enter power distribution services in Maharashtra. The state's electricity board has expressed satisfaction to grant approval in Mumbai, Pune and Nagpur. Remember, Adani and Tata Power are currently the only private power distributors in Mumbai. Vivek joins us now with the details. A third private player in Mumbai. Vivek.
That's right, a very interesting, important development as far as the power sector is concerned, and some good news likely as far as consumers are concerned of power companies as well as of supply of electricity itself. So what's actually transpired in the last couple of days is that MERC, which is the Maharashtra Electricity Regulatory Commission, has gone ahead and expressed satisfaction for granting approval to a company called Torrent Power. This is for parallel DISCOM services in 3 key areas. Which are these 3 key areas? Pune, Nagpur as well as Mumbai metropolitan region. What this essentially means is, in case this particular proposal does go through and in case there is no opposition, you would see Torrent Power also as a supplier of electricity in the MMR region along with Pune as well as the third region, which is Nagpur. Now, what has actually transpired is that MERC had received a proposal from Torrent in December 2022. Torrent Power had claimed a capex of close to 15,000 crore for setting up DISCOM services in Maharashtra. After quite a long period, MERC now doesn't have an issue. However, remember, on July 22nd, there will be a final public hearing or a final petition that will be held, which essentially will decide whether or not Torrent Power can go ahead and set up DISCOM services in Maharashtra. What is the implication of this significant development? First, let's have a look at the implication as far as the power space and power companies are concerned. Remember, parallel license distribution basically implies that companies can now look forward to a diversified as well as a steady income stream. Along with that, remember, whenever a privatization of DISCOMs has happened, especially if you look at Odisha, Tata Power has seen a steep reduction as far as AT&C losses. So it improves, number one, the network itself, and number two, also improves earnings visibility as far as power companies are concerned. What does it mean for the consumer? Well, it's very simple. For the consumer, you get another option as far as choosing your service provider is concerned, and at most times, higher competition could also mean you get a slightly lower electricity bill in the future.
All right, Vivek, many thanks for joining us. We will head to a break, but up next, after multiple delays, the Axiom 4 space mission lifts off. Captain Shubhanshu Shukla becomes the first Indian in space after 41 years. That and more when we return. The Axiom 4 space mission carrying Indian astronaut and group captain Shubhanshu Shukla is on its way to the International Space Station. The mission took off from NASA's Kennedy Space Center in Florida's Cape Canaveral. The mission had faced multiple delays because of weather and technical issues. In his first message from the mission, Shukla said, and I quote, "This is not the start of my journey, but the start of India's human space program," end of quote. Captain Shukla becomes the first Indian in space since Rakesh Sharma in 1984. He'll also become the first Indian to visit the International Space Station. Group Captain Shukla is being accompanied by astronauts from US, Hungary and Poland. They will spend 2 weeks at the International Space Station, which is a permanent research facility orbiting the Earth at an altitude of 400 kilometers. Group Captain Shukla's parents watched liftoff from their residence in Lucknow. From President Murmu to Prime Minister Modi, political leaders cutting across party lines extended their wishes to the mission.
3, 2, 1, ignition, and lift off.
मेरे कंधे पे मेरे साथ मेरा तिरंगा है जो मुझे बता रहा है कि नहीं हूँ, मैं आप सबके साथ हूँ। आइए हम सब मिलकर भारत की इस ह्यूमन स्पेस प्रोग्राम की जर्नी की शुरुआत करें। धन्यवाद। जय हिंद, जय भारत।
बहुत बड़ा गर्व है हमारे लिए आज का दिन, जो इतिहास में याद रखा जाएगा। बात अभी हुई थी, अभी सुबह हुई थी, निकलने के पहले बात किया था हम लोगों से कि मैं निकल रहा हूँ मम्मा। बात करके गए हैं आज।
बात करके गए हैं।
हाँ, आशीर्वाद लेके गए हैं, दही पेड़ा खिलाया, वो खा के गए हैं दूर से।
To the crew, Godspeed, and spend as much time as possible to look out of the window.
Well, the Axiom 4 spacecraft will take 28 hours to reach the International Space Station. It's expected to dock tomorrow afternoon India time. The mission is being carried out using a SpaceX Falcon 9 rocket. It's completed 16 missions so far, carrying astronauts to space. It has a perfect safety record. Axiom 4 is a big step towards India's Gaganyaan mission, which aims to send a crewed mission to space. ISRO is coordinating with NASA, and Captain Shukla will conduct crucial research to facilitate the Gaganyaan mission. So what exactly will Group Captain Shukla do in space? Will he study the cognitive effects of screen use, microbial adaptation, muscle atrophy and crop resilience in microgravity, among other things? Well, we will keep you posted right here on CNBC TV18. With that, it is time for us to wrap up this edition of Business 360. The news will continue after this very short break. Stay tuned. We're back in a moment.
Let's Talk Money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Now, the 28th of June is known as World Insurance Day, and perhaps what could be a better occasion to talk about the insurance landscape in India. What are the key points to keep in mind before buying insurance, and how does one pick perhaps the most suitable policy, keeping in mind our own personal finances, our other personal obligations that we need to contend with? To talk about this and more, we have with us on the show this week Priya Deshmukh of ICICI Lombard and Ashish Vora, who is from Reliance Nippon Life Insurance. Ladies and gentlemen, thank you very much for joining in and taking out the time. So we thought it's a good time to bring you people on board. Priya, of course, looks at the health insurance space, and Mr. Vora looks at the entire gamut when it comes to life insurance, to really talk about where we are, the steps we've taken, and what the customer, the policy buyer, can look forward to from the industry. So welcome to the show. I'll open the floor with Priya. Priya, your first thoughts seeing the evolution over the last few years.
So thanks, Surabhi, and it's a great pleasure. So over the last couple of years, things have really changed. And, at the backdrop of COVID, we've seen people being very aware. Things are changing in the landscape of health and healthcare, so to say. But even after that, even after being propelled by COVID and the patterns of, health conditions, we haven't seen much, penetration. The penetration still is in the range of around 3.5% to 4%, as against a global benchmark of around 7 to 8%. And thereby there's a large, insurance protection gap, so to say, and people still continue to pay out of pocket for their healthcare spends. So huge amount of opportunity, huge amount of innovation happening in the industry, and loads of option and personalization avenues for the customers. That's what I would say, Surabhi.
Absolutely. And I think the learning curve has been pretty steep, especially after the pandemic. And I think everyone realizes the need to have sound health insurance policy. That point is completely taken. Let me ask Mr. Vora as well, who's, of course, the CEO at Reliance Nippon Life. Mr. Vora, what would you say? Because when we talk life insurance, then the conversation is always a little more complex. Then we always get into the debate of whether you should only look at life insurance from a protection perspective, or should you look at meeting other objectives, investments, retirement planning, etc., through an insurance policy. What would your opening thoughts be?
Right, thank you for asking, Surabhi, and let me sort of give a straight answer to what should be looked at in the life insurance space. And I often hear this comment, it is complicated. There are many kinds of products. It makes a long time to understand and all. But let me sort of simply say that life insurance for over 100 years has served the same two big needs, called addressing the risk of dying too soon and the risk of living too long. So at a fundamental level, these are the two basic needs, or the two risks, that life insurance protects the consumers from. Of course, there are several product forms and variations and terms and retirement and all of that, and we can talk a little more about that. But to your earlier question on penetration, the country sits at about a 2.8 to a 3% kind of a penetration, and you could say that we are equal to the world. The world is roughly at 2.9%, but then the question is, we as Indians, we as forward-looking countries, who should we compare with? And you look at South Africa, it sits at over 9%. You even look at Malaysia or Thailand, they sit at over 3.5%, 4% kind of numbers. So I would argue there is a reasonable headroom for us to grow. The good part, again, while awareness numbers, you're displaying, they are what they are. However, 17% of total financial savings of households now sits in life insurance. The total AUM, or the corpus of the whole life insurance industry, is over 60 lakh crores. So it's quite substantial. What will drive growth? I do think there is a fair amount of regulatory push and simplification of products and empowerment to life insurance companies to make, use, file, modify products quickly. I also personally think it is the tier 3 and 4 where the opportunity lies at a significant level. My own belief and our company is really driving more towards the tier 3, 4, where penetration levels are lower, an opportunity of a significantly higher order.
Okay, points so well taken. But let me pick up on the life insurance piece in a little more detail first. And here, Mr. Vora, like you said, while the penetration levels, at least at a world average, it seems okay, we're not too far behind. The question always is that you may have insurance, you may have a policy, but do you have enough insurance? Does it really protect you or not? And that's where, historically speaking, I mean, we are not a country that's been used to buying a pure term product, not getting anything back, and just paying every year to ensure that if that unfortunate event happens, our interests are taken care of. So where are we on the learning curve in terms of pure protection in ensuring that we have not only an insurance policy, but we have the right policy with the right coverage?
Now, there isn't a singular answer to that. And like we began talking, there is a variety of risks that the life insurance covers. And there is a variety of ways in thinking about it. And let me just give you one frame of thinking. What we see customers is that when they are younger, and let us just take the first 10 years of working, the savings are of a little lesser order. Protection requirement or need or understanding is of a particular order, especially urban India. They tend to begin by buying a term product, especially in the last 3-4 years. And the next 10 years of working, you have a higher corpus. You become aware of need to accumulate. You also have a family, and you need to sort of, you think of growing your savings in a particular manner. You want to expand your basket. You have other financial instruments, and you look at life insurance products to do other things for you, accumulate for you. And then comes this distinction called what is your risk appetite. And more often than not, people like to bundle term along with a ULIP if they are market savvy customers, or they tend to go in for guarantees. And then comes the last 10 years of working, maybe where retirement becomes important. So sometimes people bundle it with term. At other times, they don't. They buy a deferred annuity or a pension kind of a product, which honestly is one of the great ways of living a risk-free retired life, of having a lifelong annuity coming to you out of a deferred annuity kind of a product. So we meet all these three life stages, and we meet customers with different risk appetites. I don't think there is a singular answer to say what is right or what is wrong. As long as customers are taking financially sound decisions in dialogue with the right advisor or the right institution, I think they will take the right call.
And just for our understanding, among a lot of the various product categories that you described from an industry perspective, which is the one that has been growing the fastest, say in the last 1-2 years, and which is the one where you see maximum growth in the near future as well?
Again, if you look at urban versus you look at the tier 3, tier 4, the answer is a little different, and depends on what kind of target market you are serving. But the top two dominant categories would be the traditional and the ULIP side. So it's more the savings business or the investment business. These words are used interchangeably. The term is a relatively smaller part of it. So like you began to say, Indian consumer appears to predominantly save or invest, and along with that prefers to buy a term cover that comes along. Of course, when you look at the consumer between 20, 25 or 22 to 30 urban, the trends tend to be a little different. I would argue that in the next 10 years, term would be a higher proportion. But yeah, at the moment, pure term is maybe 5% of the total industry, and 95% is bundled in some form or the other.
In terms of some of the other savings products, got that point. So that just kind of lays out the scheme of things as of now, the landscape, so to speak. Let's also talk about health insurance, because there's a lot of product innovation going on. I mean, we're really almost spoiled for choice. Over the years, we've seen health insurers offer plans with covers as high as 1 crore. There are plans for almost everything, for OPD services, for even maternity, typically things that were not covered earlier by health insurers. So Priya, shed some more light on this in terms of, because again, there's so much choice in the market. What are some of the kind of products that investors, or rather customers, must definitely keep in mind, given the fast-changing landscape within health insurance?
Sure, Survey. And basically, over the last couple of years, there's been a lot of regulatory, support and lot of innovation that has come through. And with that, huge amount of personalization, huge amount of innovation has happened in the product creation and product delivery side of it from a health insurance perspective. Talking about health insurance, really, it's a living benefit. Through your life cycle, you go through various stages of your life, and your health insurance product needs to really walk along the side as you, kind of move through the continuum of your life stages. And with so much of innovation, so much of personalized products being, created over the last couple of years, there's immense amount of options that are available. And lately, we've also seen, modular chassis products being built, where you have a core product offering that caters to the need of basic core health insurance requirements. But over and above that, other add-ons can be added, other riders can be added, which could really suffice the need of somebody who's going family way, somebody who's really living with a condition, and somebody who may have certain other, requirements. So I guess immense amount of flexibility has been built in. The power is in the hands of the insurance companies to create this innovation. And with that, the whole gamut is open for the consumers to make choice, that really fits in these myriads of options that are available. Now,
so, okay, Priya, but Priya, simplify it, because I know, we want to keep it very simple, not from the product head perspective, but you tell us, personally speaking, which are the 2 or 3 very interesting new products in the market, which you personally, for friends, for family, would say, please look at it, isko dekho, beyond just covering your hospitalization expenses?
Sure, Surbhi. So that's the point I was coming to. Basically, a consumer would need, for example, if I'm a customer as well, right? If you're buying an insurance, it needs to be very, very simple to understand, very transparent, very clear on what it covers and what it doesn't, and what is the cost at which I'm buying it, and what's the kind of value for money. So I would say, if as a customer, I would look at what is the kind of base sum insured, what is the value of that base sum insured compared to the healthcare spend. So if you look at a, hospitalization expense for critical illnesses, like a heart, cardiac bypass, or maybe a stent surgery or a liver transplant, and even, smaller appendix surgery. Typically, these surgeries would cost, much, much lesser in the last, 5 years ago. Now the cost has increased around 15 to 20%. 15% is annualized inflation rate. So the cost of treatment has gone up. So having a cover that covers your basic expenses for basic day-to-day, kind of ailments like fracture, fever, any kind of appendix, any kind of other conditions which are, cannot be planned for. Second of all, critical illnesses, major organ, challenges. So buy a sum insured that is relevant and remains relevant over the next 5 to 10 years. That's what I would say. And I would look for myself. If I'm a value conscious customer, trying and buying not too many add-ons, but the core, product offering would be my lookout. But if at all I'm a very fitness kind of a aware customer, wants to really have, gymming, yoga, other fitness kind of activities, and those activities coming back to me as rewards, because at the end of the day, my insurance, if I can use to do activities and remain healthy, and gives me back some rewards that can be availed in terms of redemption, either in the way of getting discounts on my renewal premium, or helps me redeem in various wellness services. That would really excite me. So those are newer options that are coming up. There are multiple products in market, but as I said, modularity and giving the power in the hands of the customer rather than having a very, very cookie cutter, fixed model that this is your health insurance, this is what it covers, it doesn't cover, and this is the price for it. I guess that has changed in the last couple of years, and there are multiple products. We can talk about my company, couple of other players are also offering such products. I would say that's the change we have seen with the innovation coming in, Surbhi. And as you rightly said, simplification, transparency, knowing what you're buying, making sure that you buy not only for 1 year, but that product remains, viable or is, sufficient over the next couple of years is what we have seen as a trend that is coming.
So absolutely, health insurance is going through, major changes, and there's all kinds of products in the market. You just have to go and look carefully. Ask your advisor, or if you're on a digital platform, just look carefully and you'll find a solution for your needs. Let me ask, Mr. Vora also about this. Even on the term side, Mr. Vora, where the penetrations are low, but you expect this to pick up. Correct me if I'm wrong, I think now insurers are looking at more flexible products, some which are even willing to offer the premium back or return of premium, so to speak, if you survive the policy term. So what is a further innovation we can expect in very plain vanilla term insurance?
Yes, I'm trying to use my words carefully so that it is definitely fitting the simplicity bucket. So the term return of premium, or ROP as we call it in the industry, is not really a new product. It's been around for a while. My company has had it for nearly 5 years. So again, it is serving the sentiment of the customer who says, "Paisa de diya, वापस कुछ नहीं मिला." And this is a strong sentiment in a part of the country that what happens if I don't get a claim or if I don't have anything to get back from the company? It looks like a wasted expense. So the term ROP came in to answer that question. But term has other variations also. It is not just ROP. There is a variant called I want a cover for 20 years or 30 years, but I wish to pay only for 5 years, or I wish to pay only for 7 years. So you can play with we call it a premium paying term. Can be varied. You pay a higher amount for a fewer number of years and we cover you for a longer period. There are other variants in the market called the benefits in case of a death claim are not paid immediately. It is paid in a pre-programmed manner to the survivor or to the family over a 4-year period or a 5-year period, so that it looks like an income kind of a design. So there are various kinds of options that are available, and you should expect the term market to continue to move in that direction. It is actually quite a simple to understand product. There are other products which I would argue are complicated. But this one is a simple to understand product. You can buy it with some riders, with critical illness riders or without riders. Those are all choices. They are modular in that nature. And again, with a good advisor or a good call, some expert on call, you should be able to make these choices fairly simply. And in this business, what you see is what you get. What becomes most important is to look at the insurer's history in terms of claim payment rates and things like those. Bulk of the industry is now 98, 99%. My company is also at 99%. So those become important considerations to say, who am I buying from?
Absolutely.
With that, I think term is rather simple to understand. I'll give you a different answer on the more complicated products, though.
Now, I know, and simple is always beautiful when it comes to financial products. And typically, the simpler products, cleaner, transparent products tend to, do really well.
They're all medically underwritten products, by the way. One thing that comes in the way when it comes to term is now bulk of the market is offering medically underwritten products. So you do have to go through a medical exam, unlike the health side, which is where the underwriting is on the rear end. These were a front end. And there are some designs in the market where term is now being bundled along with ULIPs. We have a design which is called a WIN. Now that helps us give up to a 50 lakh kind of a cover to the customer without really pricking him. Now that kind of a design is not term. It is basically a ULIP chassis and you've added on a term product to it. But it is quite acceptable to customers. You answer the problem called, what am I getting back? The ULIP is a very well-performing, kind of a product. And on that, you load a high amount of term.
A higher sum assured as well, to take care of your protection needs. Yeah, absolutely. Take your point.
Take care of your protection.
Yeah, and that's been the critique. I mean, since I have a lot of independent advisors also coming on the show, the one critique always has been nothing against ULIPs or savings products, but are they actually addressing first your fundamental need for covering your family and your sort of loved ones when the time comes? And I think some of the innovation that you described answers some of those queries. We need to take a very quick break, but when we come back, a final quick checklist from both our experts, what to do to ensure that we are buying the right insurance and that our claims get honored. What should we be aware of from the customer side? Back in a moment with that.
Let's talk money. Let's Talk Money.
Welcome back. You're with us on Let's Talk Money. And as the world marks World Insurance Day this weekend, we have two experts with us to help us understand the innovation that the industry is going through and what we need to do to ensure that we are buying insurance correctly and ensuring that we get those claims when we need them. So, that's really bringing us to the close of the conversation. Priya, let me come to you very quickly. Your health insurance checklist for all the customers out there.
So, Survey, basically, buying a health insurance sum insured, which keeps my needs not only immediately but over the next few years in view. Looking at what kind of exclusions, inclusions, what is the network that is covered, any kind of limits, sublimits that are existing in the policies. That's what I would like our viewers to really check. Talking about wellness features, any kind of other features that could really play a role, in additional add-ons and riders that may come, as a package that we can build in. Buy early, buy comprehensive, coverage. Buy at a time. We have long-term tenure products, 3 years, 5 years. Getting the products upfront and early could really be very, very beneficial for the customers. Disclose the health condition, any minor or major or any kind of condition that is existing. Disclosing that really makes it very easy because makes it very transparent for the insurance as well as the customer, so to say. And making sure that there is value for money. There's not really the cheapest, the best, but looking at value for money and the long-term perspective. Look at the history of the insurance company in terms of claims, history, claims payouts, any kind of customer stories, reviews. Those kind of things is what I would like to mention, and the ease of claiming as well.
Okay, all right, got that point. Let me come to Mr. Vora now. Mr. Vora, again, I know that this is not a sort of a one simple answer because it depends on whether you're buying for protection or for ULIP or savings, or depending on the product. But generally, what are the thumb rules that you'll want to put on the table?
Could be a customer on an average will take a life insurance policy decision 7 times in his lifetime. So in his policy buying tenure of 30-35 years, roughly every 5 years, he will buy a life insurance policy, often on a life stage, a marriage, the birth of a child, a house, and things like those. The customer should be very clear about what is the purpose of the policy he's buying. Because remember, he's not really going to be able to change it very efficiently, unlike several other general insurance categories where next year you could take a different call or a different decision. This is a very important decision because he is going to stick with that decision for a long time. My largest selling category is a 40-year plan. So he has to stick with the decision that he's taken. So if he's clear about pure protection need, then there are the choices that we discussed. If he's clear that he really does not appreciate the expense without a return, then it is a bundled offering that he must buy. Then the checklist says, where do I want to save? How much do I want to save? And what is my time horizon? Really, that is how the checklist really looks like. Sometimes the checklist needs to include what is the liquidity that is available on the product if I need money along the way. Therefore, those 4 or 5 considerations coupled with the risk appetite. Am I the kind of person who is comfortable with the equity market? And if you really take the last 5 years, the equity market has given fantastic returns. Or I'm not. I'm really the guarantee kind of a person. And I believe that I'm taking an investment decision for the next 40 years. I think interest rates in the market are going to be going down. So I'd rather buy myself peace by investing my money in a fully guaranteed product that assures me returns and life cover. So if these clarities exist and there is a good financial advisor to discuss with, because they're a little complicated calculations, I think the right decision can be taken.
Okay, all right. So know what you want and know whom to discuss these products with, and then take an informed call. I think that's the takeaway, and we've completely noted that. Thank you very much, both of you, for joining in and shining a light on insurance, some of the critical needs that we have, whether it's life or health. Hopefully, it'll help our viewers make more informed choices as well. Thank you for joining in. Well, with that, we're out of time on this edition of Let's Talk Money. Keep sending us your feedback, comments, and queries. We'll see you again next week.
Let's Talk Money.
Hello and welcome to News Center with me, Parikshit Luthra. The big story. The Axiom 4 space mission carrying Indian astronaut and group captain Shubhanshu Shukla is on its way to the International Space Station. The mission took off from NASA's Kennedy Space Center in Florida's Cape Canaveral. The mission had faced multiple delays because of weather and technical issues. In his first message from the mission, Group Captain Shubhanshu Shukla said, and I quote, "This is not the start of my journey, but the start of India's human space program," end of quote. Group Captain Shukla becomes the first Indian in space since Rakesh Sharma in 1984. He will also become the first Indian to visit the International Space Station. Group Captain Shukla is being accompanied by astronauts from the United States, from Hungary and Poland. They will be spending 2 weeks at the International Space Station, which is a permanent research facility orbiting the Earth at an altitude of 400 kilometers. Group Captain Shukla's parents watched the liftoff from their residence in Lucknow. From President Murmu to Prime Minister Modi, political leaders across party lines extended their wishes to the mission.
3, 2, 1, ignition, and lift
मेरे कंधे पे मेरे साथ मेरा तिरंगा है जो मुझे बता रहा है कि नहीं हूँ, मैं आप सबके साथ हूँ। आइए हम सब मिलकर भारत की इस ह्यूमन स्पेस प्रोग्राम की जर्नी की शुरुआत करें। धन्यवाद। जय हिंद, जय भारत।
बहुत बड़ा गर्व है हमारे लिए आज का दिन, जो इतिहास में याद रखा जाएगा। बात अभी हुई थी, अभी सुबह हुई थी, निकलने के पहले बात किया था हम लोगों से कि मैं निकल रहा हूँ मम्मा। बात करके गए हैं आज।
बात करके गए हैं।
हाँ, आशीर्वाद लेके गए हैं, दही पेड़ा खिलाया, वो खा के गए हैं दूर से।
To the crew, Godspeed, and spend as much time as possible to look out of the window.
The Axiom 4 mission will take 28 hours to reach the International Space Station. The spacecraft is expected to dock tomorrow afternoon, India time. The mission is being carried out using a SpaceX Falcon 9 rocket. It has completed 16 missions so far, carrying astronauts to space. It has a perfect safety record. Axiom 4 is a big step towards India's Gaganyaan mission, which aims to send a crewed mission to space. ISRO is coordinating with NASA and Captain Shukla will be conducting crucial research to facilitate the Gaganyaan mission. So what exactly will Group Captain Shukla be doing in space? He will study the cognitive effects of screen use, microbial adaptation, muscle atrophy, and crop resilience in microgravity, among other things. To take this forward, I'm now joined by a stellar panel of experts. We're joined by former project director at ISRO, Raju Garudachar, and the president of India's Satcom Industry Association, Mr. Subba Rao. He's also the CMD at Anand Tech, which designs systems and subsystems from ISRO. Also on the program with us is Mr. Somak Ray Chaudhary, who is a professor of physics at Ashoka University. Thank you very much for joining us on the show today. Professor Subba Rao, if I can begin with you. A big day indeed for India. Could you give us a sense of what really means for Shubhanshu Shukla, Group Captain Shukla, and also India's own space program?
Yeah, thank you. In fact, today is a great day for India. That, Group Captain Shubhanshu Shukla going into the space, that is a great day and a very, very memorable day for us. The experiments that we're going to conduct are going to be extremely helpful for India in terms of growing the seeds in the microgravity area and also looking at some other experiments like, muscles related activity and also touch screen related activity, which I mentioned just now. So like this, very many experiments is going to conduct on that. This is something very prior to our own Gaganyaan program tomorrow. And our Gaganyaan program tomorrow going to be something very, very extraordinary program. And for this, Shubhanshu Shukla's program today helps to lead towards that into the part. And it's a great day that we had it today. And we must, all Indians, 140 crore population of Indians, all Indians, Bharatiyas, wish very good best wishes to Shubhanshu Shukla. And we also join. Thank you.
Right. Dr. Raju, if I can come to you at this point, could you give us a sense of how complicated was this mission? The next 24 hours, of course, important because they have to reach the International Space Station. The lead up, we saw a number of delays, glitches taking place. Could you give us a sense of what must have gone into it, why these delays happened, and what makes this so complicated?
See, any space launch is unique in itself. No one launch is repeatable in another way. Therefore, one has to take zero defect policy. There was some kind of an alert when there was a leakage of liquid oxygen, and certainly it's a very dangerous thing. It may cause explosion, and we don't want to take, nobody wants to really take risk because when human lives are involved. So this happened several times, and I think they have repaired everything. That's how it got delayed. Secondly, there was a last-minute problem like wind. Wind has to be favorable for the launch. Normally, in the launch pad area, we'll have a wind profiler. It will tell you the direction and the magnitude of wind blowing. How is it helping the launch? The rocket has to take the correct angle for launching. So this is another thing. Apart from the meteorological conditions, which are not a major problem, however, the one has to keep track of meteorological condition, even though it is raining, but wind is a major, spoil shot, which can trouble the launch event. So these are the two major, apart from the oxygen leakage and all that, there are 6 different reasons. We don't know what the details of those, but what is reported is that there was a leakage in the oxygen container, and certainly it's infinite. Those are the major defects, major impediments that delayed the mission. Thank you.
All right. Let me also get in Professor Somak Ray Chaudhary. Professor Chaudhary, there are 7 India-specific experiments that Group Captain Shubhanshu Shukla will be working on. Could you give us a sense of the importance of these experiments for India?
So, experiments like these are biological experiments mostly, but there's some technological ones as well, which have been done in microgravity experiment environments over the years. But in specifically this time, there are some Indian experiments that have gone up, particularly with Indian PIs from Indian institutes and labs that Shubhanshu is going to perform in zero gravity. Some of the experiments are like as follows. For example, there are experiments to do with cyanobacteria, for example. These bacteria are very prolific in producing very interesting compounds on Earth, but they can produce, for example, out of waste material, produce oxygen or produce some chemicals that can get rid of waste material that are produced in a closed environment. So these things are very important in the future when we will have our own space station and we would want to generate oxygen or actually break down waste materials within the space station. And how these bacteria work is very important for us to study. And so an Indian experiment has gone up, which is looking at that. There are other things, for example, looking at how muscles behave in zero gravity. As you remember, when Sunita Williams and co came back, they were very unable to stand on Earth as they landed back. When you spend a lot of time in zero gravity, your muscles change in a very different way. So there's an experiment that looks at how muscles behave on long term in a zero gravity situation. This is also very important for us to understand, even without astronauts being involved, as aging progresses, we want to know how muscles change, right? So that kind of stuff. And another thing they're doing also is looking at food stuff in these experiments. They have taken up some Indian foods like sprouts of Indian beans and things like that, and how they grow in zero gravity. So there are some very Indian specific experiments this time.
All right, so that, of course, will be interesting. Let me go back to Professor Subba Rao at this point. Professor Subba Rao, I think one thing that a layman in India who's watching television very proudly would like to know what Group Captain Shubhanshu Shukla and the other astronauts in the Dragon spacecraft would be doing over the next 15 days or so. Could you give us a sense of what's their average day going to look like?
Yeah. See, as my predecessor mentioned just now about various experiments that are going to be conducted in space. No, one important thing is, they carried something like a seeds of the green gram. So that pulses, whether they can grow them in microgravity. Because in future, when you get into Moon or Mars or another location, how do we grow food for ourselves on that? That's important. So towards that, the experiment is being done. But more than these experiments, anything part of it that can be done. But it's more inspirational for the Indians that we also can do. So that's what is going to be the message that Shubhanshu Shukla is going to give to all Bharatiyas, to all Indians on this now. That's most important part of it.
Right.
I just want to recollect that when we landed on the moon, on the South Pole, so it's not a success of just a program alone. How it inspires the entire Indians that we also can do, we can become the superpower in this area. That is what the message that this Shubhanshu is going to give to all of us. And that is what we are going to have, and the inspirational one from him. So we wish success. Thank you.
Okay. Professor Chaudhary, if I were to ask you before we move on to our other guests, what would be in this for India's private sector? Currently, we've got a supervisory and a space promotion body called InSpace that has been formed by the government of India. It works under ISRO. The task there is to achieve a $44 billion space economy in the next 4 years and tap the potential in the space sector. Be a supplier to the world, be a manufacturer for the world as well. What will be the learnings for the private sector from this exercise?
We are a late entrant into this international space industry. India is one of the 5 major superpowers, and it's now a $500 billion industry in which India plays a very small percentage. 2 to 3% of the market comes to Indian companies. And that's because we've just started off. I think one of the major things is to actually establish credibility of the Indian space industry in the international market so that we can bid for international projects. We can see that in many other international collaborations in physics and other subjects that we are now collaborating with the international projects and Indian industries coming in. So that's one major thing, is to learn how, this being a completely private endeavor of Axiom and collaboration with SpaceX, and our astronaut is being involved in it, to see how that works in this environment and learn for the Indian space industry when it gets involved in Gaganyaan, when it gets involved in our Antariksh space station, to build those things for ourselves. In addition, as this space sector grows, there will be quite a lot of international tenders that our companies, Indian space companies, will now apply for. And so not just the big ones, even the small microsatellites, the nanosatellites, and things like that, that payloads that will be built, they're also built by some of these companies that InSpace is now helping to generate within the country. All of this will have to learn from the American and Japanese and European companies working in the sector. And that's only when they will expand from the 2% we're talking about to the level you're talking about, the 10% level.
Okay. Let me get in a question with Dr. Garudachar. Dr. Raju, I'd like to ask you about ISRO's contribution to the Axiom 4 program and the learnings that they would like to take away from this collaboration.
Hey, we have learned we have learned a lot about launch vehicles as well as satellite. So this is one step more where the class of quality of the equipment, quality of the not only the design, the quality has to be utmost, that is zero defect policy. So the quality improvement is very important in this kind of a human in space programs, and we will learn a lot by doing this kind of a careful, controlled, experiment, and even the development of a similar thing, Bharatiya Antariksh Station, which will be something similar to ISS. So we should be in a position to replicate ISS kind of, station in space so that we can be independent. It is our Atmanirbhar effect, that we want to do our own mission. Okay, we have to collaborate because space industry is not, it's very expensive. So we have to collaborate. That is one part. At the same time, we can really contribute by designing our own Antariksh ground station similar to ISS. And that's the main question. Thank you.
All right. We've run out of time, but I'd really like to thank Dr. Raju, Professor Subbarao, and Professor Chaudhary for joining us on the program. It's been a fantastic discussion, and we really wish Group Captain Shubhanshu Shukla, the other astronauts, and everyone involved with Axiom 4 all the very best, and we wish it all the success over the next fortnight. We're taking a short break, but when we return, we will be focusing on the Middle East. The ceasefire between Israel and Iran is holding for now. I speak to Israel's ambassador to India, Reuven Azar, for a status check on where things are right now. The big global story, the ceasefire between Israel and Iran announced by US President Donald Trump appears to be holding. Both countries are publicly committed to the truce, and both Tehran and Tel Aviv claiming victory after a 12-day war. US President Trump also doubled down his claim that recent US strikes had completely destroyed 3 Iranian nuclear facilities. This comes after an initial intelligence assessment by the Pentagon revealed the sites had not been destroyed and Iran's nuclear program has been set back only by a few months. Speaking on the sidelines of the NATO summit in Hague, Trump also described the ceasefire as progressing very well and equated the US strikes in Iran to Hiroshima and Nagasaki, calling it essential to end the war.
We're actually getting along with them very well right now. But had we not succeeded with that hit ended the war. That hit ended the war. I don't want to use an example of Hiroshima. I don't want to use an example of Nagasaki. But that was essentially the same thing. That ended that war. This ended that with the war. If we didn't take that out, they'd be fighting right now. They fought like hell, and then they said, let's stop. And they're going to build themselves. And I really see it as sticking. I mean, we may do papers on it, Marco. Maybe we're going to do papers. I don't even know if you need them. They're not going to be fighting each other. They've had it. They've had a big fight, like 2 kids in a schoolyard. You know, they fight like hell. You can't stop them. Let them fight for about 2-3 minutes. Then it's easy to stop them.
Israel's military efforts against Iran's nuclear capabilities, also known as Operation Rising Lion, is now over. That's the word coming in from Israel's ambassador to India, Reuben Azar. I caught up with the Israeli ambassador earlier and began by asking how the ceasefire is being implemented and what are the benchmarks to sustain the deal and make it permanent.
It seems that the ceasefire is indeed working so far. We in Israel are going back to normal. People are going to schools, our airports are opening up, and we wish that the ceasefire will hold. What can actually disturb the ceasefire is not only a situation in which the Iranians renew shooting, but an attempt by Iran to reconstitute the threats, the imminent threats that were threatening our country. At this point, it seems that we have set back these 2 plans of extermination that they had, both the military nuclear assembly of a bomb that we were doing and the ballistic missile program. However, if that changes, of course, we will have to assess the situation. We prefer that diplomacy will continue to work in order to achieve an agreement with verifiable, where in a verifiable way, we will see that Iran does not reconstitute those plans of extermination wars.
Right. We've still seen some violations by both sides. Could you give us a sense of whether there is still firing taking place from Iran and from Israel to Iran?
Well, there was an incident yesterday, Rachid, following the entering into effect of the ceasefire, in which 1 hour after the ceasefire was supposed to enter into effect, the Iranians fired 2 ballistic missiles. We felt obliged to retaliate. That was a reason for the American president, President Trump, whom we are very thankful for his assistance in brokering this ceasefire. He got concerned. At that point, he called our prime minister and asked our airplanes, our jets, to get back. And we complied. You know, we don't have an interest in derailing the ceasefire. We actually participated and gave our consent to President Trump to broker it for us. So I'm happy that this is over, and now the ceasefire seems to be holding.
Right. I would also like to ask you, does this mean now that Operation Rising Lion is now over? And Israel will no longer go after Iran's nuclear facilities because you believe that the nuclear threat has been completely eliminated?
Well, it hasn't been completely eliminated. It was decimated. We knew that there is some knowledge that the Iranians have, and there is some fissile material we won't be able to destroy. But what we have destroyed, actually, is very, very essential parts of the program that without them, it is impossible to assemble a nuclear weapon. And I'll just mention a few of them. We have removed the clandestine group that has been building a nuclear device. We've destroyed the conversion site in Isfahan. We have severely damaged the main factory of centrifuges, and the centrifuges in Natanz. We have, the Americans have hit Fordow, but in addition to that, we have hit the archives of the nuclear program, the headquarters of of Iran's atomic agency, and many, many dozens of other elements they had in the program. Therefore, the program was set back for many years, and if they try to reconstitute them, then we have the intelligence, the access, and the capability to reach Iran. So the Iranians will hopefully refrain from trying to reconstitute the plan. And if they do, there will be a danger of escalation. We prefer, Rashid, to have a diplomatic solution. And I hope that one will be seen.
With that, it's a wrap on this edition of News Center. More news and updates continue right here.
The way to get started is to quit talking and begin doing. Walt Disney, the founder of the Walt Disney Company, simply yet profoundly articulates what entrepreneurship is truly about. It's having the courage to try, the conviction to follow through, the consistency to execute, and the compassion to share the success of your endeavor. My guest today embodies each of these attributes, having started not just his own entrepreneurial journey in 1984 when he started Enam Securities, but also having supported and stood by many of India's dreamers who, through their enterprise, scripted a new story for India, her capital markets, and her economy. You have stood up and stood by many of India's dreamers.
I became a magnet for entrepreneurs. So there's one man who will hold our hand and take us all the way.
So what is the art of deal making?
So whenever the deal maker wants to become too big, oh, I'm God, okay, you say this and you say that, kind of attitude, not literally, but I've seen that. What percentage of people you think die, Shireen, with regrets in their hearts?
A very large percentage.
So this risk of failure, fear of failure, is the one that makes people die with regret.
What is holding us back?
Promote and protect the good. Prevent and punish the bad. We prefer to be slow rather than fast. That's how we are a chalta hai country and not a daudta hai country.
The lack of speed would be, if you were to IPO India today, that would be on the risk factor side in the DRHP, right?
I wouldn't IPO.
You wouldn't IPO?
But to IPO, I must have a new story.
You have a special place in your heart for Charlie Munger and Warren Buffett. What have you taken from them that continues to guide and shape how you think today?
Understanding of balance sheet, because balance sheet is accumulation of good and bad.
How do you find India positioned in this mix today?
We have a resilience, we have a stability, we have a wisdom of our own. But वो हम एक scene दिखाते हैं, फिर we have a long break. Stop that.
Interval थोड़ा लंबा हो गया.
बहुत लंबा हो जाता है.
When did this happen? When was the start of it? This inner journey?
So first was, when I lost my mother. I was 13. Very attached to my mother, and so you can understand.
Yeah.
If you're sensitive when something like that happens, you really start pondering, questioning. But I wasn't a pessimistic kind of kid. I was a very optimistic. Someone held my hand, and that's how I read Gita, and that was very transforming. And kept finding new masters in my life.
Okay.
And I continue to. And so once I came across a book on Vipassana, it just fascinated me. This must have been 1972 or something. And
wow, as far back as that?
As far back as that. I met somebody who had returned from a Vipassana course. Vipassana was just 3-4 years old in this country. And I knew, well, I'm going to do it. I did it eventually many years later. But I knew that it had all the answers. So I went by my first course in 1989.
Wow.
And I knew I had got the path.
So at the end of that 45-day period, what was the outcome? What was the result? I mean, how?
It's a journey. Firstly, you learn that it's a journey. And what is a journey? A journey is that we don't see clearly. You see clearly. You are able to walk on this path in this manner is because you start seeing something. And you see that, most of the time, you are not seeing clearly. In our tradition, this is called Maya. Our vision is clouded by Maya. And what is Maya? Maya is seeing what is not there. And Maya leads to Moh. And what is Moh? Moh is getting infatuated with something.
Attachment.
It's not there.
Yeah. And all of this while you've been in the world of money.
Absolutely.
And material.
And Maya and Moh. And
exactly.
But you can imagine that when you have that internal clarity, how easy it is not to be trapped by it. And maybe even very easy to deal with it. And I found this, that our masters and our guides in life, ever since we discovered them, that is Buffett Saab and Munger Saab, they are masters. They are so advanced spiritually, I can't tell you. In my other office, I have made this very famous painting where I put Buddha, Mahavir, Emperor Ashok, Gandhi, and Buffett Munger at the same level.
Wow.
That is quite something. So they hold that much of a sort of closed space in your life?
Absolutely. Absolutely.
Did you get to spend a lot of time with them?
Not a lot of time, but I did meet them, and I got a book autographed by them. I got a chance to touch their feet.
You touched Warren Buffett and Charlie Munger's feet. But what is the one book that you would recommend to somebody? One book outside of the Gita that you would recommend to people?
So, a book on Vipassana, I would say, definitely. And there are 2-3 choices. One is Art of Living by Bill Hart. The second is by a McKinsey partner, senior partner, practicing in New York.
Oh.
So accidentally he took a Vipassana course. His life got transformed. And so he's written a book on seeing with eyes closed.
Seeing with eyes closed, that how important is that?
You can't have a bigger advantage in life.
But I'm going to ask you to take a seat here while we mic you up.
This is the third. This book has been written by my daughter.
Wow.
And so she is a top Ayurvedic consultant in America.
Oh.
And dedicated to women health.
What was it that made you want to start up? What was it that made you believe that you could be entrepreneurial? What was that moment like, if I could get you to go back in time?
Well, I think I had no choice. I mean, I didn't see that as a considered choice. I remember that I passed CA exam with flying colors, and I had 50 job offers. And I said, well, it'll be fun to go for a couple of interviews. And I did go for them. And obviously I did quite well. But one of them was an embarrassment. And they said, they kept me for 4 hours. It kept making me meet this person, that person, until I met the managing director. And then I said, this is too much. I must tell them very clearly that, look, I am not interested in any job, not only this. But then I developed a friendship with that gentleman for life. So Shireen, for me, it was very clear that I was going to be an entrepreneur. And the journey has not been easy. I had a lot of false starts. But I obviously have zero regrets because they were all there to teach me. And that's the beauty of entrepreneurship. Until you call it a day, it's only a lesson. It's not a loss. So I've learned many lessons, and it's been fabulous. And I'll tell anybody and everybody to take that attitude. Entrepreneurship is not necessarily, taking up a job in today's times, where you have so much freedom, compared to when I started, more than 50 years ago. Today, you have, so much freedom in your job to be creative, to call your shots, to define your rules. So I think there is only one way to live. Nature wants you to be an entrepreneur because it gives you unique capabilities. Like every creature in the world, it has a defense mechanism, it has an offense mechanism, it has a creativity of its own. And if you don't use it, let me ask you a counter question. What percentage of people you think die, Shireen, with regrets in their hearts?
A very large percentage.
Because our systems don't encourage entrepreneurship. So this risk of failure, fear of failure, is the one that makes people die with regrets. And people who have all the capability, education, resources, dying with regrets, what can be more painful? So not only that I was an entrepreneur, but I supported entrepreneurship big time.
Yes.
And I continue to kindle that in everybody.
And as you pointed out, not just your own entrepreneurial journey and the many lessons associated with that, but as I pointed out, you have stood up and stood by many of India's dreamers, people who were not necessarily seen as visionary or ahead of their times. What made you bet on them? What was what would you consider today your highest conviction bet?
So firstly, I saw the transformation in myself. But I felt that if I could change and I could do whatever, everybody can. So as long as you don't have a broken value system, given everything just falling in place, you have a good chance of coming up and making it. And second part was that the bulk of my journey was post 91. We started in 85 itself, and we started working with Reliance in since 1985, and nobody did more work while I was still a banker with Reliance. But that besides, so when came 91, much before reforms were announced in India, I was in America, saying that India will happen, meeting Wall Street. I had that abiding faith that India's time had come. And therefore, when entrepreneurs like Narayan Murthy and Subhash Chandra and Anil Agarwal and so many of them started approaching me, and then I became a magnet for entrepreneurs. So there's one man who will hold our hand and take us all the way. We can take some legitimate pride that we played a very key role in the first 15, 20 years of India's shaping. Sector after sector were opened by us, kind of thing. We did the defining IPO for that sector. So not only we presented the company, but we presented the potential of the sector. We did, whatever pioneering things in capital markets we did.
And I want you to narrate for us the 3 or 4 things that stand out or so vividly sort of, resonate with you in your memory, in your mind, as the defining moments of that period between 1991 and 2000.
So as a country, if I were to say that the period 91 to 93 has been so eventful, I don't know how many people think about it. Just imagine. 91 March, we go bankrupt, we pledge our gold. And IMF is talking to us about, $4.4 billion in 2 tranches of loan to us, and the terms are being negotiated. From that time to 93 March, when we had the bomb blast, the world had changed completely in India. Reforms happened. FIIs came.
Yeah.
Divestment happened of, several PSUs got listed. Harshad Mehta happened and fell, by the way, in that short period. Yeah. More importantly, NSE was formed. SEBI came into being. Market went on a whole big roller coaster. Outcry started to give way to, technical platform of computerizing this, that, etc. The grand story of BSE, 108-year-old institutions by them or 118-year-old institution by them, we started to decline and the BSE couldn't see it. And by 93 September, 2 very landmark companies had already got formed, Infosys and CTV. And therefore, the 2 stories that stand out are these from personal point of view, Infosys and this. But one story I would like to recount and request the whole country to put it as a center, as a guidance for the future, is that of a gentleman called N. Vittal. He was a secretary in the Department of Electronics and Information Technology. Information technology industry hardly existed.
Yeah.
This man saw the potential. He had experience in export zones and export policy, etc. And he saw that, most people don't understand what software exports mean, but I've come to understand by and by that what they mean. And this is magic because they create high-paying jobs. There's such a big potential. So I must do something. Never before or after, he did what was making the government follow business. So there's something called STPL, right? Software.
Yeah.
And he said the principle there was that normally the government wants the businessmen to tail it. You follow our rules, you come to Delhi, etc., etc. He said, no. We will come where you are. Yeah. He said, if you set up you set up a software park in a forest, I will set up an office in the forest. We will help you. So this approach of helping a sector all the way, and then he found solutions to creating links and telephone lines and power and doing deals with the states to give them land and whatever they needed. One man who's a missionary, and look the result of that.
Yeah.
That one little innovation is $300 billion of exports today. Country has floated. If on anything more than anything else, it is the software export zones and software exports. So you've got at least 10, 15 such ideas where we need to do a Vittal.
What would be the top 3?
So there could be AI, it could be quantum, it could be medtech, medical devices and technology, is pharma itself, where we need to redefine the rules. And we have seen what we have done in drones, what we have seen in space, nuclear capability is just opening up. Some of our small companies have done wonderful work on this. Bharat Forge, as we know, is a leading forging company and very research-minded. We have had a relationship with them for more than 40 years. And they said, what is the most logical thing to do is to create high value-added products. Gun would be great.
Yeah.
And so India was looking for a substitute for Bofors. And they said, well, we'll make one. They're so ambitious. So they built one. And they thought it was a great gun. But until you fire a gun, you don't know. So they're looking for what we call a firing range to fire it. And they tried for 4 long years, no success. After 5 years, US government, they started trying for 1 year, and the US government gave them permission to fire an Indian gun on a US firing range. And it did brilliantly. He had to play a video. With great difficulty, got a chance to play a video to a defense conference, which had Mr. Manohar Parrikar in it. And Mr. Manohar Parrikar froze because the gun was 40% more efficient, 30% cheaper than anything available in the market. And this gun was not allowed to fire for 4 years in India. The rest is history, as they say. So this is the kind of talent available in select areas. And these are the kind of difficulties they face, where we need to take a Vittal approach. Tell us what you want. Typically, it means 2-3 things. It means that I need funding, which has tolerance for failure. I need funding which is patient. Because if I have to be cutting edge, a lot of the things that you're seeing today have been in the US labs or other labs for very many years, 5, 10, 15 years. And so maybe we will not take 5, 10, 15, but whatever number of years. I will need market support whenever I'm ready. Because just as, if India doesn't buy the first gun from Bharat Forge, who will? In this case, actually it was Saudi Arabia who gave them a $150 million order. But that won't happen everywhere. So I think, and we have some stories, like, for example, the COVID vaccine, where the government came forward and Modi ji did an amazing job by taking the first shot of, the Bharat vaccine. So you will need things like that. And then you need consistent policy, friendly policy regime. Government changes, ministers change, bureaucrats change, policies change. These stories are absolutely legion. But the idea is that how do you leapfrog? And you leapfrog with technology. So when mobile technology came to India, for example, this illiterate vegetable vendor suddenly had an advantage. She learned how to read all the relevant stuff. She learned enough technology to operate a feature phone or a smartphone or whatever. And so it's such a great leveler. An ATM is a leveler. So technology is a great leveler, and it is fantastic news for people who are less privileged. So if I have that vision and that logic, what is holding us back?
What is holding us back?
Painful reality of India. So not only, I feel very strongly to commission, I have done films in various areas, and a film on, Indians against India. There is something in us, Shireen, where we prefer to be slow rather than fast. That's how we are a chalta hai country and not a daudta hai country. And speed and innovation go together. How do things become speedy? How does a Vande Bharat happen? Unless you love speed. So the record of deregulation and success of private enterprise has been so phenomenal. There will be failures, there will be frauds, but that's not to prevent all children from running around, because they will fall occasionally. Some will, get seriously hurt. That's okay. So this daudta hai se dar lagta hai. How will that India change?
So since we're talking about India, I would imagine that this the lack of speed would be, if you were to IPO India today, that would be on the risk factor side in the DRHP,
I
right?
wouldn't IPO.
You wouldn't IPO?
unless I had two things to present. And, you know, let's just face it. Indian stocks are not cheap. They don't go down because they don't deserve to go down. Because, you know, we're still doing a lot of good things. And therefore, maybe my P is justified in some manner that quality, people want to hold on to quality because it's a rare thing. And that's the principle of valuation, the principle of the markets. So I wouldn't sell all my blue chips, even if they are highly valued. Where do I go from here? So they won't perform for some time, but that's okay. But to IPO, I must have a new story. I must create room for higher P, higher profit growth, etc. And that won't happen. What do you think will take India ahead? The government or people?
People.
Then government should be after people, no? Why are people having to change the government?
But not after, but supporting or...
Exactly, exactly. So you know where is the engine and where is the dabba. So the government must play the role of an arbiter, providing a track. So I say that, okay, promote and protect the good, prevent and punish the bad. That's all.
You're saying we're still over-regulated?
100%.
Across sectors?
Well, you know, I mean, you can't pin me down on this expression, but you know what
Capital
I'm meaning.
markets?
See, question is it is a mindset question, right? Look, what did capital markets do? Capital markets, the creation of NSE, saying that, look, BSE was a fantastic institution, absolutely what role it played, blah, blah. But if you are not forward-looking, you will get into trouble. And people thought that without this badla and what will happen, nothing happened. And dematerialization. How can we forget dematerialization? We never thought this was possible. In the crazy world of transfers and whatnot, and how inefficient and, you know, what poor use of time it used to be. And look, 90% got dematerialized in no time. We think our people are illiterate, कि चिमन भाई को क्या आएगा, सुब्रमण्यम को क्या आएगा, what nonsense. So we just don't learn that how capable our people are. And we were more dematerialized than UK and England, UK, US, Germany, France for many years. I don't know what the current thinking is.
you're a man who's supported IPOs across the length and breadth of India. As you look at what's happening in the IPO market today, some of these new age companies listing in the Indian stock markets, the Indian startup story coming of age, so to speak. How do you read that?
So it's not new. So I've seen the age of mega issues. I don't know if you were even around that time. So in 1989, you had 4 companies attempting that, and L&T was a surprise, guest to the party. But you had something by Reliance, you had something by Usha Rectifier, you had something by Oswald. People have even forgotten.
Yeah.
And the 200 crore issue was a mega issue. So there is a mood in the market that people want to give money, and there will be people who will collect it by selling an idea, selling a dream. That, oh, this is a mega idea and it will create mega results and all.
As you look at what's happening globally today, the state of uncertainty, flux, volatility, changes that some we didn't expect at all at this point in time, geopolitical relationships changing. How do you find India positioned in this mix today?
So there's something about India, right? That we have a resilience, we have a stability, we have a wisdom of our own. We had the Asian crisis. We did the nuclear explosion. We had the Kargil war. The Indian corporate balance sheets were in a mess. Government of India balance sheet didn't look good. You know what the interest rates were?
Yeah.
The market were 18, 19, 20, 21%. Government was borrowing at 9%. Institutions were borrowing at 16%. And the interest rate reset happened under Dr. Jalan and Montek Singh Ahluwalia. And the interest rates have been falling ever since. So what all surprising things we've done. We've come back, and the COVID is a classic example. From one picture to another picture. So India has this great story capability of its own, and now you have a people that has tested future. What hum ek scene dikhate hain, फिर we have a long break. Stop that.
Interval thoda lamba ho gaya.
बहुत लंबा हो जाता है. So I think we need to just do that, and you adopt speed as the way to innovate faster. And I think a brilliant.
But are you concerned, since you're talking about innovation, and the debate is on whether Indian private sector is investing enough in R&D, is investing enough in innovation, as we look at what's happening in China and the US and so on and so forth. Does it worry you? Does it concern you that we may fall behind?
It's a statistic. See, innovation is a mindset. I can't force, say, a talented hockey player to play cricket. They are completely different mindsets. My risk, my appetite for failure. See, as we say, necessity is the mother of invention.
Yes.
The automobile car in America is the result of military defense, military spending support. Some of the most amazing products were supported by the government. So, somebody has to lead the way, and the government has to lead the way. And I think things will happen. So I wouldn't, because then it's a non-starter for me. So I don't talk that language. I will look at the R&D that we are spending only 0.7% of GDP. They are spending only 0.78% of their corporate profits into it. But that's a statistic. Let me change what will lead to innovation, where I will show the path, I will create vehicles, and I will support the initial investment, and then people will come. It will be a flood. Do that for 3-4 years. Government has already shown the attitude, right? 1 lakh crores, 20,000 crore allocation this year. Let this money start rolling out. And then, some academic institution, and we don't have academicians today to take up the research dollars. We have a huge opportunity. US is Mr. Trump is throwing out its research scientists by tons. Why don't we go and grab? Government has a program. Now I need to accelerate 10 times more money and bring them all to IITs, IIMs, RDCs, this, that, wherever. First, आदमी तो इकट्ठे कर लो यार, बाद में सेना बना लेंगे.
But you talked about Mr. Trump. Let me ask you about what you anticipate in terms of capital flows, with the world being in this sort of state of flux today, and the opportunities that present are presenting, that India finds itself presented with, whether it's manufacturing and so on and so forth. How do you see capital flows in this current milieu?
See, investment is a micro decision. It's not a macro decision. Macro is a small part of it, but micro is the main part of it. Does it make sense? Do I see safety in it, etc., etc.? So I have to provide the fit for the money, and the money will come. Some part will come because a lot of money is there and we have to do some allocation business. But what we call investing per se will happen on a micro basis. So say, for example, if some of the semiconductor companies, they have good stories to write, we are seeing this, they are attracting partnerships and they're attracting money. Some of our renewable energy, where we have a huge opportunity, we could be a world leader, right? Mr. Mukesh Ambani talks about it, Mr. Adani talks. We have a real opportunity. Money is coming in, money will keep coming in. So also if I support AI, this, that, etc., money will come in. So I think if I provide, just the stability, I provide this better governance, I provide better ease of doing business, my rank has to go from, in beyond 50s, just to come within 25 in the next 3 years, 4 years. Let me take drastic action. If I see that kind of momentum, I have no doubt money will come. And I say, you create that environment here. Money has to come because we have some great advantage, which we did not use like China did, the domestic market. Visualize this. US and China, they cannot live without each other. Trump is realizing it. But even to whatever extent, they don't allow access to their own market to each other. Where will they go? They want a large growing market for 5, 10, 15 years, or maybe longer. India is that market.
Since we're talking about money and, your relationship with money, but more importantly, what you now would like to see being done with the money that you've accumulated. What is the purpose?
Well, I didn't accumulate money, really speaking, Shireen, in the sense that even while I was in business, we wanted to give. Not only we wanted to give, we told our employees, you give one, we will match it. Then we say, you give one, we will give you two. Give. That has been our approach. And therefore, say whether we take Flame University, for example. Like Flame University is a very different story of investment. It's the best investment we made.
Why do you say that?
With no return that people can count, right? There's no tangible return, but it's fabulous. That redefining education, higher education in India, doing something for Indian values, doing something for R&D, doing something for a global statement, doing something for, reversing brain drain. Say, for example, one of the areas out of many is doing something for democracy. That how democracy from a very eloquent definition of, for the people, by the people, of the people, it has become for some people, by some people, etc. And how will it change? Why will it change? One can't imagine that a political class will say, let me empower my citizens. I will always make them feel, I'll say, okay, you be entitled, main hu na. I will somehow provide for it. So I'll create a welfare state of whatever kind. Do you know what Socrates said about democracy? Very interesting. More than 2,500 years ago, Socrates said, well, be careful of democracy. Because there will come a day where the criminals will say, no, we should not be punished. And there are enough of them. Sure, they will not be punished. And therefore, you need a very intelligent democracy. There is no democracy at the end of the year if there is no democracy today. There is no democracy unless I participate in democracy. So I have visualized a democracy 2.0, where it is democracy of actisans, where the citizen is an active participant in democracy. So we have created a concept called actisan. Actisan means alert, informed, and active, and not activist. And now we have taken that program to 10,000 schools, government schools in 4 states. Very difficult job to think of what we can do, to create a program, to take it to school, experiment, evolve continuously, But today we have several states and thousands and tens of thousands of schools waiting. But until we build capacity, we won't take it.
You know, as you look at not just your own journey, but the journey of so many entrepreneurs that you've been closely associated with, who've grown, scaled their businesses, some have even had global ambitions and global aspirations, what would you say have been some of the most underrated management principles that entrepreneurs must focus on?
Values. Values is a tool of management, highly underrated. So you will hear about humility at times. You will hear about honesty at times. What about empathy? is the most powerful tool, empathy. I have used that in my deal making, in running my empire, running my business, in my NGOs, that at the end of the day, we are not the role that we have. There's always an emotion inside us. And when you go to that level, obviously it is accompanied by honesty. And if there's no humility, you can never achieve empathy. So empathy is not easy to achieve.
So what is the art of deal making? The 3 or 4 or the top 5 things that one must focus on?
See, you have to be very authentic. You can't do a win-win without authenticity. There can't be anything sly about it. So if the buyer and the seller themselves are not stating it, as a deal maker, you got to bring that out. You have to be creative. Obviously, that's why things are setting apart, because there are assumptions, there are norms, etc. And you know how you break norms rather than rules to see things right. We started talking, seeing things as they really are, and that's the art of deal making. Then you need patience, you need empathy, and you need real skill. You need diligence to how to see things deeply over time.
What's been the most fun deal that you've done?
Oh, there have been too many.
The top one.
Let me talk about one of them, and because it made tremendous amount of money. This is the L&T deal, right? And I was not the deal maker primarily in the first place. Right. I was not the first banker of the deal. And Mr. Birla wanted to buy L&T, as you know. Yes. This is probably in early part 2001, 2 or something like that. And then, Mr. Naik wouldn't have any of it. And not only that, he mounted a counter-attack, and things were a complete mess. Obviously, it was so depressing for Mr. Young Birla. He had just come into power, and he thought this was too tempting, so
he was going to go
like
after it.
Tiger cub attacked an elephant. And then, I came into the scene, and we said, what can we do? And so we started working systematically and saying that, look, firstly, can we break the company? So it was not only I, but there were a lot of other people attempting. But I was doing the deal structuring, holding him, encouraging him, taking him out of his depression. And it took us 3-4 months to turn around the whole thing. L&T carved out a large part. It carved out a brilliant deal for its employees. They created a stock option, employee stock, very brilliantly created. And there were a lot of doubts as to, whether the deal will pass muster or not. But through all of that creativity, we were able to take that cement business. It became Ultratech. It is the largest asset of the Birla empire. So from a completely lost deal, becoming very regretful and remorseful that your company guy and nothing can be done. So even what looked like half a deal or even less than half a deal became the most amazing. So the art of possible, do what is possible. That was not possible, forget it. Don't think that, there's animosity, this, that, etc.
I know that you have a special place in your heart for Charlie Munger and Warren Buffett. As you look at what's happening today, and some of their principles, investing principles, are timeless, as we've seen. What is it that has guided your investment thesis, your investment philosophy? What have you taken from them that continues to guide and shape how you think today?
So 2 things. That the man at the helm is very important. Large part of it is that. And the second is understanding of balance sheet, because balance sheet is accumulation of good and bad. Not many people pay attention to the balance sheet. And balance sheet is, a tangible balance sheet and an intangible balance sheet. So, my relationship with my customers, my suppliers, my employees, my regulators, my community, etc., is also balance sheet. And of course, what sort of liabilities I am ready to take, what sort of asset policies I have, how do I write them, how do I recognize, how do I write them down, how do I recognize them. Once you have that study, it reflects the character of the promoter, the founder, the management. These are the two principles that guide us. That when you meet a person, you see the value system, what is that person trying to do, and if you see an alignment, that this is fine, because nobody knows what will happen tomorrow. But we know if something goes wrong, how will this man react? That's enough. And then the balance sheet shows us how has it been on an accumulated basis. And sometimes the way we look at the balance sheet is actually surprising to the promoter themselves. That, look, we didn't realize this, how it shows up in the balance sheet. And what you say is right? Because they are on a day-to-day basis. We have the advantage of, peaceful evaluation. So that's how, we buy, make our investments. And very typical for us to sit for 5, 10, 15, 20, 25, 30 years with our investments.
Let me end by asking you, what to your mind is your leadership language? What is it that you would like people to remember you for?
Well, here was a reliable guy who always wanted to be useful. That would be my epitaph. But as to, leadership, my leadership language is probably twofold. As I said that, we all have a desire, but we don't have a design. Many times you don't have a design. So, for example, in today's world, suddenly we don't know what will happen. And the company, the business may face so much uncertainty. What do you do? So the leader or a CEO has two roles, one of a mother, one of a captain. And what does a mother do? Mother has to create children who are a lot more educated, a lot more skillful, a lot more capable, taller, stronger than her. So it requires inspiration. It requires a value system. Mother has to show courage, stability, patience, learning to do with less, creates solidarity, a feeling of oneness, etc. And that's what nurses children have become. There are times when you have a design clarity, when you become a captain. A captain is a coach, he got strategy, he will give a chance to everybody, he's a team player, etc., etc. So you have to alternate between mother and a captain role. Uncertainty, you become a mother. Certainty, etc., you become a captain, you create more ambition, this, that, etc. And I've seen that play out. And let me give you one example, and I think it will become very clear. In the Infosys journey, not from public, but much earlier, right? Mr. Murthy was a mother. All his partners were, far less capable. They were not really partners in terms of stature of him, but he is the one who encouraged them. They wanted to sell Infosys. He said, I'm not selling Infosys. He showed that courage, that example. And then later on, he became a captain. And look at the man. He came back a second time. 2005, he retired. 2013 or something, 14, he came back. And he still performed. He knew how to be a captain a second time. So there are few leaders who have this very, very clear in their mind that can I inspire people? So my language is one of inspiration, having implicit faith, letting them take risk. I used to tell my people, look, I'm not going to teach you anything. I'm going to take you and put you in a swimming pool. You have to learn swimming on your own. But they would have so much confidence, I will not drown. This is such a protective environment where I can go 20 times and ask. And people, they learned. One person who is a big fund manager today, we taught him how to read a balance sheet. We gave him that opportunity. Koi baat nahi, aaja beta, teko sikhata. So, that mother attitude, okay, everybody a chance. Okay, you'll become all right. But they would learn so fast. So, that's the kind of game, that's the kind of fun I've had, Shireen.
alternate between being a mother, the nurturer, the provider, the supporter, the protector, and the captain, steering the ship through certain times, not the uncertain times. The uncertain times, the mother comes in.
Absolutely.
The mother comes in. But Mr. Bhansali, what an absolute pleasure it has been to have you on the program. Thank you so much for sharing.
I don't know. I am a fluent guy. I just flow. So I hope it is meaningful for your audience.
It was absolutely fabulous. We truly do appreciate it. And I think, you know, as I've been listening to you narrate your stories and share your insights with us, I'm reminded of what Mark Twain said. He said, don't let your education interfere with your entrepreneurship, or broadly that. And I think to add to that, what I've learned from you today is don't let your ego get in the way of your entrepreneurship either. It's been an absolute pleasure. Thank you so much for joining us here on the Leadership Language. Appreciate your time.
Thank you for giving me this opportunity.
welcome to Voices from the Valley. I'm Shireen Bhan. We're here at Menlo Ventures. It's got a 47-year-old history investing in startups, 165 M&A transactions that it's been a part of. Some of the hottest bets that it's making today are in companies like Anthropic. Joining me now to talk about the road ahead for Menlo Ventures and his view on all things AI is a man who has now become a tech influencer. Also, of course, is a products guy and an investor. Didi Das, thanks very much for joining us on Voices from the Valley. It's great to have you here
It's a pleasure
on
to
the
be
program.
here, Shireen. Thank you for having me.
Before I talk to you about Menlo, let's get a little bit of your backstory. Cornell, Google, Glean, and now Menlo. How did this come about?
Well, Shireen, you know, I grew up in Calcutta, and when I was in India, what I really wanted to do always was, you know, just to come and be an engineer somewhere in the valley. You know, you'd grow up, you'd look up to companies like a Google that sort of was the bastion of the internet for the longest time.
Right.
And the reason I feel like when I was growing up, I learned so much about the world. And that was really the dream. So when I came to Cornell, I studied computer science. I went and I eventually worked at Google, and I was working on search, and that was sort of the dream for me. With time, though, I realized that the potential and what the Valley really offers is far more than working at a big company, and I knew I wanted to do startups. And that's sort of when I made the transition, and I realized, well, I wanted to start something, but I ran into Arvind. I met Arvind very fortuitously, and then we spoke, and then I joined Glean on the founding team. And that was
your best decision, I believe.
I believe it was a fairly good decision. I mean, Glean worked out pretty well so far. It's a $7 billion company. We saw it grow from, you know, maybe 5 people when I was there to now it's almost a 1,000-person company over many, many places. But really at Glean is what really solidified, oh my God, like this is how companies are built. And after Glean is when I realized, you know what, like there's not enough people on the investing side who are, you know, understand how to build a company, who understand all the work that's involved. And I was sort of, I didn't really want to ever go into venture capital. That was never something I wanted. But after doing engineering, product, a lot of hiring, sales, marketing at Glean, I sort of started to understand how businesses are formed. May have made sense to go and start a company of my own, but I realized it would be so much more interesting if I could help a bunch of different companies figure this out on their own. And that's how I sort of moved on to the venture capital side, which is, you know, traditionally an industry where it's full of people from business school who are doing finances, know how to read an Excel spreadsheet. That was never how early stage venture worked, though. You don't have many numbers to go off of. And what you really need is someone who understands technology, how to hire, how to get a company off the ground. And I thought, you know, maybe I'd be pretty decent at that. And that's how I came here. And it's been about a year and a half, and I've been really enjoying it. I feel like it is really, really fun to work with companies who are just getting things off the ground.
A VC with a founder's mindset, is that how you would describe yourself?
I guess so. You know, like a lot of what founders look for, it's a very intimidating journey. You know, you're doing this thing often for a first-time founder alone, maybe with one other person, and it's very isolating. It's a 24/7 job. You don't know who to look for help, and really all you have is your investor. And if your investor understands that journey and really empathizes with it and knows how to do it, I think that's a pretty good sell, and we can work better together to get that company off the ground. So I would describe it that way.
Well, speaking about getting companies off the ground, you know, the tagline, the slogan everywhere inside the Menlo office says, all in on AI. I mean, that's not unusual. If you walk around the valley today, everyone's all in on AI. But how are you seeing this differently? How are you doing this differently?
Well, if you look at the history of the Valley, almost all great companies have come from a single revolution. So you had the internet era, you had the dot-com bubble, and then everything that ensued after that. Then you had cloud, then you had mobile, and each of these sort of tectonic shifts in how things are built changed the companies that could come out of it. So you had various different companies of each era that are, you know, dominant and well-known household names today. That of our time is definitely what generative AI can do for us. And we are seeing a bunch of different companies come about. But the interesting thing is, unlike many of the other platform shifts, most of the companies that came out of that were out of the ease of building products. It became easier to build and distribute products, but it was really a lot about the products in the business. Today, in the world of AI, a lot of investing and understanding these businesses is really about really deeply understanding technology and talent, especially at the early stage. And that's kind of where we come in, where a lot of us at the Menlo team, if you look at, I work very closely with many people, but three people I want to highlight are, there's Tim Tully, who was the ex-CTO of Splunk, which is, $50 billion company. There's Joff Redfern, who was the ex-chief product officer at Atlassian. And then we have, Matt Groening, who, built and sold $1 billion company. When you look at founders, access to capital is really not what venture capital provides anymore. That used to be a niche industry back then, where you could only go talk to 5 people and they'd give you capital.
There's plenty of capital around now, so that's not a constraint.
Really, and for great founders, that's not even what they're looking for. They know they can find capital in many places. They're looking for a partner in that journey. They're looking for someone who can help them, someone who can be both moral support and emotional support, but also actually on the ground, helping them grind out getting a business off the ground. And that's really where I think we differentiate ourselves, where we know how to do a lot of this. And it comes across immediately in early interactions with founders. Like even just last week, I was talking to an early stage founder at, YC Demo Day, funnily enough. And within 5 minutes, it's like, I feel like I've gone through an hour of worth. I skipped an hour of content because you just get it. And I'm like, of course we get it. We live and breathe this. And he's like, yeah, well, with many other VCs, I feel like I have to explain to them all of this stuff. And I don't have to explain that to you. So I really enjoy talking to you. And that's really what we think we can differentiate. Obviously, you do need investing experience too. That's very valuable for a lot of different reasons. But combining that with operational experience, that's what really allows us to be, very unique and differentiated in this market, where there's thousands of companies.
Thousands of companies, and yet some outliers, and you're backing some of those outliers. Let's talk a little bit about Anthropic and the bet that you're making there. $65 billion valuation at this point in time with the latest fundraise. What excites you about what's going on at Anthropic?
Well, there's so many things to name about what goes on at Anthropic. If you look at, we look around the world and almost a lot of people want to be software engineers. Computer science may be the most popular major in, dare I say, the world, if not America. And that's happened maybe in the last 15 years. In many ways, there was this career people would aspire to be in banking or in consulting, and so sort of the cookie cutter way to do it maybe in the 90s. Over time, that sort of shifted to computer science, and there's been so much talent that goes in. What really excites me the most about Anthropic is we're finally seeing a world where that really highly skilled job, you can have a machine do a lot of parts of that. And that's a tectonic shift in like how we even see the future of technology evolving. I, the other day, went on my computer and we were analyzing some data for this company. This was like 100 MB Excel file. It takes 2 minutes just to even open on your Excel on your computer. And I want to run this analysis. I open up this Anthropic product called Claude Code, and I just say, hey, you know what? I just want you to run a cohort retention analysis on a dollar basis, transaction basis, and a customer basis. That's a task that would normally take, an MBA associate maybe a week worth of time to do all of this stuff together. It took the computer 2 minutes. It printed out these beautiful, beautiful graphs that I could see. And if that's not magical, I don't know what is. I mean, when we grow up, I was like, this is what you sort of dream of. Like, what do you mean? I don't have to write the code and think about it. I can just do what I want to do. So I think that's what's so exciting.
It's magical and scary at the same time. I mean, even the team at Anthropic is warning us about a white-collar bloodbath. So in this context, then, is computer science really going to be the sexy thing that people want to do? Or are MBA associates going to be a thing in the future? I mean, what are we talking about?
I know it's really scary, and there are parts of, I think, every technological shift that can be a bit scary. I do think that it's really hard to predict the future, obviously, with things like this, and you honestly risk sounding very foolish by even trying to make any predictions. I don't even know what's going to happen 4 weeks from now, right? All of the guesses on how models change, how the intelligence increases over time, we don't know. That being said, if I were to look at history, usually what happens in history is when there is a monumental shift, humans find a way to adapt and do something else. And yes, is it a risk? Are white-collar jobs in danger? Maybe. But one can also make the argument that even if you didn't need 100 people to do the job, you can get the same job done with 10 people. And maybe those 90 people can go do other new things, and it's net more productive to society. And I know one of the things that everyone always talks about, and it's TBD whether this actually happens, is when are we going to see generative AI actually contribute to productivity and GDP? And I think it's coming. I mean, it goes without saying, even today, change takes time. But when I speak to companies, today companies are able to do with less than 10 people more than they've ever been able to do before. We are talking about billion-dollar companies that exist today with hefty amounts of revenue, less than 10 people in an office. And it's kind of surprising to see. You would not expect that in the yesteryears. Even 5 years ago, a billion-dollar company, you usually say has 250 people, maybe 500. So just that productivity increase, I'm very optimistic about that future, actually.
Just about everybody wants to get into the AI business or the AI game in some form or fashion. There's OpenAI, there's Anthropic, there's the whole ex-OpenAI cohort that's trying to do their own little shops at this point in time. What do you believe? I mean, is this a winner-takes-all market? It seems to be at this point in time. How much room is there for more?
It's a great question. I think I would separate this out into technology and business. From a technology point of view, there are very few people who have the ability to innovate on a fundamental level. A part of that reason is because it is capital constrained. It is very difficult to train cutting-edge models, at least in the methods that we know, in better, more capital efficient ways. And why would someone invest hundreds of millions of dollars, even though they have, into new companies?
And even though they still are.
And they still are, because there is a promise that they could do something great if they have the skill to have done it in the past. So that's on the technology front. But on the business front, I think, products don't change that much throughout society. Sticky good products are always sticky good products. Businesses that grow and have sort of a moat, I mean, that's a interesting word in the Valley to say, because almost nobody has a moat.
Like, what is a moat now?
But look, Anthropic for example, has hired hundreds of people. They've done tons and tons of work on their models over time and progressively made it better. They've spent a lot of capital. They've got a ton of infrastructure. That's a bit of a moat. It's not easy to replicate that overnight. And then, of course, on OpenAI, you could say something even stronger on the consumer side, at least, where, if you look at the public rumored numbers, at least, 800 million monthly active users for a product like that. There hasn't been a product grow to that kind of scale so quickly. Ever. So I don't think those are defensible businesses. I think I am a little surprised at how quickly it's penetrated society. When these things came out, I just had the lens of, maybe this is useful to some really nerdy machine learning people, and maybe they can go out and build other products. The shift, and I know people at OpenAI who would agree with me too, is the shift to this being a consumer product that people go to. And today I'm so amazed when even I talk to my friends and they tell me, this is what I use as a therapist. Like, I just talk to my ChatGPT and it knows about me and it'll answer my problems. It'll tell me what to do in life. I don't think I could have predicted that. I saw this as a utilitarian tool to maybe be useful to a small set of people. I frankly did not see it become this ubiquitous, all-you-can, Oracle that you go to for
all kinds of life advice now.
So I think that's spectacular to see.
But what are the trends that you're looking at this point in time? You talked about
capital and the fact that this has been a capital guzzler in many ways. Of course, we've seen costs coming off also. There is, of course, room for costs to come off further. But what are you seeing as some of the other interesting trends that are also helping you on the macros make your decisions on what to do with the micros?
Well, on the macros, there are a lot of pretty interesting things happening. In general, we see that a lot more companies are, well, it depends on what kind of macro you speak of. Let's talk about just the macro in terms of public market companies today. After, say, 2021, there's been a bit of a compression in public market valuations. A lot of those companies some of those companies are struggling to grow, and they feel the need to reduce cost. And when you feel that need, that's where AI can come and help you. That's just one example. Other things on the macro that I find interesting are, frankly, like the cost of, going back to the cost thing, the R&D cost for a lot of these applications, let me step back a little. If you want to start a business, you need to be profitable. If your R&D cost is too high and you're not making enough money, inherently there are some businesses that cannot exist. What this opens up at a higher level is there's a whole new set of opportunities of businesses, whether venture backable scale or not, where the cost comes down to, in many cases, like one engineer or two engineers, yet you can create a product that creates, say, a couple $1 million a year in revenue. That's a new viable sort of business. So we see this explosion in small businesses that were previously not possible anymore.
Do you see more consolidation within this space as we now start to see companies scale up? I mean, whether it's Musk or it's Zuckerberg, we're talking about the talent wars. I mean, look at what Zuckerberg's offering people at this point in time to get the best AI brains into Meta. Musk trying to raise money at this point as well. Is OpenAI, we've already talked about that, but is this going to be a big boys game?
Usually with innovation, all companies use the resources at their disposal to create a defensible position. That's always been the case, I feel like, with capitalism. That will not change. OpenAI will try their best to defend themselves. Anthropic will try their best. Meta, X, everybody will try their best to defend their position. And on a foundational model level, yeah, you could argue that it becomes way more difficult to compete when you're not able to access the capital to get off the ground. However, on the other side, on the application level and everything else, there are so many opportunities that blossom. And, I keep saying this, but increasingly there's fewer and fewer people that need a formal education to be able to do that. And these LLMs have been transformative to how people learn. You effectively can go online and chat endlessly and learn about any topic in as much depth as you can. So we're seeing even people who are 18, 19 years old who have honestly, like no business doing a company, who just know everything about it. And I have so many examples of people like that who have learned on LLMs and been able to translate that into careers, into opportunities, into businesses. And for that, I think the opportunity is very, very vast. Foundational model layer, though, there is going to be a lot of competition. Capital is a difference, makes a difference. Amount you can pay makes a difference. Huge salaries go into it. Huge amount of compute budget go into it. A lot of the ecosystem is compute constrained and do not have access to the number of GPUs they need to serve all of their users or to train new models. Data is a bottleneck. After the internet, where do you get your data from to make models better and better? So there's a bunch of different problems that all of these companies are trying to solve. And I would say, it is quite difficult, but not impossible to compete in that space from the ground up.
Let's talk a little bit about what's happening in India, especially as far as the AI space is concerned. And I think, there's sort of been this debate on whether we're doing enough deep tech and we should be prioritizing deep tech. And I think that it's a process of, of the evolution of the startup ecosystem. And perhaps we're getting to that point of some degree of maturation where we will start to see that happen. But what do you make of, the AI efforts, the Sarvams and Krutrims and so on and so forth? I mean, you're pretty vocal as a influencer. So what do you make of what's going on there?
Well, look, one thing I'll say is, even on the history of companies that have been formed in India, the tech companies that have been formed in India, often their right to win is a grasp of the knowledge of the people and the customers that they deal with. For example, if you look at a Zomato, a Zomato would have crushed any other international competitor in India because they were able to execute better on the ground in India. They innovated on the ground on how you can do these things, how you can recruit people, how we can make this business work. India is an example, somewhat unlike China, which is a fairly closed-off marketplace, where we've chosen that we want to compete on a technological level. That's a hard choice to make, right? Protectionism versus free markets has always been a debate throughout history, and we have chosen a free market path. For all of the companies in the past, that free market path worked out reasonably well. We got the best of companies that were in America and in the rest of the world and their products. And then in our products, we figured out how to make it work on an India scale. With AI, that's a little bit different because it's a pure technology where it's unclear whether your understanding of the local area has any difference in terms of product.
Right.
It's a pure software play. It's a pure, and when you talk about pure plays, it's very difficult to compete with the people here and the companies here. And the reason is you need capital investment. You need talent. You also, some people make the argument of, hey, what if we made models that were very good for Indian languages? Sure. Why would you have more data than someone like Google? Google's sitting on all of YouTube. Google has infinite access to resources to collect data in every single language. And the last point...
So you're saying that's not an advantage either?
Maybe for the short term. Maybe you do partnerships that solidify, that make your product accessible to a lot of people. But at a pure technological level, I find it really hard to even squint my eyes and see a world where in Hindi or Tamil or Bengali or whatever language you choose, that they don't have more data, they don't have better models, and they don't have cheaper prices.
They may choose not to prioritize it though.
That is always temporary in my opinion. For a company like Google, who is, sort of in their DNA is to build products for the world, internationalization or localization as they call it.
Just a matter of time.
It's just a matter of time. They are prioritizing it at some level, and it will probably come. So the question is, how defensible would be the work that you do today?
And we've got the government coming in and backing, foundational models and saying that we'll have our India model in the next 6 months and so on and so forth. How do you see this playing itself out? The government kind of also, in a way, collaborating, partnering, whatever you'd like to call it. How do you see this impacting business outcomes going forward?
Well, the downside of protectionism usually is you are protectionist when you sort of don't believe there's a current right to win, and you temporarily make some sacrifices to promote local technology in the hope that they will eventually catch up to global technology. And that's sort of I think the premise of supporting sovereign models. I mean, there's security and there's some other stuff too. Given that premise, you still have to believe that these will eventually catch up in terms of power to frontier models. I just don't know if that's the case. It could be the case, but look at the amount of spend these companies have had to do to create the models that they do. I mean, you look under the hood, even look at the public rumors on how much OpenAI spends and how much Anthropic spends. We're talking several billions of dollars a year without necessarily seeing profit for a while. And the other question you have to ask is, who will front that cost in India? Is it worth fronting that cost in India? And then you come back to even somewhat adjacent topics, which is that the best use of money in India? It's nice to say you want to compete on a global scale in AI, but to me, it often feels like that shouldn't even be the priority. We wouldn't have said in 1998, hey, let's create a Google of India. It wouldn't have worked, right? And so similarly here, I don't know if an Indian foundation model is competitive or would work as a business. There are local problems to be solved. There are many cases where Indian companies have a huge leg up over companies that are global, and I think you should exploit those opportunities. Why focus on something which is extremely hard to compete with on a global scale? Almost no other country in the world can compete with America on this scale. What gives India the right to compete? I think it's still unclear.
रिटर्न ऑन कैपिटल कि अगर आप 100 रुपए धंधे में लगाते हो एंड इफ यू कांट जनरेट 15-16 रुपीज आउट ऑफ बिजनेस, तो उस बिजनेस का मतलब क्या है? फिर तो आप जाके अगर 7-8% ही करना है तो आप एफडी में पैसा रख दो. वन ऑफ द कंपनीज which is now known in the market is a company called Solar Industries. Today, the market cap is 1,50,000 crore. When we identify, it was 1,000 crore market cap. Narratives will work for a while.
Right.
But finally, top line is vanity, bottom line is sanity, and cash in bank is reality. It's the promoter. He's the friend, he's the enemy.
Make or break.
Make or break. वही बनाता है, वही बिगाड़ता है.
Okay.
There are pockets of bubbles. I am completely acknowledging that. But it should not be painted with the same brush that everything is expensive.
I remember meeting Rhythm Desai at the
Okay.
Morgan Stanley conference, and he actually went on to say that Indian stocks are cheap.
Yeah, I mean, you have to search your pockets.
Yeah,
and I think
yeah.
ये मेहनत करने का time है. You have to go at the ground level, search for companies, search for good promoters.
Finding the ultimate multi-bagger, that mid-cap or small-cap stock that will compound in such a way that it will light up our portfolios, that it will make all our dreams come true. Let's face it, this is a big wish for most of us investors when it comes to the stock market. But finding that ultimate mid-cap or small-cap stock that will lead you to riches, it's easier said than done. So in today's edition of Market Cafe, I thought, let's go and meet a man who is one of the most celebrated and the most successful mid-cap and small-cap stock pickers of India. He's got over 2 decades of experience and he has so much to share. So let me go and introduce you to Pankaj Tibrewal of Ikigai Asset Manager. I can't tell you, Pankaj, how happy I am to be speaking to you in this environment. You know, this setting, thoda relaxed lag raha hai.
एकदम.
And the conversation, I think, demands it. We're speaking to one of the most legendary mid-cap stock pickers in India. So here he is, Pankaj, and in about more than 2 decades in capital markets, right? And mid-caps and small-caps have been your forte, so to speak. But before we talk about mid-cap stock picking, Pankaj, I actually wanted to spend a minute to understand today's market. In 2025, we have seen such uncertainty on multiple fronts. Do you feel that return expectations need to be scaled down from Indian equities?
So Surbhi, last 4-5 years post-COVID has been a dream run for equity markets in India. And obviously, in many pockets, we warned in September that there is a bubble brewing up. But let's divide the conversation into 2 parts. One is the domestic and one is the global. I think the big picture first on the global side, that the world is changing. The era of globalization, we were brought all in post the World War II. I think that's leading to deglobalization or fragmentation. And I think that's a big picture change we should not ignore.
Yeah.
Countries are becoming more inward looking. They want everything in the country. Protectionism is becoming a very, very big thing.
Yeah, absolutely.
And I think that leading to some kind of a macro change globally. And to me, it's not a trade war, it's a yield war. Look at the Japanese 30-year bond yield. Look at the US 10-year bond yield at 4.5%.
So that's the thing, that in a world of very severe dislocations, I mean, who would have thought that investors will start moving out of the US?
Yes.
Who would have thought that there'll be so much of trade conflict? Who would have thought that there'll be so much of geopolitical conflict? So in this world of major shifts, where are we and where is our market? And what is the kind of market that we are probably going to be in for the next, say, 2-3 years?
So I think in the context of the global environment which I spoke about, which is uncertain, very volatile, I think India is an oasis in the desert. And what we have been saying that growth will pick up. And look at what happened in the 4th quarter. 7.4% GDP growth. Government capex in 1 month was 280,000 crores. What RBI has done is remarkable.
Yeah.
At least in my 2 decades, Shurbi, I have never seen so pro-growth RBI.
Usually they're so conservative.
I mean, hats off to them. The system was deficit, durable liquidity, 3 lakh crores in the month of January. From there till now, they have pumped in more than 10 lakh crores. And the further CRR cut, which will start from September to October, will see another 2.5 lakh crores. Coupled with that, 100 basis points of interest rate reduction. So I think RBI is completely pro-growth. We are the only country in the G20 countries post-COVID which has brought the fisc from 9.5% this year to 4.4%. Only
Fiscal
country in the G20 nations. So I think we have gone a long way on the fisc consolidation. Now we think is the time to start on the escalation mode on the growth. And I think all the three parts I am quite bullish on, which is liquidity. Incremental liquidity is better. Incremental cost of funds will be lower than last year. And third, incremental growth, both on consumption and capex, will be better than last year.
So that's the academic part of it. Now let's translate this into again the market question that should investors continue expecting a dream run from Indian equities? Because post-COVID, it was a complete dream run. Then it started getting volatile and patchy. So now what?
So it'll be over longer periods of time. If you look at Indian markets, 5 years, 10 years, 15 years, 20 years, finally the EPS growth and share price growth is not too different, right? What happened in the last 5 years? Nifty 500, Nifty almost compounded earnings at 18-19%, and so was the market return. The mid caps and small caps compounded between 22 to 25%. Slight PE re-rating, they saw the same returns, 25 to 30% CAGR returns. I think the earnings growth will not be as charitable as we have seen in the last 5 years. You saw margin expansion, you saw balance sheet deleveraging, and everything helped on the P&L. I think going forward now, our expectation is next 2 years, the earnings growth should be between 10 to 13%.
10 to 13%.
And hence, in the near term, there could be narratives, aberration, everything can happen in the short term. But over the next 2-3 years, I think returns should mimic your earnings growth.
That brings me to the central part of this discussion. The reason why we've got Pankaj on this conversation today on Market Cafe is because I keep hearing increasingly the talk or the narrative that this is going to be now a stock pickers market. Jo chhu lo, wo chale, wo wala market nahi hai.
Yes.
You have to be very, very sure about which companies and which stocks you're picking. First of all, do you agree with this assessment?
To a large extent, I agree to this assessment. And over the last 3 quarters, we are seeing glimpse of that. How do we say we are seeing glimpse of that? Starting second quarter of last year till first quarter of this fiscal year, the headline returns of the index and the median return of the index are two different things. What do you mean by that? Let's look at last quarter, which is fourth quarter. The NSE 500 index was about 4.5% negative. But the median return of the index was negative 11%. 7% divergence, which means few stocks are holding the index higher, they are performing, and the profit polarization is also happening there. So my sense is that it will be a stock pickers market as you move ahead, because there is a divergence between the earnings growth of NSE 500 companies. And companies which will deliver higher than expected earnings growth will be the darlings of the market. And hence you need to be a complete bottom-up stock picker. It is not that everything will grow.
No, that's true.
There will be few companies which will grow faster than the average. Few companies will grow below the average. And hence we believe that if you can pick up the right winners on the earnings growth side, you will be rewarded.
Which now brings me to the crux of the conversation. What is the secret sauce? Now, viewers, some of you might...
So what excites you about the India startup story today, outside of course, what's happening on AI, where there are questions and doubts at this point in time on how it's eventually going to work. But overall, the India story and the India startup story, how's that looking to you?
I'm so excited about it for primarily the reason is talent. A lot more of a bigger percentage of the world over time of software developers come from India.
Yeah.
And add to that what I said earlier about access to skills and being able to learn with these AI and LLM tools, the potential is unbridled. And in terms of just talent that can come up in India and do things. That's so broad, and for the foreseeable future, India will be a source of a lot of the global talent pool. And if we can figure out how to retain more and more of that talent, and undoubtedly we will retain a lot of them, then I think there's a lot of opportunity in India. I mean, if you look at just from a cost perspective, hiring an engineer, even an average engineer in the Bay Area, and I'm not one to say that Bay Area engineers are better than Indian engineers. I don't think so. They might look better on paper. But an average engineer, a senior engineer here might cost you $350,000 a year. That's not how much an average engineer in India costs. So what does that do for the ecosystem? That just means India will become a hotbed for both global startups and companies, but also an opportunity for innovation unlike any other. And there will come a time, and this is the story I love the most, there's early signs of this, where India is actually capable of building companies for the world. And you see a couple of these consumer companies, like I like to always look at Pocket FM, probably the biggest one. But you see Indian companies create these consumer experiences that even Americans and the world will consume. And that will continue to happen. And I'm very, very bullish on that.
You know, since we're here in the Valley, what's consuming mind space outside of course, everything AI? I mean, geopolitics, immigration, what's happening in the world? What are people talking about? What are people sort of weighing at this point in time as founders, as investors, outside of course, what's happening on the tech?
Well, look, geopolitics is obviously a huge issue. However, to be honest, we don't think about it that much, because how much control do you have over those situations?
So focus on your area of influence.
Correct. I mean, that is often, you read, you don't respond. So you have to know what's going on with, whether it be tariffs or anything else. Those do impact a lot of the companies. However, they're somewhat not actionable. So there are things like that. Immigration is a big one. Of course, a lot of engineers, a lot of founders in the Valley too, do come from international backgrounds. So policy around immigration has a pretty large impact on what happens to the future of a lot of these companies, whether they decide to build offices here, somewhere else, all of that. So we pay attention to that. I would say hardware for AI especially is a big one. Whether it be, what are the restrictions on China in terms of building hardware? How far along are they in their supply chain to have a completely verticalized supply chain to roll out their own hardware? That's when things become a little bit tricky, because right now the hardware supply chain is pretty global. But China really does want to nationalize it because it sees America trying to defend against it. So, those are pretty interesting things, because that does shape the future of what the capabilities of AI look like. If you don't have access to hardware, it's very difficult to scale to a global scale. So those are some things that are interesting. Data center building in America, that's really interesting. Stargate and the amount of investment going on behind things like that is quite interesting from a geopolitical perspective.
Mind-boggling numbers there.
Yeah, but it's to bring it back to America. So I think those are several of them.
From your own experience of running things and now helping other people run things, what would you say are the top 3 things that differentiates a successful founder from an average sort of company that's trying to find its way, navigate its way through the market today?
So I would say number 1 is definitely you need to have some special knowledge or insight about what you're doing. I know it's not particularly new, but a lot of people take this for granted. Today, startups are so commoditized in the way they're formed and created, and you can go read 100 guides on how to build a company. That's all great, but that's actually not the useful part about building a company. Anyone can learn those things. The hard part of building a company is having a unique insight and belief that other people do not have. That's extremely hard. People are not trained, our education system does not train us to have unique, differentiated insight.
Yeah.
So that's the number one thing that we look for. The second thing is the talent to back that insight.
Yeah.
You know, you can't just have an insight.
Yeah.
If you don't have the talent, it's not just about inability to execute, it's also inability to hire. So you definitely need to have the talent to back it. Number 3 is shipping velocity. I love to say Perplexity is maybe the best example of this. You know, if you look at what Arvind's done, almost many people in the Valley will tell you that they were never impressed by what Perplexity has built. Because they're like, I can build this, I can see how this works. It's so easy for me to see how this works. But what he's done is he's built an exceptional product and he's shipped so quickly. Something comes out, it's on Perplexity. And that's really the modern version of keeping users excited and attracted to your product is shipping velocity. So that's number 3. And then if I had to say a number 4, I would say an insane amount of adaptability and curiosity about the world. This is the yesteryear's mindset of, hey, this is always the way things were done and this is going to continue to be the way things should be done. It's just broken today. It just doesn't work. It's so difficult even for us now where it's weird. We have to ask the question a lot of times, hey, I know you've been a VP of product at this amazing company and you want to start a new company, but I don't know if your skills are relevant anymore. Like, I don't know if the things you've learned in that job are at all useful for this next job that you're going to do. And so the ability to be curious and stay on your toes, that's rare. And so that's maybe the 4th thing we look for. I think if you have a combination of those 4 things, a couple of other things you might need, I think you have potential to be extremely successful.
So, 2025, we're kind of midway through the year, but say end of 2025 and 2026, do you believe that we're likely to see consolidation by way of M&A in the startup ecosystem? Some of the names that you spoke of, the IPO markets picking up again, after, at least in the US, after kind of being cold. India, of course, has been a completely different story. But both consolidation as well as IPOs, do you believe we're likely to see things heating up?
Absolutely. I mean, this has been a fantastic year for even Menlo. From that perspective, we've been very fortunate to have Chime go IPO this year, which was a huge IPO after a long time in the entire Valley. And then we had some big M&A acquisitions that happened as well, where one of our companies that we funded, Neon, got acquired by Databricks for near $1 billion. So yes, I would say that M&A markets are heating up. I wouldn't say IPO markets are necessarily heating up. They're opening up again. But most venture capitalists will tell you that there is a stark difference between public and private market valuations. And crossing that chasm, if you will, has become hard because you're so overvalued when you're private compared to the value you can get publicly. That's number 1. And then number 2 is, I think, an increasingly large number of companies want to stay private, which is somewhat the reason that the reason you wanted to go public before is for access to liquidity and capital. Today, you have that liquidity. You can just sell in the private market. There's so many private buyers, there's so much capital that the only incentive to go public is that you want to go public and you want to be listed, and it's some sort of achievement that you have. But who wants to report all their stuff to the SEC? Who wants to abide by all this regulation? It's very, very cumbersome to have predictable revenue and be a public company. So an increasingly large number of companies are just choosing to stay private. And that's something that we also have to contend with. The secondary markets are another way of getting liquidity for investors and people at the company. Secondary markets, M&A is picking up, IPOs opening up, but still I would say wait and watch mode.
Valuations, especially on the AI front, I mean, are we anywhere close to the peak, or are we still going to see crazier valuations?
The valuations are crazy. I don't think they're necessarily always justified. A lot of people, will say, hey, look at venture capitalists, they're giving people these crazy valuations. And, in my defense, the one thing I will say is, the valuations are really set by the market. And the interesting thing about a private market is there's no downward pressure. There's no equivalent of shorting a stock. In a public market, there's a reason because people can sell it and people can short it. And so there's no incentive for you to artificially blow something up. But in private markets, there's only upward pressure. So when there's access to capital to win good deals, you just pay crazy prices. And we're seeing all of these crazy prices.
So you admit you are paying crazy prices?
No, we are paying crazy prices. I don't think it's like that hard to admit. I mean, just objectively by the numbers, those prices do not make a ton of sense in many situations. You are often, it's not all companies, we often tend to focus and over-focus on the very, very crazy ones. But even the normal ones, I would say, are much higher priced than before, which increases the bar for returns. And that is just the market we live in, because there's access to a lot of capital. Last thing I'll say though is venture cycles. The reason this is possible in venture versus say like hedge funds who trade public markets is because the time that it takes for you to realize that you haven't done a good job is 7 to 10 years. It's a typical cycle for a fund. So 2021 was a time of reckoning. And a lot of the funds of the 2021 and 2020 vintage are affected as a result. They're not doing particularly well. But this will take 10 years to sort of play out. And maybe if you squint and go to like 2030, people hope, or not hope, but people think there will be a time of reckoning for a lot of the funds who have an overflow of capital to be like, we haven't actually done a good job for our LPs. We haven't actually returned money that we were telling them we would return. And then a lot of those funds will cease to exist, perhaps. And that's where you get the reversion to the mean over time. But I don't see it happening in the recent future. Right now, the valuations are still quite out there. I mean, you're looking at, maybe the most iconic example of that is Thinking Machines, Mira Murati's company from OpenAI. I mean, it started with a seed round of nearly $10 billion. And I don't know how to reckon with that. Like, you don't have a product or make any money. $10 billion is a pretty lofty price for something like that.
So what do you believe the bet is on then?
I wish I knew. I wish I knew. I mean, we're not investors in Thinking Machines, but for the companies who are, their claim, actually, I do know. I'm friends with some of the people who work with companies like that. Their claim is the outcomes are so large that we can drown out competition with capital. Capital allows us to recruit better. It allows us to have leverage on how we distribute our product, and any other company that tries to compete with us won't compete. Maybe we won't see like a 3x, 4x, 5x return, but hey, even if we see a 2x return on that, that could be pretty lucrative given the amount of capital that's going into this, and maybe it could be at a shorter time period. More notably. So can we keep our internal IRR pretty reasonable even by paying a really high price up front? Maybe. And the fact is there's precedent for this. I would say that even if you look at companies like Anthropic where we did back them, there is precedent for these humongous valuations turning into something even more incredible. We backed Anthropic at first the Series C and then led their Series D. And that seemed like an egregious price to pay at the time when they made no money, they made no revenue. It was unclear how they would even make revenue. Whether would they be consumer? Would they be enterprise? Would they have the frontier models or not? All of that was very unclear. And we made such an insane bet, and you fast forward now and you kind of look like geniuses. Like the company is doing so well, it's valued at $60-something billion. So there is precedent for that.
Didi Das, the entrepreneur, Didi Das, the investor. Where do you find that you're most comfortable today?
I mean, I think I would always be more comfortable in an entrepreneurial setting. I think that is the source of anything that I've been able to do or otherwise as an investor. So that's always going to be my choice. Now, entrepreneurs are the lifeblood of the Valley.
Well, there's plenty of that energy here in the Valley, and we hope we continue to see you fund a lot of that energy, at least in this avatar at this point in time. But thanks so much for joining us.
Thank you so much,
Voices from the Valley. Appreciate you joining us here on the program. That's Didi Das. If you enjoyed that conversation, visit us on CNBC-TV18.com, on CNBC-TV18 Prime and Access. Log on to our social media pages. We'll see you again next week. Till then, from all of us here on the team, for now, thanks very much for watching.